know when they are wrong, and the endurance to take the pain of not only losing money, but also failing to make a correct call repeatedly. While all properly initiated traders know that being frequently incorrect in your opinion and taking regular small losses is irrelevant to good trading, it is a form of Chinese water torture for the vast majority of people, and downright unacceptable in most occupations. That makes these character traits uncommon in the average person, and therefore the aspiring trader. But all of these interesting elements of success belong in their own podcast episode, which I'll record someday. Today's episode is focusing on the final and most underappreciated aspect of the most successful traders in the world: the fact that they treat their trading like a business. Trading is not a recreational activity. To elite traders, trading is a job like any other job. The main enviable difference is that they get to be their own boss and pick their own hours, if they're retail traders, and potentially make huge sums of money for minimal time invested. Now, for retail traders to make huge sums of money could take decades, but for prop or hedge fund traders, they get paid pretty good and typically have a lot more capital at their disposal. But one thing elite traders do not normally experience in the markets is excitement. For the majority of elite traders, even including fast-paced scalpers and day traders, they typically experience trading in a flow state. There is no excitement, and more importantly, no fear. If there is fear or excitement in an elite trader's day, then that usually means they did something wrong or inconsistent. When you are consistent over a long period of time, whatever it is that you are doing becomes second nature, and the excitement goes away naturally. It's the price you pay for being a professional. It happens to everyone in all careers to some extent. Maybe not Formula One drivers, but you get the idea. If you were to go to your doctor and you saw that he was fidgeting and couldn't sit still, and then he said he couldn't wait to begin operating on you, you would probably feel uncomfortable. And so you should. You want a doctor or surgeon that has his nerves under control, not a gung-ho lunatic who's eager to get his hands dirty at any cost. Likewise, if you were to get on a plane and the pilot announced that this was his first flight and he was extremely excited to see what happens, you'd probably feel a little bit of anxiety. Only amateurs get excitement out of the markets. Experts know exactly what to expect because they know their strategy. Of course, they don't know how the markets will specifically play out this particular time, but they know what they'll be doing regardless of what happens. They are focused and they have a plan and a strict process that governs their business operation in a consistent and sustainable manner, just like any other successful business. And so, the reality is, most of the time, long-term, sustainable, successful trading is boring. If you want to feel excitement when you put your capital at risk, then you belong in a casino, not in the markets. And there's nothing wrong with that. Just make sure you know the difference. I myself enjoy going to the casino occasionally for the excitement of gambling. But while it's a nice surprise sometimes, I never expect to win because the casino has the edge. The markets are different. In the markets, I want to have the edge. And so this is the appropriate attitude for trading too. If you want excitement out of your trading, then don't expect to make any money. At least not consistently. The elite trader does not think or care about how much money they're going to make on their next trade, or how much they might lose for that matter. Those thoughts have little to no emotional impact on them whatsoever. It's completely irrelevant, because they know all of that is taken care of over the long term as a result of employing the correct foundations in their trading process. Of course, there are times when their system is doing particularly well or particularly poorly, and that may still affect their emotional experience. Successful traders are not immune to joy or suffering or stress. But those feelings are definitely subdued and mitigated by the fact that their perspective is shifted from the short term to the long term, and their focus is process-oriented instead of solely results-oriented. Great traders don't make lots of money from their efforts at trading directly. If that were the case, then everyone who tried really hard at trading would be making lots of money. No, the secret is that they follow their rules and processes, and depending how effective their rules and processes are, determines how much money they make over the long term. There's a distinct difference. Don't expect trading to make you feel good. If you want to feel a sense of accomplishment and achievement from your trading, then focus on your trading process, not your trading results. Track your discipline and how many trading errors you make each month. Train yourself to think in terms of the bigger picture, and then you will begin to feel good about yourself when you exercise self-discipline and proficient trading skills and stick to the plan. There's a big difference between feeling good when you win a trade and feeling good because you followed your processes properly. It takes time for your processes to play out, so it will take time for you to feel good about yourself if you focus on judging yourself based on the progression of your process, which means you can't expect trading to make you feel good all the time. If you enter the business with that expectation, then you will find the journey unpleasant, speaking from experience. You need to develop an appetite for challenge, or else the challenges will overwhelm you. And as I said before, if you want excitement, then maybe consider rewarding yourself by going to the casino or something like that a few times a year when your trading is going well. Or go skydiving or bungee jumping. But whatever you do, don't treat the markets like a casino. Going to an actual casino when you feel like gambling will help you to differentiate between trading and gambling. But in my experience, most traders who become consistently profitable never care to set foot in a casino again anyway, because they see it as a waste of money that could be better spent invested in their systems that make money and have an edge. Once you understand what it means to have an edge, you typically lose interest in negative games or negative implied odds like the ones casinos offer.
Although poker is a little bit different. In poker, you can actually become skilled enough to beat the other opponents. As a trader, I've grown to appreciate poker much more. It's become my go-to game when I feel like gambling because, unlike the casino, if you take some time to study the game and you pick your games carefully, you can actually have an edge over the other players, especially at the low stakes where people play loose and are usually just there to gamble. But I digress. The subject of poker and its similarities to trading deserve its own podcast episode someday.
So how do you treat your trading like a business? Well, trading can be many things, but it should only be one thing if you plan to not only survive, but thrive over the long term, and that is a business. And if you've ever owned a business or worked for a business, then you know how impersonal financial affairs are in larger organizations. And that is how it should be with your trading. It's no different. The only difference is that instead of the company's reputation and capital at stake, which is depersonalized, it's your own reputation and capital at stake. Not just temporarily, but for so long as you're active in the markets and with ever-lurking uncertainty for the future. That's why emotions are heightened in trading compared to other financial or entrepreneurial endeavors. Not only are we putting ourselves on the line and our money on the line, but we have to do it repeatedly every time we place a trade. Every trade we take is a new business venture, and every new business venture might just fail. We don't know the future. But each trade should really be viewed as an investment within a larger business venture, which is comprised of our entire operation as a trader. That is the appropriate way to think about it. Not all investments play out ideally, but in a successful business, the ones that do make up for the ones that don't. That's exactly how trading should be. The most effective way to treat your trading like a business is to journal and track your trading statistics extensively. Don't just track them for the sake of it though. Make sure you are tracking stats that mean something to you and that you understand how to interpret. For example, don't just focus on your overall win percentage or your overall drawdown or something like that. Break your trading down into micro routines and pieces. Analyze each market you trade as if they were your employees. Which ones are carrying their weight? Which ones are holding the team back? Don't make radical decisions based on a small sample of data. But once you have enough data, say over 100 trades or a 6-month period, then you can break things down and see if perhaps you'd be better off letting go of certain markets from your portfolio or systems, or increasing your risk on the markets that are consistently performing well, or your allocation to those systems. Analyze your average profit versus your average loss, or your annual return divided by your max drawdown, the MAR ratio. That's another good metric to track. Make sure that you're hitting your target numbers and staying above your danger zone. I recorded a podcast episode explaining the mathematics behind analyzing your edge,
titled The Math of Winning.
There'll be a link to that in the description. Check that out if you want more information on how to break down your trading performance metrics to determine things such as your minimum win rate required to turn a profit. If you can't consistently exceed that win rate, then perhaps you need to return to the drawing board with your system and make adjustments. And finally, analyze your routine. Do you perform top-down analysis at the same time each day? Are you checking your trades at the same time each day? Are you entering and exiting your positions consistently each day, each week? Or are you lazy and you skip a day here and there, which results in sabotaging your long-term trading performance and psychology? If you're a discretionary trader, then do you draw your trend lines and support and resistance the same way every time? Or are there inconsistencies there? You need to minimize those inconsistencies, if there are any. These are the types of things you should be thinking about as a trader, not just your next trade. The next trade ought to take care of itself if you are doing all of this properly. Nick Raj, an extremely successful trader here in Australia who's been trading for over 35 years, he likes to say, focus on the next 1,000 trades. And Mike Bellafiore, the co-founder of S&B Capital, one of the biggest prop trading firms in Wall Street, Mike likes to say, one good trade, then one good trade, then one good trade. You keep doing that consistently without getting hung up on any individual trade, and you will find success eventually. Or as Akil Stokes, a really popular Forex trading coach, likes to say, process over outcome. So what are the benefits of treating your trading like a business? Once you're in this optimal place of operating your trading like a business consistently with strict processes in place that are designed to enhance your edge and your long-term expectancy, then a lot of the immediate stress and pressure of trading is relieved. As traders, we have a lot of pressure to perform, but the markets are a wild and unpredictable place, which makes it difficult for us to determine exactly what it means to perform well. If you define performing well as following your processes and trading rules to the letter each and every time you place a trade, then it becomes a lot easier to grade your performance as a trader. The other benefit it has is that it shifts the blame from you to your system. If you're not making as much money as you'd like to, but you're following your rules consistently and trading your system as it was designed, then you know exactly where the problem lies. It's not with you, it's with your system. And so it becomes a lot easier to diagnose and fix the issue. Rather than questioning yourself and whether you have what it takes to be a successful trader and suffering low self-esteem, you merely question your system and whether or not there are things you might be able to do to improve it. Once you isolate an objective pattern in your trading that could be improved, then it's a simple matter of backtesting variations of potential improvements until you find one that does the job. No emotional pain or suffering is necessary in that process, other than the pain of backtesting, which is something we all must come to terms with at some point as traders. This is how you treat your trading like a business. Simply imagine your trading processes and strategies and systems without you in the picture. If you can't do that, then you may have a problem with consistency. Ask these questions. Do you have systems in place that could, at least in theory, be automated or delegated to another person without too much confusion in explaining what needs to be done? Do you have processes and rules written down in a detailed and objective manner? Do you have organized spreadsheets and statistical data on your trading results? And are you analyzing your current performance in relation to your past performance? Not other people's systems or performance, but your own. And are you operating out of a growth mindset and constantly building towards improved efficiency and efficacy? If you answered no to one or more of these questions, then you need to take some time to better define exactly what it is you are trying to do as a trader. But if you have all of these elements of your trading under control, then congratulations. You should be proud of yourself. You've truly committed to trading, and I believe it's only a matter of time before you achieve the success you're aiming for, because that's how it worked for me. I hope you enjoyed this episode. I love you guys. Best of luck with your trading, and I'll speak with you next time. Hey traders, hope you're doing well. So a couple of weeks ago, I sent out a email newsletter asking traders to let me know what they're struggling with. I was just curious to see what people needed help with, so that I could just be more aware of that when I'm making content. And I actually got a lot of replies. I got over 50 responses from traders telling me various things that they're struggling with in their trading, and I thought it was really interesting to reflect on. You know, I've been trading for 7 years now, and I've been through my own share of challenges, personal struggles, issues I've had to work on to become a profitable trader. And so I thought I might go through each email anonymously and give my reflections, advice, tips, anything I've learned myself from my own trading experience that might help some of you guys with these issues. And even if you don't have these issues, maybe you'll just find my thoughts interesting on the subject. So let's get into the first email that I received. I struggle with patience with following the strategy. I can definitely relate to this one. I struggled with it a lot in my early days, particularly. And by a lot, I mean a lot. It was probably my biggest weakness as a trader and led to a lot of inconsistencies in my actions. Consistent profitability depends on consistent actions. So there really is no way to counteract or counterbalance impatience in trading by making up for it in other areas. It's just something that you must find a way to develop as a trader. And this is something that comes with practice and time and experience. First, it's important to have confidence in the strategy that you're trading. If you truly believe in your system, then you're much less likely to feel the impulse to override it. Ensure that your backtesting process was robust and encompassed as many known challenges as possible, meaning it covers various market conditions, drawdowns, losing streaks, and so on. When I'm analyzing my backtesting results, I like to put myself in the shoes of actually trading it, like in real time. So I try to visualize the journey, not just the outcome. I look to see what the average drawdown is, how often I can expect to be underwater with my equity curve, how deep those drawdowns are on average, how long did it take to recover its worst drawdown, did it have losing years and months, and so on. I pay special attention to its month-by-month returns and drawdowns and try to really feel what going through the motions of having my money really fluctuate like that would be. or feel like. It's easy to look at a final backtest result that returns an average of 30% or more over the course of a year and think, I can definitely trade that. Until the 30% drawdown comes along and you go off the rails emotionally and fail to follow the system because the loss is double what you're comfortable with or something like that. So preparation is key, and honestly, that's probably going to be my answer for most of the comments of what people are struggling with when it comes to their trading. The backtesting process can really eliminate a lot of these issues if it's done properly. But as for developing patience in following the system once it's built and you have confidence in it, well, that comes down to practice and discipline, which can be learned and developed over time. So don't be discouraged if it's hard in the beginning. It does take time to develop that skill, but it can be done 100%. I've definitely done it. When I started trading, I was all over the place, and now I'm so consistent. I don't even tell people at parties what I do anymore because it's so boring. When I get into the details of my day-to-day routine, it bores people to death. So trading's not exciting. Good trading is not exciting. Always remember the end goal. We're here to make money, not have fun, and not be excited. I have a large piece of paper pinned to my wall in my office, which has been there for several years now. It says in all capital block letters, trade your edge with edge underlined. It's a consistent reminder to myself that I invested the time in developing my edge and my skill at trading. I trust it. I know it will keep me out of trouble. So why should I ever deviate from my plan or my system and risk losing everything on a whim or some random emotional response? And to be honest, if you can't find a way to develop patience and discipline to follow your system after trying for a long time, then maybe you're just not cut out to be a trader and you need to find an alternative wealth building method which doesn't require rigidly following rules. Good trading is boring, and if it tests your patience because it's not exciting enough, then believe me, there are easier ways to make money that are much more exciting than trading, like starting a business in a field you're truly passionate about. For me, it really helped to train myself to think long term. I think in terms of the next 1,000 trades or even 100 trades. I don't really analyze my trading results until I have a large sample size, but the only reason I can do that safely is because of my rigorous backtesting and risk management. I don't need to micromanage my systems because I know that they're sound. So unless a black swan event occurs, there's almost no chance of me taking large losses rapidly. And so I can sit back, keep pushing the buttons day after day and reflect on my results each quarter or so. So I don't really give myself time to get impatient. I just keep taking trade after trade after trade until it becomes robotic. That's my solution. But I'm a systematic trader, so things are different for systematic traders. If you're a discretionary trader, it is going to be much more difficult to develop patience if you're naturally impatient. But it can be done. And if you're committed to trading and overcoming this challenge, then I'd recommend researching the science and psychology behind motivation and finding out why your patience is being tested and why your discipline is being tested. Then you can build systems, processes, and integrate techniques to help mitigate that problem in real time when it arises. Becoming a good trader means becoming very self-aware. You can't lie to yourself. You need to be your own worst and harshest critic. But you also need to go easy on yourself and understand that trading is a process. This is a skill that's developed just like any other skill. No one picks up a guitar for the first time and is pissed off because they can't play like Jimi Hendrix. That's ridiculous. And it's the same with trading. Obviously, the main difference is with that analogy is, if you play guitar in front of people, you might embarrass yourself if you're not good at it. If you start trading and you're not good at it, you could lose a lot of money. So stick to a demo account if this is something that you're still working on. That will test your patience for sure. Trading money that's not real really forces you to focus on the process. And if you find that boring, demo trading and practice trading, you definitely need to work on your mindset about trading. It shouldn't be exciting. Now, there are moments that trading's exciting for sure. Like I started off this year, my first quarter was awesome. It was probably the best quarter I've had maybe ever, especially in the stock market. And that was exciting. But it wasn't one day. It was several weeks of trading that got that feeling to come out of me. So, that's, for what it's worth, that's how I think about this particular subject of patience in trading. It's a discipline issue. It's a confidence issue. To work on that will require uncomfortable and honest reflections on yourself. But that's the magical thing about trading. You need to embrace that as a trader, I feel. Anything that makes you a better trader will make you a better person. I mean, if you can develop patience in the markets, trust me, from experience, you become more patient in traffic. You become more patient standing in line. The other day I went to pick up some takeaway food and it was running late. I had to wait an extra 15 minutes and there were people in the queue that was so pissed off, and I was just chilling because, I've got worse problems in the world. than standing outside and watching the night sky and reflecting on life. It's not that bad. So yeah, putting in the work to develop patience, develop discipline is worth the trouble, not just because it'll make you more money, but because it'll make you a well-rounded person. If that's not motivation enough to work on it, I don't know what is. You get paid to become a better person when you become a good trader. That's the best job in the world. As far as techniques and stuff go, there's a great podcast episode by Andrew Huberman, Dr. Andrew Huberman, a neuroscientist from Stanford University who does great work explaining how the mind works in relation to subjects like this. So I'll leave a link to that below. The title of that podcast episode I'm talking about is How to Increase Your Willpower and Tenacity. I'll leave a link below somewhere, so go and check that out. That's all I really have to say on this subject. Thanks for being honest and sending it in. I mean, all of us have issues with our trading. Even I have some issues that I need to work on. So there's no shame in having challenges as a trader. Being honest about them, being open about them is the first step to fixing them. So good on you. Good luck with it. If you're truly in the right place, if your heart's truly in the right place as a trader and you're not here just to get excitement and treat it like a casino, you'll get there. You'll figure it out. Just do deliberate work on it. It's not easy, but it's definitely doable and worth the trouble to achieve. So good luck with that, and I'll speak with you guys in the next episode of this series. Take care. Every trading podcast has an intro with music and all that stuff. Let's not do that. Let's just get straight into it. You guys don't need to listen to my jingle. Let's just get started. So today's question or struggle from a trader is this. The question is, what are you struggling with as a trader? This trader's answer is, I'd say sticking to my pre-market analysis. If it goes how I expect, fine. But then if price does something else, I often take trades without doing new analysis. Getting there though. I get the vibe just from this trader's self-awareness of this problem that they're going to sort this out themselves and they don't need my help with it. But I will give my thoughts on this because it's a really important topic or subject that I struggled with in the past as well. And this sort of question applies to trading in general, not just pre-market analysis. So let me share my thoughts and experiences with this type of struggle as an aspiring trader. The key to success in any form of trading is consistency. Whether you're a systematic trader or a discretionary trader, you must be consistent in your approach to trading and analysis. If you are inconsistent, then you cannot improve, because you cannot improve what you can't measure. One way to increase the probability of you sticking to the plan dictated by your own pre-market analysis is to incorporate third-party accountability. So this could mean joining some sort of trading group or mentorship, or it could simply mean posting your pre-market analysis on social media like Twitter before you begin trading. Even if no one reads it, at least it's out there in the world, and you can reflect on what happened after the day is over and see how consistent your actions were with your pre-market analysis. Now, depending on your personality, this might help or it might hinder your performance and make you more self-conscious and overthink your decisions. So it's not something I'd recommend to everybody, but it's worth a try if you think you can handle the added scrutiny of publicly announcing your intentions. You can also just hold a journal, write down your pre-market analysis notes and intentions before trading begins, and after you've stopped trading, jot down the decisions you made throughout the day and see if they're consistent with what you plan to do. Simply writing down the words, "I screwed up again today," enough times will trigger something in your mind eventually. And I'm speaking from experience. One day you'll write it down and you'll think, this is ridiculous. I'm making this mistake way too often. I'm not improving. And if I don't figure this out, I might not ever achieve success at trading. And I really need to step up my game because this is embarrassing. That's pretty much how journaling made me feel back when I was struggling with breaking my rules all the time, putting on too much risk, cutting trades early because I was scared of losing, or taking profit too early because I was scared of not making the most amount of money. I used to journal about those problems all the time, and after a while, after a month or two of constantly reminding myself of how much I sucked at trading, I started to take it seriously and make serious commitments to improving. I would just pick one element of my trading that I was screwing up and focus on that until it was fixed. And then I'd move on to the next problem. So if that was inconsistency, so not taking trades I should be, or taking trades I shouldn't be, I'd just stop that and I would just focus on only ever taking trades that meet my trading rules. And then if the next problem was putting on too much risk, getting greedy, then I would focus on that and improve that. And I wouldn't move on to the next problem until that problem was fixed. It was slow. It cost me a bit of money in the beginning, but I kept my account size small because I knew I was learning. And over time, I overcame those problems through journaling. I don't keep a daily journal anymore. I reflect on my trading quarterly now because I have a handle on my day-to-day trading psychology, and I don't make silly mistakes anymore, at least not consistently. The mistakes I make these days are usually due to complacency and being too comfortable with my trading and routine. It's not from bad trading psychology and bad habits, typically. But journaling and or sharing your experiences on social media can really help increase your accountability to yourself and your goals. That's my practical thoughts on the matter. Anyway, that's a technique you can use, journaling and maybe sharing your experience on social media to be accountable to what you say you're going to do. The second thing I want to mention regarding this issue is the importance of reminding yourself before you start trading every day of the importance of consistency. Again, you cannot improve what you can't measure, and inconsistent actions versus your trading plan introduces a level of randomness to your trading that cannot be analyzed and improved upon. Think about it. What's the worst thing that could happen if you stick rigidly to your pre-market analysis plan? Maybe your plan is wrong and you might lose some trades. Assuming you have your risk management under control, this shouldn't be a catastrophic problem, and it should take a long time for you to blow your account. This means you should have plenty of time to analyze your trading plan and pre-market analysis over time to improve it. Figure out if you're making bad decisions or if the losses are just natural losses which occur when any trading system is out of sync with market conditions, which is perfectly okay and happens to even the best traders. You can't be right every time, all the time. For example, if your pre-market analysis identifies a trend continuation possibility for the day, and the markets do in fact continue in trend during the day, and at the end of the day you discover you failed to capitalize on your correct pre-market analysis, then you know you have a problem with execution, not with analysis and planning. And at least you can focus on that. You can revisit how you enter trades, what your entry criteria and exit criteria and signals are, and so on. Maybe you entered too soon and you need to be more patient. Whatever the case is, you can work the problem practically because you were consistent with your analysis and your plan. And likewise, if your pre-market analysis identifies a trend continuation possibility, but the markets reverse massively and you're way off, and that happens a lot, of course you're not going to make money out of your pre-market analysis because it's just plain wrong. But again, now you can practically approach the problem. You can figure out what was it that led you to believe the markets would do one thing when it did the other. Just being consistent to the plan allows you to improve the plan. And if the plan's not the problem, then you know the problem is a technical issue with your execution, the way you enter your trades or exit your trades, and you can work that problem. However, if you come up with a pre-market analysis plan and then during the trading session you go AWOL on that plan and basically wing it, then there's not much you can do about that. You're just a bad trader. Even if you have a good outcome, it was random and not easily reproduced because you don't have a system or a plan that you can measure, improve, and build upon. At least that's how I thought through this problem when I began trading and I was struggling with these sorts of issues. I 100% can sympathize and empathize with the experience of having a plan and then getting punched in the face and then losing sight of that plan. That happened to me a lot when I started trading. So I know this problem, I've been through this problem, and these are the ways I thought about it and how I overcame it for myself. Just internalizing this knowledge and theory and believing that consistency in trading is of paramount importance can help you stay motivated to stick to the plan. As Friedrich Nietzsche once famously said, "He who has a why to live can bear almost any how." Now, I don't want to get too deep on you guys here, but if you understand why you need to stick to your plan and system in trading, then you'll find a way to do it. It might take time, but you will find a way. If you're doing it just because you think you should, but you don't understand why it's important to do, then you're much less likely to stay focused and disciplined in pursuit of your goals in trading. So with this problem or any problem in trading, reflect on why pre-market analysis is important. Reflect on why being consistent with your actions in parallel with your pre-market analysis is important. Again, remember, if your goal is to improve as a trader, you need metrics to measure. And if you're inconsistent, you have nothing to measure. And so reflect on how all these core pillars and building blocks form a strong base for success in trading, and your self-awareness, your focus and discipline will improve dramatically overnight. Just understanding why discipline is important and consistency is important, understanding the value of these things in your trading will improve your focus on those values. The rest is just a matter of employing systems and techniques to improve consistency and solve the problem, which is a lot easier to do when you have consistent metrics to measure and build upon. As Akil Stokes
a pretty reputable Forex trading coach loves to say, plan your trade, trade your plan. I have a big note above my office that says trade your edge in big block letters, and edge is underlined. Trade your edge. If I'm not trading my edge, then I'm just gambling. I'm not a real trader. I'm not a professional, and I want to be a professional trader. That means trading my edge. In my case, as a primarily systematic trader, that means sticking to my system, trading my plan as it is designed. In a day trader or discretionary trader's case, that means sticking to your pre-market analysis and your trading system. Even if it's discretionary, you still need rules. You still need consistent approaches and techniques that you apply to exploit your edge over the markets. So yeah, I hope that helps. I hope that gives you something to think about and inspires some other ideas on how you can go about this. I mean, there's so many ways you can approach a problem like this, but that's my thoughts on the matter. Understand why solving the problem is important, and you'll be much more likely to commit to ways to fix it. I mean, identifying the problem in the first place is half of the solution to the problem. You've already done that. You are aware this is a problem. Now you just need to understand and believe that fixing it is important, and then you just need to find techniques that work for you. Journaling is a great place to start. That's where I would recommend you start. It can be as simple as a spreadsheet with every day listed out in it and just a yes or no. Do you believe that today you followed your plan as best as you could? Yes or no? And if you have way more no's than yeses, then just simply noting that and writing that down and making that real over time will help you to be more self-aware, be more focused. And when you are in the moment and you're breaking your rules or you're going against your pre-market plan, you'll notice it more frequently and you'll be able to stop it in the moment. Building self-awareness takes time, but thinking about these issues is the first step to implementing a solution. Anyway, I don't want to repeat myself, so I'll wrap this up here. Good luck with your trading, and I'll speak with you guys in the next one. Take care.
During World War II, the US Navy had a problem. They were losing bomber planes to enemy fire at an unsustainable rate. Something had to be done to reinforce the armor of these important war assets. So the Navy began studying the planes which returned from combat. Initially, they planned to reinforce the areas of the plane which had been hit the worst by enemy fire, until a statistician by the name of Abraham Wald observed that the Navy should in fact do the opposite. His conclusion was counterintuitive. The bullet holes in the returning aircraft represented areas where a bomber could take damage and still fly well enough to return safely to base. Wald proposed that the Navy reinforce areas of the plane which had not been damaged in the returning aircraft. He realized that the fact that those surviving aircraft were not damaged in certain areas inferred that the ones which did not make it home were probably hit where the surviving aircraft weren't, and it was these areas of the plane which were most vulnerable. His suggestion did in fact improve the survivability of US bombers, and his work is often touted as a great example of the dangers of survivorship bias in statistical analysis. What does all this war stuff have to do with trading and investing? Well, there are several situations where survivorship bias can creep into our trading process and contaminate our trading strategy research and development. The most obvious form of survivorship bias in trading is on the stock market. Many traders like to develop systems to trade universes of stocks, such as the S&P 500, for example. The S&P 500 is an index of stocks which includes 500 of the largest companies whose stocks are listed on the major United States stock exchanges. The members of this index change on a quarterly basis. So for example, if you were to backtest the system on TradingView based on the current members of the S&P 500, you'd be falling victim to survivorship bias. This is because TradingView do not list any stocks which are untradeable. So by definition, they exclude the charting capabilities of any stock which did not survive until today. The danger of excluding these delisted stocks in your backtesting is that your system is going to have artificially high returns and unrealistically low drawdowns. This is because these stocks which could have resulted in major losses for the system in the past were excluded in the backtest. Survivorship bias is also rampant in financial media. The other day, my own dad came to me with an article saying something like, if you'd invested $1,000 in Tesla's IPO, you'd be a multi-millionaire today. Which might be true, but you didn't, and you ignored the hundreds of other promising stocks which you might have invested in at the time. This kind of shoulda, woulda, coulda analysis of past stocks is popular with rookie traders in financial journalism. If you knew next week's lottery ticket winners, you'd be a millionaire too. But you don't, do you? The Motley Fool publication is notorious for this sort of rubbish journalism. If you have a subscription to them, do yourself a financial service and cancel it. So anyway, what does all this mean for you as a trader? The key takeaway is to be sure you're using the right tool for the job when it comes to system development. I have a lot of traders who follow my channel. We have Forex and crypto traders, stock traders, futures and commodity traders, and so on. Each of these trading specializations have different concerns to address. For example, as I said, TradingView does not list stocks on their charting platform which no longer trade. Any companies which have gone bankrupt or merged with other companies in the past are no longer testable on that platform. So if you're backtesting a system based on a basket of stocks included in a dynamic index like the S&P 500 or NASDAQ 100 or so on, then you are much better off using a more advanced portfolio-based backtesting software like Amy Broker or Realtest or some other comparable tool. If you're interested in learning more about portfolio-based backtesting for stocks, check out my free Realtest video tutorials on my channel. They'll be linked in the podcast description. If you're trading Forex or commodities, then a platform like TradingView is probably perfectly fine for backtesting because it's not very often that a currency or a precious metal goes out of business. Likewise, if you're trading cryptocurrencies, assuming you're sticking to the major assets by market cap like Bitcoin and Ethereum and other coins which have been around since the birth of crypto, then you're probably not being affected by survivorship bias. But if you trade small cap altcoins and you're only testing your system on the currently listed coins, you are probably in for a bad experience if you ever trade that system live. This is because your backtest data does not account for the thousands of altcoins which have gone to zero over the years, which means it doesn't simulate the current coins headed to zero, which you will inevitably end up invested in at some point today. Now, if you're an intraday trader, then backtesting on TradingView using PineScript is probably fine too, as long as you test across a large sample of historical data and various market conditions and don't just stick to a single asset. Single asset systems tend to be curve fitted, so having a large sample of assets in your backtest sample can help avoid that. And delisting is not so much of an issue with intraday systems because of the granularity of the time frame and the nature of an intraday trader's selectivity. The only time survivorship bias becomes a potentially major issue for an intraday trader is if they're a one-trick pony and they only trade one system on a single stock or market or one type of market condition. The broader your intraday trading is in terms of strategies or setups and assets you trade, the less and less survivorship bias becomes a concern. Some other things to consider when going through the strategy research and development process is strategies themselves. If we only ever focus on systems which generate a profit and ignore ones which didn't, we're not going to learn the weaknesses which certain systems can exhibit. If we only ever focus on winning trades or winning systems and we never analyze our losing trades or systems which broke in the past, then we're opening the door for getting blindsided by situations we don't account for in our testing. We're also hamstringing ourselves creatively because analyzing losing trades and broken systems can often lead to discoveries in ways to improve future systems. For example, if a trading system imploded during the 2008 global financial crisis or dot-com bubble or the several crypto bubble bursts we've seen in recent years, then studying what caused its catastrophic losses or drawdown could lead to potential defenses against those weaknesses in the future. A great example of this is regime or market index filters. I employ regime filters in nearly every long-term system which either holds positions for a long period of time or trades long only. If you don't know what a regime filter is, there's a link to a video I made about them in the podcast description below. Essentially, this defensive market filter keeps my trading systems out of major bear markets and dramatically improves the profitability of certain systems which might otherwise be undesirable to trade. And the discovery of this tool's effectiveness was based on research done throughout the major bear markets in history and from analyzing what caused long-term systems to suffer their worst drawdowns. There are plenty of other examples of survivorship bias, too many to list in this episode. But here are a few that come to mind which you should be aware of and should try to avoid. Only testing during specific market conditions, for example, testing trend following systems only during trending markets or mean reversion systems during low volatility, discarding underperforming systems without first understanding why they failed, overfitting to historical winners, which makes your system less robust and resilient to future changes in market characteristics, only backtesting on the historical outperformers like FANG stocks or Tesla or gold or Bitcoin, just because they did well until today, but ignoring any similar assets which did not do well. This is a form of recency bias which is similar to survivorship bias. Assuming perfect fills with no slippage during your backtest, this will result in unrealistically high simulator returns. And a final one which comes to mind is ignoring commission drag on a system. If you don't know what that is, I have an entire video on that linked below in the podcast description. And finally, here are a few tips for avoiding survivorship bias. Always test on broad market conditions, bullish, bearish, sideways consolidation, market crashes, etc. Test on broad assets. So avoid single market systems or small baskets of assets. If you trade Forex, for example, try to test your system on all the major and minor pairs. You don't need to trade them all or expect all of them to be profitable. But if your system only works on a single currency, it's probably curve fitted and an unstable system, which is likely to fail in the near future. Always simulate real slippage and commission costs as best as possible, and always use high quality data, especially with stocks. So for example, Norgate data or others, there are other services which include historical constituents and delisted stocks. That's very important for stock traders. And the best general advice I can give is to train yourself to think outside of the box. Don't try to prove your system works, try to figure out what you might have overlooked. If you do this and your system's performance metrics are still reasonable, you're probably onto something which is pretty solid and robust. Good luck with your trading, survivors. Hey there, traders. Currently, I'm hunkering down in preparation for Tropical Cyclone Alfred to hit my island on the east coast of Australia tomorrow.
Not a lot of weakening or change happening over the next 24 to 36 hours as Alfred moves closer and closer to Queensland and New South Wales, and in particular the Brisbane area.
Alfred seems like a silly name for a catastrophic weather event, but then I'm not a meteorologist, so what do I know? I am, however, a successful trader, and preparing for this storm got me thinking about how I prepare for storms in the financial markets. Nothing I'm about to say should be considered financial advice. I'm not a financial advisor. I'm not qualified to give financial advice. This is all just personal reflections from my own experience as a trader and going through that process of starting out as a bad trader, blowing accounts, and making my way up to becoming consistently profitable. So treat what I'm about to say as ideas to go out and research, not as advice. Everyone's different. Everyone has different risk tolerance and different expectations and requirements out of their trading. So yeah, this is just my thoughts on these subjects. It's all well and good to talk about how to make money in the markets. Everyone wants to hear about that all day. But not many people take the time to learn about how to not lose money in the markets. So is it any wonder why 90% of aspiring traders fail? Not to me. So today I want to take a few minutes of your day to reflect with you about risk management and financial weather storm preparation planning, which I believe is the real secret to my success in the markets. When I began trading, I blew up my account several times and lost thousands of dollars. But nearly 10 years later, I'm still here, I'm still going strong, and I'm still growing. Last night, one of my systems had a record profitable night and made more money overnight than I lost in my first 2 years of trading. So I think I know a thing or two about making, and more importantly, losing money in the markets. And so here are some key things I think all traders, especially beginner or struggling traders, should understand and apply to their own trading to not only weather the storms in the markets, but come out thriving. Number 1, good education/mentorship. The mathematician and philosopher Alfred North Whitehead is quoted as saying, "The purpose of thinking is to let the ideas die instead of us dying." What he means by that statement is that a human's ability to think through a concept before acting on it allowed us to evolve as a species much more efficiently. It's much better to wonder what it might be like to jump out of a plane without a parachute than to actually try it to find out. In trading, we have education, which fulfills this purpose. Learning from a successful trader or mentor can help us avoid terrible ideas and having to learn from them the hard way, which can speed up our learning process immensely. By being subscribed to my mailing list and podcast, you're already on the right track on this front. But you can never have enough education in the markets, and learning from others is often much more efficient than learning the hard way. So, seek good guidance, good information, good coaches, good mentors, and good courses. If you're new to trading, this can be very difficult to discern, and I can only recommend what I've personally experienced, so here are my recommendations. If you're a new and struggling trader, check out my coding courses to learn how to properly analyze the markets. I have a free PineScript Basics course where you can get started without investing a penny. Whether you are a fully systematic or automated trader, or even a fully discretionary click trader who isn't interested in automating your trading, it doesn't matter. The benefits are still worth the investment. Learning to code even the most basic scripts will help you understand the markets better. And no matter how you prefer to trade, there are immense benefits in having the skill of building your own tools to analyze markets and alert you of specific conditions. If you're very brand new to trading, or you're one of the many aspiring traders who discover they don't have the time or passion to learn how to trade themselves, but still want to have a more active hand in managing their investments, then I suggest you check out the Chartist's Signal service. It's the only Signal service I trust and use myself to manage part of my own portfolio. It's run by Nick Raj, a fellow Australian and veteran trader who I consider a personal mentor of mine and who I've met in person several times and can confidently say he is the real deal. His Signal service actually works, unlike most out there, and the strategies are easy to implement, robust, and consistently beat all benchmarks of passive investment alternatives. I've written about this service before, so check out my email newsletter on the subject and my blog post review of the Chartist if you're curious. There'll be links below in the show notes. Nick gave me a 10% discount code for anyone who signs up to their annual subscription. Again, there'll be a link to that below. So check that out if you're interested. Now, priority number 1 is position sizing when it comes to risk management. Now, I know you've all heard this one before, but there is a reason why it's touted so often in trading culture. Risk management is without a doubt the single most important aspect of profitable trading. So I need to mention it here for the beginner and struggling traders out there who haven't mastered this yet. The quickest way to make a trading system unravel and implode is to have bad position sizing models, or in other words, risking too much per trade when you lose a trade or several trades lose in a row. This is the most common method for implosion for rookie traders, speaking from experience. So if you're new to trading, start here. When I was learning to trade and having trouble making profits, the biggest change I saw to my performance came from proper position sizing. Once I began only risking 1 to 2% of my account per trade, I stopped the bleeding. It took me several months to get profitable from there, but the first requirement for profitability is to not lose all your money. The best offense is a good defense in this particular case. These days I trade a variety of different systems and the risk management models are different for all of them. For example, in Forex, I typically risk 1% of my account balance on each trade. But in stocks, the risk is closer to 3 to 5% for some systems. But that's because these systems perform very differently in the stock market and without leverage. So there's no one-size-fits-all approach to risk management, but there is one key tenet to abide by. Do not risk more than you can comfortably lose. Not just on a single trade, but across time too. Beware of losing streaks, know your max drawdown numbers, and prepare in advance for losses. One piece of advice I have, which might be worth backtesting for your strategy, is seeing what impact reducing your position sizing relative to drawdown is. For example, if your system hits a 10% drawdown, maybe you reduce your position sizing by 25% and so on. If it hits 20%, you reduce by 50%. If it hits 30%, you reduce by 75%, etc. Change the threshold to suit your risk tolerance. This will slow the losses down at the cost of reducing the speed in which drawdowns can be recovered. But for traders who are uncomfortable with risk or new to trading, this can be an effective way to buy more time if your system goes into a particularly nasty period of losses. Now, this is not financial advice, just food for thought and something worth going out and backtesting, especially if you have a particularly volatile trading strategy. I don't personally use this technique, but I've found interesting test results with certain trading systems, and some reputable traders have used it in the past, such as the turtle traders, who systematically reduce their risk per trade for every 10% of drawdown. In any case, without first establishing good risk management, all other advice is worthless, so make sure to take it seriously. I put together a video on this subject called The Math of Winning on YouTube, and surprisingly to me, it's my best performing video with over 800,000 views as of recording this. So I highly recommend watching it if you want to better understand good risk management theory and techniques. Again, there'll be a link below in the show notes. Another useful tool in managing risk is the use of a regime filter or index filter. So for example, in the stock market, you may want to experiment with a regime filter on the universe you're trading. So for example, if you're trading the S&P 500, the 500 stocks included in that universe, then you might want to see what effect only buying stocks when the S&P 500 or SPY is trading above its 200-day moving average. So that's an objective way to gauge whether the broad market is in a bullish trend. You can filter your trades based on that regime filter. So if the market is trading below its 200-day moving average, maybe you want to tighten your stop losses if you're using a trend following sort of system. You might want to ratchet your stop loss up even tighter to lock in open profits, or you may want to close all open positions in case the market rolls over, like during the 2008 financial crisis, COVID, 2001 dot-com bubble, etc. I've done a little bit of research with applying that to crypto, so buying altcoins when Bitcoin is trading above its 200-day moving average and so on, and a little bit with currencies, so only going long on dollar pairings when the DXY is trading above a certain moving average, things like that. And there is some promise to applying them for certain trading systems. So that's worth investigating as well. I have a video on my YouTube channel somewhere about regime filters, so go and search that if you're interested. It's also worth investigating the use of various market filters on trading setups. I've found using moving average filters on trend and momentum systems to be extremely effective, not just as a regime filter, but also as a setup filter. I've also found massive improvements to a mean reversion system of mine when I tweaked the setup ranking method to be more relaxed during bullish periods and more restrictive and selective during bearish volatility. So get creative with your conditional filters. They can improve risk-adjusted returns quite significantly in some cases when employed correctly. Next up, diversify, diversify, diversify. Once you've established good risk management into your trading approach, the next best way to reduce exposure to catastrophic risk events is to diversify your trading. There are many ways to go about this, but here are a few tips. Have a diverse portfolio. If you trade Forex, make sure to trade several major and minor pairs if possible. If you trade stocks, make sure to trade a broad market universe. For example, the S&P 500, Russell 1000, the All Ordinaries here in Australia, etc. Avoid single market systems. If the system only works on gold or SPY or Bitcoin, and that's the only place it works, then it's probably curve fitted and it's probably likely to stop working imminently in the near future. Have a mix of strategies. Don't be a one-trick pony. Don't marry yourself to trend following or mean reversion. Now, you can have a favorite style of trading. There's no problem with that. And you shouldn't trade any style that you don't believe in or believe in the edge of. But you should have a mix of multiple strategy types in your portfolio. I personally trade a trend following system, a mean reversion system, a momentum system, and some very long-term investment systems. And in Forex, I'm partial to swing trading systems. I like the 4-hour time frame, 1-hour time frame, and capturing swings in the market. So you could add swing trading in there. And I actually trade multiple variations on a few of these. Trade a mix of time frames. There's no reason to be locked in on a single time frame. Lots of traders think day trading is sexy and lucrative, and it can be, but it is also much more difficult to pull off. So don't be afraid of having some end of day, end of week, or even end of month systems in your portfolio. Systems which make trading decisions at the end of these periods. These types of systems tend to be more robust, more resilient to short-term market swings, much easier to manage than day trading, and produce very reasonable profitability comparative to the workload. So some of my systems take 10 minutes a month to manage and have made me tens of thousands of dollars over the years, which is pretty good bang for your buck in terms of workload and time, if you ask me. Even if you're an aspiring day trader, there's no good reason not to have at least a few longer-term systems running in the background to diversify that risk a bit. Now, none of this is financial advice. This is just my reflections from personal experience. And finally, when it comes to diversification in trading, I recommend trading a mix of assets. So I trade stocks, Forex, crypto, commodities, or I hold bullion, gold, and I also trade ETFs. And when one sector or asset class is doing poorly, usually one of the others is making up for it, or more than making up for it. It does require quite a bit of capital to diversify across all of these aspects of your trading that I just listed. So if you're undercapitalized, then at least consider picking a few of these ideas to take to the backtesting process and research their effects on your risk-adjusted returns. There's no point diversifying if it doesn't improve your risk-adjusted returns, but I'd be very surprised if any one of these didn't, and if all of them especially didn't. And ideally, if you can do all of them, it's only beneficial to your bottom line, in my experience. And finally, good backtesting / data, or data for you Americans, or data for you Canadians. Discretionary traders may struggle with this one. It's hard to backtest a discretionary system unless it has very strict rules that allow you to analyze historical data consistently. It can be done. I've done it in the past, but it requires extreme honesty and self-awareness during the backtesting process. But even a fully discretionary trader should at least replace backtesting with forward testing, so trading the system on a demo account on live market data before putting real money at stake, and rigorous record keeping and constant analysis of their own trading data to spot patterns and potential areas for improvement, particularly on the defensive/risk management side. Now, for systematic traders, which is my specialty these days, we are blessed to have access to the highest quality market data ever available in history. So there is no good reason not to be backtesting your strategies if you know how to code. If you're a TradingView fan, then it's a no-brainer to check out my PineScript courses, particularly the Mastery course if you want to learn PineScript, and or my Indicators and Strategies course if you want to steal the source code to my best scripts. If you are a stock trader, then you might prefer my Real Test Strategies course, which is a new course I put together late last year in 2024, containing some of my personal stock systems that I trade my own money with in the markets, in the stock market. So the PineScript stuff is mainly focused on Forex and a bit of crypto. The Real Test stuff is focused on portfolio-based stock market trading. So where I hold a basket of stocks, one of my systems trades up to 20 positions at a time. So that's quite different to what's possible with PineScript. You can check all that out on my website, theartoftrading.com. The Real Test course is new and still in development, and I have a few more systems I'm actively working on, which will be added to the course when I'm satisfied with the quality, performance, and robustness of those systems. I'm also working on developing a deep dive course covering general backtesting theory and some practical tools and processes for system development, both through TradingView and Real Test. So stay subscribed to my email list and podcast to be notified of when that releases, hopefully later this year, depending how this cycle goes. Anyway, that's it for this week. Good luck in the markets. I'll speak with you in the next episode. Take care out there. Manage your risk, first and foremost. Seek good education, good mentorship, and investigate diversification methods, and make sure to have a very robust backtesting process. There are other ingredients that help with profitable trading, but those are the key ingredients in my experience that helped me become profitable. So that's where I would start if you're new to trading. Go and research those, investigate those. Not financial advice, just personal reflections from my experience over the past 10 years or so of trading. I think I'm on my 9th year trading. I've lost count. I don't really keep track of that. But it's been a long time. I've learned a lot over the years. These are the main ingredients of good trading in my experience.
Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. And yes, we're back on video once again. So if you're just listening, you might be missing out. So head over to YouTube or Spotify to check out the video versions of it. Today's episode is going to be a fun one, but also a really important one. We're going to dive into trading indicators, but not in the way that you might expect. We're not just talking theory. We're not just talking strategies that work. We're going to answer a much more interesting question, at least interesting to me, and that is, which trading indicator does the public, you guys, actually favor the most? And let me tell you how the whole thing got started, right? We were in the live trading room, as we usually are, 3 days a week, and I got asked a question from one of our Tier 1 trading members, Akil, what are your top 3 indicators, right? And if you know me, I'm not a really big indicator person. I have experience with a lot of them from just experience in the market and experience developing strategies. But as far as my personal use on the charts, I tend to keep it simple. So I was trying to think about it, and I gave about 2, but kind of brain farted on the 3rd one. Then later on, because of course the algorithm is always listening, guess what popped up on my feed? It was a question from a trader that I highly respect in this industry, Stephen Burns, asking the question openly, "Dear trader, what is your number 1 trading indicator?" And well, after combing through over 150 answers, really questioning why do I do this and what is my point here, I wanted to come out and give you the top 5 that you guys, traders, voted on. And at the very end, hopefully I don't forget, I'll double back around and actually share my opinion on what are my top 3 indicators. And don't worry, I've also finally figured out what my third choice would be, and it was actually right in front of my face the whole time, and I feel quite ashamed for forgetting it in the first place. But here's a clue. It's rather new as far as what I use in the market. And for you guys that know me, let's see if you can guess what that is. Now, before we get into listing off the indicators, just want to share my opinion on indicators in the first place, right? Understand that there's a big difference between being popular. There's a big difference between being effective. There's also a big difference between me asking the question, what is your favorite indicator, and asking the question, what is the best indicator? Now, you would never hear me ask any type of question that says, what is the best? Because my philosophy on the market, and if you ask any professional trader's philosophy on the market, aside from like the extremely egotistical ones, there is no such thing as best in trading, right? What is the best? Technical analysis or fundamental analysis? There's no answer to that. What is the best? Classic price action trading versus indicator trading? There is no answer to that. What is the best indicator? The MACD versus the CCI? There is no best. There is no best anything in trading. We can go time frames, we can go market, we can go hours of day, right? What matters in trading most is not that you find the best, it's that you find the best for you, right? When is the best time frame for you to trade? When is the best, or what is the best asset for you to trade on? And when it comes to indicator, what is the best indicator for you to use? And in my opinion, this is going back into coach mode, but this is the Trading Coach podcast. So I guess I could do that, or I guess I could suggest anyway. What I would suggest is this. You want to build your trading strategy around your personality, meaning it's around your philosophy on the market. It's around something that you value, something that you actually believe in. Once you understand how you want to attack the market, for example, do you want to be a trend continuation trader? Do you want to be a counter trend trader? Do you want to look for extensions? Do you want to look for reversals? You then want to pick an indicator that supports that. And the thing is, most indicators can be used in various ways. And when you research them, you're going to hear about the traditional way to use them, where it says like, hey, moving averages are an indicator that supports the trend, so you should only look to use them as a filter to keep you in the direction of the overall trend. That could be the case, but moving averages could also be used as counter trend methods as well. So, just understand that with whatever indicator you use it in a way that supports what you actually want to do. And at the end of the day, if you can do that, you're going to be able to find the indicator that is the best for you. Now, into the top 5. I guess before we go into the top 5, there were a lot of answers. Again, 150 plus comments, right? The coffee was strong to stay awake. I want to go through a few that were actually left out. So let's talk about the top 3 that didn't make the cut. So number 1 that was left out, I guess not number 1, but it would be number 8. So anyway, the first one we're going to talk about that was left out was Bollinger Bands. This was interesting. We've been having a lot of discussions on Bollinger Bands on the platform lately. We did a private Q&A session on Monday talking about them, and Bollinger Bands are a great example of how a single indicator could be used in many different ways. You could look for price action to hit the extremes of the bands and break and close outside of them, and that could be a counter trend trading sign where you expect a reversion to the mean, so you expect price to come back in within the bands. You can use it as a trend continuation way as well, where if price breaks back down to the moving average in the middle, that could be your entry reason to play price to a retouch of that band. You could be a breakout trader with Bollinger Bands as well, where if we break above or below the band, you then buy expecting high volatility and continued move to the upside. So not to get too deep in there, I promise I won't do this with every single indicator, but it's fresh on the mind. But Bollinger Bands is one that was left off. Another one that was left off was volume, right? And volume in different ways. There is your anchored volume profile. There's your traditional under the chart volume. But volume was another one that almost made the cut, just missed by like a single vote, but didn't quite get there. And then this is the most surprising of them all, because traditionally, and I'm old now in the trading game, so maybe traditional doesn't mean anything anymore, but traditionally this indicator was always known as the most popular indicator. I've never actually used it in a serious way. I've played around with it and used it to answer questions for the traders I work with, but I never actually used it in my trading. But this one would be the MACD. The MACD was right below the top 5, did not make it. Sorry, MACD, you have fallen. Sorry for you guys. I'm going to be unprofessional and get a swig of water real quick because my voice is hurting. All right, now into the top 5. And understand that some of these aren't going to be technically classified as indicators. So before you get all in the comment section and the mentions and stuff like that, I'm just taking what the people voted on. There were some other ones as well that were kind of way off. Like someone said, a bunch of people said my eyes, which I would agree. Your eyes are probably one of the best indicators, but I don't think that should count in this category just because it's a little bit of a reach. So number 5 is going to be Fibonacci, which is surprising. I am a fan of Fibonacci. They are not the backbone of my trading, but being a harmonic pattern trader, they are very important to me. And for the longest time, I got laughed at for being someone that used Fibonacci. Akil, it's black magic, it's voodoo. The markets don't actually respond to it. But if you ever take some time to deep dive into Fibonacci, and if you are going to do that, I highly suggest that you actually take time. Like you may want to just clear your schedule for the weekend because you're going to go down all types of rabbit holes and literally figure out why rabbits produce or reproduce in the way that they do. That is Fibonacci. See, it's starting already. But you're going to find out some weird stuff about Fibonacci. You're going to start measuring your elbow to your wrist and your wrist to your finger, and you're going to start seeing 618 Fibonacci retracements and 382s, and look at that weird picture where the guy is like that. It's going to take you some places. But no matter what we think about Fibonacci, we can't deny that this magical sequence of numbers not only exists in real life, right, in our everyday life, but because it exists in our everyday life, it also exists in the market, right? If it exists to us as normal humans and the market is just a visual representation of all of the actions that normal humans and bots that are programmed by normal humans are taking, then it does make sense that it would all kind of flow together. Now, there was no specific mention of what Fibonacci the traders were using, but I would assume the basic Fibonacci tools, your Fibonacci retracement tool, which is a tool that is used to predict the retracement level. So after price comes from an extension, it creates a pullback, a retracement, and these are numbers that are used to predict how deep that retracement will be. And then there's the Fibonacci extension tool, which is the exact opposite. You use that to predict where the next wave, where the next trending move will extend to before it starts to run out of steam. So I'm happy this made the cut. I'm a Fibonacci user. Did not expect this at all to be in there, but look at that. We're at number 5. Mama, we made it. Number 4 is also one that I use. This is going to be the RSI, the Relative Strength Index, right? The RSI is not the reversal strategy indicator, which is something that I thought when I was a new trader, even though it's commonly used as a tool of identifying when the market is in an overbought and oversold condition. The RSI is a momentum indicator. It tells you when there is a lot of momentum or strength in the market. It tells you when that strength is getting weaker and weaker. There are many ways you can use the RSI, and there's a book that I always tell you should never read, and some of you read it anyway, and I can't find it. Oh, this one right here. It's Dusty, The Complete Guide. I hope you guys can see it. RSI, The Complete Guide by John Hayden. If you ever want to look for alternative ways to use the RSI, there are many ways that will melt your brain in there. Do not recommend that to newer traders at all. That's why it never gets mentioned whenever I do podcasts about my top whatever book recommendations. Do not read it. But it's a great example of showing you how it can be used in different ways. It can be used to find reversals or loss of momentum using overbought or oversold. It could be used to find kind of exhaustion points in the market by using divergences. It could be used to find continuation opportunities in the trend by using hidden divergences, right? Shoot, it could even be used to define the trend. Seriously, I've worked with a trader, brilliant mind, David Alcindor, who used the RSI to determine the trend in price action before even looking at the price chart. And that was a method that John Hayden mentioned in his book. Now, one of you guys in the comments section, Chris, did mention that, and I work with a Chris, and I'm curious if it's the same person. If not, it's really cool because a lot of people don't know that method, but you can play different, you can play the bounces between the different levels, and it can actually tell you if the market is bullish or bearish. So many different ways to use the RSI, which is really cool. So I'm glad it made it into the top 5. Number 3, this is one that I agree with 100%, but I don't really think it should fall into this list, but I included it in this list because as a bigger teaching perspective, I think it's important to understand how popular this is and how more traders believe this than you would think. But price action. Now, price action isn't an indicator. It's not something that you go to your indicator tab on and throw into your chart, but it is an indicator as far as it indicates your buying and selling behaviors in the market. Maybe it's a stretch there, but I included it because I was so happy to see that in a world where everyone is looking for the shortcut in an indicator. I don't know why I did 3 and 2 here. In a world where everyone is looking for the shortcut in the indicator, which isn't actually a shortcut because finding the optimal way to use an indicator is very, very difficult and time consuming and frustrating, and it will make you pull out your hair, right? Yeah, you can see. But price action is still key, and it was cool to understand that most people understand that indicators are lagging. All indicators are lagging, right? If you have one that's not lagging, you can let me know, or you can type nothing below because there is none, meaning that your indicator is based off what happens with price, right? Even price is technically lagging because your candlestick chart doesn't print until orders have come in. But again, not down that rabbit hole. But I do think you should value price, and I do think your indicator should support what price action is doing. That doesn't mean that you can't have a fully indicator-based strategy. You certainly can, but you just need to have the understanding that your indicator is confirming something that you see on the price chart, right? Versus the other way around. Number 2, and I'm going to combine this a little bit. This is going to be either VWAP or anchored VWAP. I'll just throw it all in the VWAP category. And this is a new one for me. VWAP, if I remember correctly, volume weighted average price. There we go, volume weighted average price for VWAP. And essentially what it does is it gives you kind of, it's similar to a moving average, but not like a moving average. It gives you an average price based on not just price, but also volume as well. And I believe traditionally it was mainly used for like just intraday trading, meaning it would give you like the range of the day or the session, and that's what the VWAP would print off of. But as it evolves, and I think anchored VWAP is this way as well, you can actually choose the individual session. So, you know, where a moving average will start at the forever of time, you could actually set the VWAP to measure a very specific portion of price. Again, I'm not an expert on this, but I am somewhat familiar with it. I read a book 2 years ago by Brian Shannon, my colorful book series, Maximum Trading Gains with Anchored VWAP, the perfect combination of price, time, and volume. So if you do want more on the anchored VWAP, make sure you check this bad boy out. It's become a very, very, very popular indicator, at least from what I've heard on the streets, over the last 3 years specifically. Not that it hasn't been popular within kind of the trading realm for a very long time, but as far as like the public grasping it, it's picked up a lot of steam. So no surprise that it's number 2. And number 1, drum roll. Brrr, you probably know what it is because I left it out. What does everyone like to have on their charts? Moving averages. Moving averages are number 1. Now, not going to spend a whole time on moving averages. I just did a video a couple months ago called, I think, 3 simple ways to use moving averages. Give me a second. I had it up at some point. It's called Moving Averages Explained Simply. What is the best setting? And I think we talk about different ways to use moving averages. I apologize if we don't, but I'll link that video at the end of this podcast. You can check that out. But moving averages can be used in many different ways. There are many different versions and variations of moving averages, but the most popular reason that traders use moving averages is to confirm the trend, right? Meaning that if you have a single moving average, if price is above that moving average, it is in a bullish trend. If it is below that moving average, it is in a bearish trend. If you have double moving averages, you can look for them being spaced out to give you a sign of a strong trend, them being skinny to give you a sign of a weaker trend. If they're crossing, I don't know how to do it with my hands, crossing back and forth a lot, you're in consolidation. If one crosses the other, the small crosses the big, that could be a sign of reversal in trend as well. So lots of different ways to use moving averages. No surprise, that is number one. Now, what you've been waiting for, my top three, and I didn't think about what order I want to put them in, but I suppose I should give you an order of my favorite indicator, and understand these are personally based off my trading and what I used. One that I was surprised, I guess it was on there, didn't receive a lot of votes. Do I want to put that 2 or 3? No, okay, so number 3, volume, specifically horizontal volume or anchored volume profile. This was a tool that I learned about in another book I'm going to share with you somewhere. Haha! There we go. I should really figure out where I put these things. In a book I want to share with you called A Complete Guide to Volume Price Analysis by Anna Cooling. Really good book, not just, it's very simple to read. Very good book on explaining both your traditional volume and your anchored volume profile. And also, this is a really good book if you want to understand the secret price action behind price action, how big banks and institutional traders do moves to bait traders into doing their own moves so that they can take advantage of those traders and profit while you suffer. Great book for that. But I forgot what I was going to say about volume now. Yeah, volume is new to me. It was something that I hated at the very beginning of my trading career, and I looked back into it probably about 5 years ago now. I have no idea what year it is, but probably I think either right after COVID, I think it was. And I had a new opinion on it, and I was open, and I learned something, and I had no intentions of using the anchored volume profile. That was just kind of like a bonus in the book that I was like, oh, this is cool. But I actually fell in love with it, did a year of study with it, and now it is something I use in a regular basis in my trading. So because it's the newest, and it's I need it the least, meaning I think I can do just as good of a job. I know I can do just as good a job as I was trading without it for so long. Without it, and then I can with it, but it gives me a little bit of extra comfort and does allow me to do kind of small little changes that are just increase my edge by a little bit. So that's going to be number 3. Number 2 is going to be, this is tough, the RSI. I'm a fan of the RSI. Sorry about that, talking to traders in the background. I told you I'm an RSI nerd. We already went over the millions of ways to trade it. It is the one indicator that you really see on my chart if you ever see any of my videos. And then number 1 is going to be the ATR, the average true range, which is a volatility indicator. Now, this is interesting. You won't actually see the ATR on my chart because I don't use it as a chart-based indicator. It doesn't need to be there aside from making my chart look pretty. But the average true range is something that I use in every single one of my trades because I use it to project my stop loss. And we spoke about risk management. We spoke about how important having a stop loss is. Yeah, that's very important. Now, technically, I can probably calculate the average true range without having the indicator. So if you force me to get rid of an indicator, maybe that would be the first one, but that would take a lot of time. It'd be very frustrating, a lot of math. I might have to hire someone to do it, which is going to cost me money. So it's much easier for me to just have it on the chart. Now, I shared with you the public's top 5 indicators. I shared with you my top 3 indicators. Here's what I want for you. I want you to share with me your number 1 indicator. You can only choose one. Don't list a bunch of them. Let me know what your number 1 indicator is and what you use it for, and I look forward to reading through these comments. So I hope you guys enjoyed the podcast. Hey, if you ever want a free trading computer builders or buyers guide, click the link or scan the QR code, whatever I'm showing you at the time. It's an awesome guide. It's free. I keep sharing it with you because I've used it and it's personally benefited me as someone who knows nothing about computers. So seeing how there are other people that probably don't know anything about computers, it should benefit you as well. And it's free, so check it out. All right, until next time, plan your trade, trade your plan. Take care. What if I told you the reason you're not making money in trading has nothing to do with your strategy and everything to do with how long you can stay uncomfortable? Hey guys, Akil Stokes here, and welcome back to another episode of the Trading Coach Podcast. Another video episode, so check out the video version on Spotify or on YouTube. We are going to hop into the charts for a little bit, so the visual experience is going to be a little bit better, but I'll do my best to keep the audio audience engaged as well. Today's episode is going to be a follow-up on the previous Trading Coach Podcast episode that we did on active trade management, where we talked to you about 3 ways to trail a stop loss. So if you haven't seen that already, make sure you put that on the to-do list right after you're done this. And in this follow-up, we're going to shift the focus a little bit and talk about something that really doesn't get discussed much in trading, and even me myself has done a poor job of discussing this with you guys. But we're going to talk about how to build your emotional endurance. And it's fitting that I'm wearing my cross-country shirt as I record this, because cross-country athletes, runners, well, we work with them on building their endurance as well, just in a different way, but kind of the same way. Because if you ever ran, you have to deal with massive amounts of pain and negative thoughts for a very, very long time. And usually it's mind over matter. So maybe it's actually more similar than I think. Anyway, this ability plays a crucial role in your active trade management, and honestly in any type of trading in general. And I would even dare to say that this is probably the difference between those who can become and remain successful versus those who struggle or maybe become successful for a little bit before giving it all back to the markets. Now, the idea came to mind from a question that I recently got from a trader on our Tier 1 trading platform. By the way, shameless plug, if you ever want to learn to trade with us, www.tier1trading.com. Come in, check us out, live sessions, chat with traders, chat with myself and Jason. It's a great experience. I don't need to sell you any more than that. Just get on the platform and you'll see what we're about. But I'll put the question up on the screen so you guys can see it. But to sum it up, our trader was essentially asking a question about active trade management and saying, hey, how about instead of having a set target 1 or even a set target 2, I simply just trail my stops below price action until I'm eventually taken out. Does this seem too good to be true? Is this something I should try out? Is this something that I'm completely wrong against? And to answer that question, I would say this. Well, first and foremost, you should test every idea that you ever have. That is going to give you the ultimate answer, right? I can tell you something, Jason can tell you something, the greatest trader on the internet can tell you something, your mind can tell you something, but none of that is going to be as important as having the numbers in front of you. So at the end of the day, regardless of what I say, if you have this question, the only true way to build that belief is to test it, look at the numbers, and have them give you the answer. What I can tell you is this. From personal experience, and this is talking from a trader's perspective, so not a long-term investor who's just like buying and holding, someone who's more active in the market, you're probably going to be more profitable if you have some sort of an end game, meaning that usually what happens is when you try to trail forever, you end up losing more money than you would make if you just had a set target in mind. And we have to understand as traders that our goal isn't to get every little bit out of the move. We're not going to get involved at the very bottom and get out at the very top. Rather, we are mercenaries. We are jewel thieves, right? Our job is to come in and take what we came to get and get out before we get got. And we'll head over to the charts for an example of that. So looking at the chart in front of you, we're just going to give a very simple example of a trader that is trading a trending opportunity, and let's just say they're trailing at structure. So we're going to take a look at this move right here. We were brilliant, and let's say we got involved right here. Price action came up, bada boom, bada bing. We retraced and we got involved in the pullback. So I'll give some numbers just so the audio only audience can hear us. We got involved right here. Let's just call it 134.27. Now, we spoke in the previous podcast about a trail stop method that is going to follow price action. So every time price creates a new structure high, we trail our stops behind the previous retracement. So initially, let's say our stop loss is right here below our entry point, the consolidation point of our entry. As price action makes its way up, and as we create a new structure high, we are going to roll that stop below that new structure high, or that outside return, by blank amount of pips. And as the market keeps doing that, right, we keep rolling it up. So a new outside return is created, our stops roll up. A new outside return is created, our stops roll up. So our initial entry was at 134.27. Currently, I rolled my stops up to about 136.50. I'll do some quick math by stealing the ruler. We are trailing our stops at 225 pips in the profit. Now, I know that seems grand, but as this trade goes on, price action continues to go up all the way to about 138.66, right? So you can see that price action went from... What if I told you the reason you're not... What if I told you the reason... Hey guys, Akil Stokes here. Well,
Hey there, traders. Currently, I'm hunkering down in preparation for
See.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What is going on, team? I hope all is well with you. Thanks so much for being here. For this episode, the trader who I had the great opportunity to speak with and who you're about to hear from is Adrian, or at AddyF69 on Twitter. Going back in time, Adrian was a professional sailor for almost 2 decades, but for the past 6 years, he's been on dry land, taking an income from financial markets as an independent day trader. Adrian primarily trades the Bund and the DAX, though he initially started out in foreign exchange. His trading strategy is influenced by support and resistance areas, volume profiling, order flow, and stats. After talking about how Adrian survived storms at sea, torturous sleeping patterns, and run-ins with pirates, we spend a fair amount of time discussing how Adrian actually uses stats and some things to watch out for and why it pays to be process-driven. Please enjoy this episode, guys. I'm Aaron Fifield, your host, and here is my guest, Adrian.
Hi, Aaron. How are you?
Adrian, I'm good, man. What's up?
Not much. Been just trading today.
Yeah, cool.
So you had a bit of a storm last night?
Yeah, man, it got pretty wild. Did you see the photo I posted on Twitter?
Yeah, I did. Yeah, was that a tree branch that come from the window?
Yeah, from across the road. The whole sort of top of a tree blew off and flew across the road. Branch came straight through the window, and the road was like blocked, obviously because the tree was across it. The roof next door on our neighbour's house has like a 3 by 2 metre hole blown in the side of it. What else? The guttering along the front of our house blew off. The fence in the backyard is on a total lean. It's only been held up because there's a couple trees behind it. Yeah, it's a bit of a mess. So
yeah.
we had
busy days trying to sort that out.
Yeah, we're gonna have to obviously get on the phone to insurance and a lot of cleanup. Oh, there's so much shit in the pool, including part of the neighbour's roof next door. We've got to try and dig that out, so that's going to be fun. And it's a bit too cold to jump in there and grab it at this stage. Summer's not quite here yet.
Yeah.
But no, it's all good. It's all good. How's your weekend?
Yeah, good. Just spent some time with the missus. Done my usual weekly review and trade and analyse and all the work around that side. So quite busy.
Very good.
but my missus works away from home during the week, so I'm home alone. So I try and spend a bit of time with her at the weekends. Otherwise, we both just end up working all the time.
Yeah, absolutely. And you got to have that balance. So before we talk trading, I'm actually really interested to hear a bit about life before all of this. You were a pro sailor, is that right?
Yeah, I was a professional sailor for 17, 18 years. Sailing, I sailed around the world, lived in America, Caribbean and France. So I had quite an interesting life doing that. And sailing's always been a bit of a passion for me. But it got to the stage where I was reaching, my early 40s, and there's a lot of travelling and living out of hotels involved with pro sailing. And it was kind of, what do old sailors do? And I was getting a bit bored with the travelling and, out of hotels. And I wasn't doing that much sailing anymore. I was managing projects and refits and stuff like that. So I decided I was going to leave it, leave sailing before I got too old and try and make another career. So I left that. I did some project work for a friend of mine who ran a currency exchange and doing deliverable currency. And I was managing the new build of his website and his database and stuff. And that's what got me interested in trading, because they were obviously using charts and stuff for the Forex market. And that's how I got into trading. Started doing trading part-time on the side while I was doing other projects. And then decided a couple of years into it that I wouldn't mind having a go at making that a career. It interested me a lot. Had a lot of similarities on the outside to I used to do a lot of weather routing and analysing the weather in my pro sailing career. And on the surface, it seemed to be very similar to doing stuff like that. And that side's always interested me, and process and stats and stuff, even though at the time I wasn't particularly good at stats. And whilst I thought I understood them, my understanding wasn't as good as I thought it was.
Yeah, okay. I mean, the stats in particular is something I'm very keen to ask you about. So we're going to really get into that in a moment. During your sailing career, what were some of the competitions that you participated in?
I did the Fast Start race 7 times, did the Newport Bermuda, done Cork Week twice, Cows Week 9 times. I did the Clipper Around the World race. We used to have series called the Walk races, which are offshore races basically around the English Channel. I did so many of them, I can't even remember the number of them. So I used to compete a lot around the Cairns and offshore.
Full on, okay. And do you have any stories from like being out at sea and any like wild weather and huge waves, anything like that you sort of came up against?
Yeah, I mean, I've been out in storms, in Bay of Biscay where other boats have sank. I've been one of the first trips. It was my 3rd transatlantic, and back then in the late 80s, early 90s, that most small yachts didn't have GPS. You couldn't afford GPS on small yachts. So we were still doing transatlantics at the time, using sextants, astronavigating by the sun and the moon and the stars. And we were doing a delivery, taking a tow from France to the Caribbean, and we was hit by a storm about 600-700 miles off France, and it was so windy that at one stage the sea went from being humongous waves about the size of the boat, 40 to 50 foot size waves, to in the peak of it that actually the sea leveled out and was complete foam. But the boat was leaning over about 50 degrees, just permanent hill with no sails up. We had taken the sails down because it was just too windy for the sails. And at times like that, there's a saying which is, I think, stolen from World War One, but there's no atheists in a small boat at sea in a storm.
Yeah, I can imagine. I mean, what do you do in times like that? Do you just sort of sit still and hope for the best? Or, I mean, is there anything you can do?
There is stuff you can do, but you do very much understand after you've spent a certain amount at sea that you are very much in behold of Mother Nature at times. So there's stuff you can do, but if the sea wants to take you, the sea's going to take you. I mean, one of the worst things I ever saw was coming across mid-Atlantic, a bunch of life jackets, an old-fashioned cork-filled life jackets all tied together into a raft. And they've been out there for a while and they're all stained and everything. And so obviously somebody tried to use that as a raft. And back then we had no ways of communicating with shore. So that was before sat phones were small enough to take on small boats of like 30 to 40 foot size. So we couldn't report it. Reported it once we got to the Caribbean side, and it had a ship's number on it, and it had been a fishing boat that sank about 6 weeks, and they never recovered anyone. He just disappeared. So we had come across the last place where obviously the survivors had tried to make, how many of them we don't know, tried to make a raft and had a guide there. It's quite unnerving when you're like 2,000 miles from the nearest piece of land. But it does make you realise what the human body or the human being is capable of in them conditions when you get to situations where you're so tired or hungry or dehydrated that actually you can keep going and do stuff, and you see people that you never thought would, in a moment of crisis, stand up, and people you thought would be strong in moments of crisis crumble.
Yeah. No, that's really interesting to hear about. I mean, I don't know if this might be a bit of a silly question, but you know, during your sailing career, was there ever a risk of pirates out there, you know, in the seas?
In certain areas, yeah, we sailed through the South China Sea, and there's pirates. So they're not what people imagine to be. They're basically, they were basically fishermen that could see a expensive boat sailing along in a race and were opportunists. So they will try and come alongside, or they'll go right in front of us and drop their nets like 20, 30 meters just in front of us, hoping we'd run into them. So they were opportunist pirates. So they weren't going around especially looking to pirate. Their main thing was fishing. But if they saw opportunity to take advantage of unarmed or undefended Westerners, then they would take the opportunity.
Okay, so did you have run-ins personally like this?
Yeah, they was trying to be boarded, and they tried to get alongside us a few times.
Yeah, was there ever a time when they did come on board?
No.
Okay.
I always, on that trip down there, I spent 9 days at sea. I slept every 2 hours for 20 to 30 minutes, and that's what was my routine because of the risk of pirates and that sort of stuff. So I was constantly going up on deck. So I spent 9 days doing that. I never slept more than 40 minutes in that 9 days.
That's crazy. What happens to your mind when you're sleeping with that sort of pattern?
It's not particularly good for focus or making good decisions. You operate at a very base level. You're constantly tired. At one stage, I got so tired I was hallucinating. So that when I had a 40-minute sleep. But you learn a lot about how to get away with shorter sleeps. So whilst that wasn't particularly good, I learned lessons about how to manage my sleep in the future. So I've done a 20-day trip where every 4 hours I slept for only 1 hour. So I never got into REM sleep. So I never woke up. I woke up feeling tired, but I never woke up out of it. That was a much better routine, and I could maintain that for like 20 days. But sleeping 20 to 30 minutes every 2 hours was crap. You make a lot of bad decisions.
Wow. Yeah, I imagine that'd be really tough going. I mean, why were you doing this? Were these solo trips? Like, was there no one else on board with you for this?
No, it was a fully crewed race, but it was an amateur race. So I was the only professional on board, and I had amateur crew with me. And so you're responsible for them. And during that South China trip, it was pretty windy. So that made the conditions quite dangerous. And with the amount of fishing boats around, some of them were opportunist pirates and some of them were just fishing boats. But yeah, with all the nets and the fishing boats, which don't always have proper lights on, so you can't see them, you just had to be on the ball all the time.
Yeah. Okay, full on. All right, so let's talk a little bit about trading.
Yeah.
Talk to us about how you went from being a sailor to actually becoming a trader. You mentioned that you were doing some sort of project work with someone who ran a currency exchange. Would you mind elaborating on that a little bit?
Yeah, he was a currency dealer. So in UK, there's various currency dealers that if you want to exchange money via the bank, they charge you quite a large percentage, or they used to charge quite a large percentage. So various companies set up as intermediates between banks and the public, so you could exchange money with these companies, and you get a better exchange rate than doing it with the bank, because basically this currency firm would put everyone's currency trades together and get a better deal on the exchange rate. So you could get, like, at the time, the banks used to charge about 4% to change your money, and these currency houses were offering between 1% and 2%. So you could save 2% on the exchange rate. So it's really aimed for people that are transferring 2,000 euros, pounds, or dollars and above. That's because they made savings on that. So it was a friend of mine, and I went there to oversee the project management of build these databases, his websites.
Okay, excellent. And so how did you go once you kind of made the decision that this was something that interested you and you wanted to pursue it further? Like, what happened from there, and how did you go once you started to get into trading a little bit more?
I think I followed the path of a lot of retail traders, as in buying a system off the internet and paying for poor quality courses, basically because I didn't really have enough knowledge to understand what I was looking at, whether I could if it was good value for money, and sucked in a bit by the sales pitch of that. All you needed was a system and you'll be rich. I soon realised after about a year that wasn't really going to be the case. I then started looking for a system and trying to get myself organised rather than just a get rich quick scheme. So that was how I started, and I made all the mistakes that a lot of retail traders make mistakes, because a lot of the times people just really haven't got the information to make good decisions, and I was looking for shortcuts. But after trading for 6 odd years, about 2 to 3 years in, and realising the shortcuts I was looking for, trading systems, setups, and edge actually are the wrong shortcuts that I should have been looking for, and I think which most beginners shouldn't be looking for.
Okay, so would you mind elaborating on that point, maybe a little bit more about some of the shortcuts that you think we should be focusing on, if we should be focusing on shortcuts at all?
The average retail trader that I've met and myself, are looking for setups and systems to start with, because they think that's the best path to follow to profitability. But in the first 2 years, straight 3 years, and really, I was nearly profitable before I actually realised this, that out of all the profitable traders I met, whether prop firms, ex-retail, they all traded different systems or different setups. And it suddenly occurred to me that the common link between all the profitable traders wasn't that they were trading just one way, they were trading a variety of systems. Actually, the common link between profitable traders is actually not their edge, is the way they approach the whole business of trading. So they knew how to evaluate an edge, how to they understood probability, how to review, how to change the systems, and how to process stuff. So the thing in common was just how they approached the business. So if I was decided then, the best way to replicate and to turn profitable was not actually just purely focus on finding a profitable system, was to replicate the work ethic and the principles of all the rest of the side of the profitable traders, i.e. process, how to evaluate a trading system, because we buy these trading systems off the internet, or you follow someone, and most of the time we don't know how to honestly evaluate whether they actually had a trading system has an edge.
Okay, and when you came into trading, when you first kind of got started, Were you doing this, did you sort of jump into trading full time, or was this something that was sort of a side hustle while you were continuing to do this contracting work?
To start with, it was just a side hustle. I was doing it part-time in the evenings. And one thing about myself, I know that I'm not particularly good at focusing on two different projects at the same time. So that I found that either I was focusing on trading and my project work was suffering, or I was focusing on the project work and the trading was suffering. So after about a couple of years, I wasn't really making much progress. So I decided that if I was going to make a go of trading, then I would have to stop doing the project work and focus on the trading, which then meant that I'd sit down with the wife, we had to sort out our finances, and basically she was going to have to support me until we got profitable. And we'd have to make fairly drastic cutbacks in our lifestyle to support that. So that was a decision we made as I went full time. And then it took me about probably 18 months after that to get profitable on Forex, but I was trading the daily time frames. And I found whilst I was profitable on that, I couldn't really make a living because I was undercapitalized. So after about a year of trading Forex, I decided I was going to move to futures really to get more opportunities. And then once I moved to the futures market, I realized that whilst my system, I was trading the same system, had edged the market, that the rest of my decision making or how I approached the trading wasn't robust enough on the lower time frames. On the daily time frame, I would have hours to make a decision and watch the markets, but then when I was going down to the 5-minute time frame, you might only have a minute to make the same decision. And I soon realised that my whole process and decision making approach wasn't robust enough for that time frame. So I was a lot more inconsistent, made a lot more discretionary errors, and it took me a while to get to grips with that and to get on top of that.
Okay, so I'd just like to back up a little bit to when you sat down with your wife and you had that discussion about when you were going to step into trading full time, and at this point you weren't profitable. I mean, what did that discussion sort of go like? What were some of the things you talked about? Did you have sort of, in a sense, goals that you wanted to hit profitability within 12 months? If you didn't do that, you were going to, pack it in and go back to work. I mean, was there anything like that? Did you set any kind of milestones that you wanted to hit right at the beginning there?
We had one milestone that if I lost 50% of our money, then we would reassess whether this was a viable option for me, and that was it. We both just had a belief that, one thing my wife knows about me and myself is that I have a tendency that, if I approach something, either they'll do it or they'll go in the back garden still trying to do it. So if I say I'm going to do something, then I will do it sooner or later.
Yeah. I mean, you must have been pretty confident in yourself that you were going to be able to do this. I mean, it's quite a big decision to actually jump into trading full time, especially at a point where you're not profitable, I think. So, I mean, props to you. It's obviously worked out well. Yeah,
it is a difficult decision, but at the end of the day, that I left the career in the city to go sailing, which was unpaid at the time, when I was working as a management trainee for a big shipping firm, and all my friends and family thought I was nuts for doing that. So thinking I'm going to fail or it's going to turn out, it's never been a problem for me, because I think that I'm always going to. The worst thing someone can tell me is I can't do it.
And I think, often people are kind of scared to take a risk like that. I'm not saying you should just go out there and quit your job, to whoever's listening to this right now, and just jump into trading full time. But often people are actually already living out their worst case scenario. People are always scared about if they take this risk and they jump into something, what if that fails and what if it doesn't work out? And even if it does fail and it doesn't work out, the likely scenario is they're going to go back to what they're doing right now. So in most cases, many people are already living out their worst case scenario. But, just moving on from this, during that kind of that 12 months, 18 months, how did you deal with information overload? Did you feel as though there was an overload of information? And, how did you do your best to avoid going down dead ends?
To be honest, to start with, you have no real way of avoiding the dead ends because you're so inexperienced in the market, or I was so inexperienced in the market. You have to go down a certain amount of dead ends to realise they're dead ends. And as you go down the dead ends, you start to recognise dead ends, so you get the experience not to go down them. So one of the mantras that, and I've got this from FT and a few others, that I just learned to accept that what I've done in the past or what I've done up to now, I can't change. It's what I now do from now onwards because, there's plenty of dead ends in this business and some you just can't avoid. Some you can by focusing on I call them shortcuts, but focusing on the right areas so you can evaluate edges or evaluate the information out there. But as a retail trader, you need to just focus on one thing at a time because there's so much information and so many areas to do well in. You need to just split them up and take it in small steps.
So would you say that there was any kind of definitive turning point in your trading career?
My definitive trading point was because I used to do a lot of racing, used to do a lot of tracking and performance analysis. So as soon as I started trading, I started tracking my trades, and I wasn't profitable when I was tracking them. And then it suddenly occurred to me that if I wasn't consistently following my rules, so my own process or making loads of errors, and actually the trades I was taking were slightly random or random trades. So all the stats I was doing on my random trades were random stats. So while I was trying to analyze and review them, I was just reviewing a bunch of random stats. So the value from these stats was virtually zero. So I stopped tracking everything and went back to tracking just my consistency and errors, because I went through when I thought about that and realized, well, if I'm not consistent, then I'm just tracking random. So I went back and looked at like the last, I can't remember how many it was, like 50, 60 trades, and like 50% of them had errors in it. And then I, looking at them old trades, once I removed all the errors, I went from a losing trader to actually a slightly profitable trader just by removing the errors. And that's not even approaching looking at the consistency side. So what I did was then just start tracking errors and my consistency in following my rules. And by working on that side, that turned me from a unprofitable trader to a break-even trader to a slightly profitable trader. Just by focusing on them areas, that's without trying to optimize my system or work on the system. So that was a key turning point for me.
Right. And what were some of the errors that you noticed you were doing most regularly?
Not taking trades that are in my system, taking trades that wasn't in my system, being early, so a lack of impatience. So I've got an area where I set up, but I enter early before my checklist was complete. Missing the entry and then entering late. Breaking my trade management rules. Putting the wrong targets in, wrong stops, made all them sorts of errors. Some more than others, and the first couple were the majority, so that was really an order of how often they occurred to me.
Okay. I like the point you bring up there about how, you were tracking your trades, you were doing the right thing, but, the trades you were tracking were trades that were outside of your strategy that you should have been trading. So you were essentially tracking randomness. I think that's a really interesting point, and I'm glad you brought that up. Talk to us about how you're trading these days. Give us the rundown on your approach to markets now. I mean, is it any different from when you first got started?
Yeah, completely different. I can't even remember the system I traded when I first started, but I trade supply and demand, which was originally, I learned that from a course from OTA by Sam Seiden, and the way they teach it is freely available on the internet. But what I've done is altered that to to sort myself by using volume profile. So I use sort of supply and demand to find areas where I think there's trap traders or traders wanting to get out and in, and then use that to take my trades off.
Okay, and what markets are you trading?
Trading in the Bund is my primary market. I was trading Euro stocks, but I've swapped Euro stocks and I'm experimenting with the DAX at the moment as a secondary market.
Right, and you're trading intraday?
Intraday, yeah. So my big picture is 60 minutes. My medium picture is 15 minutes, and I trade off the 3-minute chart.
Okay, and if I understand correctly, I think you mentioned this a little earlier. You started out as more of a swing trader or maybe a multi-day trader, but you've since gone to the intraday time frame. I mean, what sparked that change?
The spark that change was the fact that it would take me, compounding my account, it would take me over 10 years to actually earn the same sort of money that I was earning while sailing. So my wife would have to support me for 10 years, and I would then only then through compounding, because I didn't have loads of capital, and I was very careful with the capital I had. Obviously, sailing is a lot better paid now, so funny enough since I've left. But at the time, sailing wasn't particularly well paid, so I didn't have loads of capital, and that was the main reason to change from trading the daily to the intraday, was to maximise the number of opportunities, and whilst trading the same amount of risk relatively on the intraday, it just had more opportunities. That's more opportunities to compound my account.
Okay. Yeah, I can see how that makes sense. And now the markets you mentioned there that you trade, out of all the markets available to you, why do you trade these select few markets? Is there any reason?
Yes, there is. When I was trading Forex, I was looking to move to intraday, and I was starting to experiment on Forex markets intraday. I went to a party, and one of the crew I used to sail with worked for, I can't remember what bank, but she worked for a bank. And there was a couple of prop traders at this party. Didn't know each other, worked for two different firms. I can't remember what firms they were, because it was quite a few years ago. I was talking to them about trading, and none of them traded Forex. And no one in their firm traded Forex. They traded the odd currency market on the futures, but they were, secondary trades at best. And everyone was trading, either the ES or the Bund or the Euro stocks or the DAX. And I thought, well, everyone in retail was trading Forex, and it seems all the pros are trading completely different markets. And then through Tom Dante was talking about his experiences at Prop, and it was basically the same thing, that no one was trading Forex as a primary market. And I think he said one person was trading Forex as a primary market, and there was the least profitable person at the firm. And I thought, well, there must be something in that retail are trading Forex and the pros are trading different markets. So if I wanted to be a pro, I should be trading the same markets as the pros trade.
Okay, so why do you think that is, that less of the quote-unquote professionals trade Forex compared to other futures?
To be honest, I'm not too sure. I mean, I wasn't having much success on the lower time frames in Forex. To be honest, I'm not 100% sure why they don't. I mean, I'm not sure that the Forex on the lower time frames are slightly more random, or there's more games played, but I think that the pros I've met are using a lot more volume profile, and that's obviously easier available on the futures market, because there's no real central exchange on the Forex.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So you mentioned a little earlier that you've recently started trading the DAX as well as kind of a secondary market to what you do. What are some of the things you've done to get familiar with this market? Like, as someone who is, a profitable trader now, you've seen some success. When you introduce a new market to what you do, what are some of the first things that you actually do to familiarize yourself with that, in this case being the DAX?
The first thing I did was I keep about 15 to 20 standard stats on the market I trade. So the first thing I did was draw up the same stats for the DAX market. And then I had the charts open for maybe 2 weeks and just watched it, see if it reacted and drew my lines and done my other process, how I analyze each time frame to find areas of interest or areas where I want to buy and sell. And so I did the same and just dropped the same trade plans, but I didn't actually trade it. I just then watched to see if it kind of reacted the way that it would to my system. And then I started trading it using one lots, just to see, where the buffers need to be, how much I need to front run levels, how easy it is to get filled, and just really experimenting with how it reacts to my system and what change I need to make to my system to deal with the DAX market, because obviously the DAX is a lot thinner than the bond market and the Euro stocks.
Okay. Now, you've used the term system a little bit. Let's just get very clear on this. How much of what you do is discretionary versus rules-based, just so we understand where you're coming from here?
Well, basically, I couldn't code my system, but it's very much rules/process-based in how I make my decisions. So it's a discretionary system, but it's very rules-based in how I make my discretionary decision. So I have rules for how I analyze the charts, how I find the areas of entry, what I'm looking for. So I have a checklist and a cheat sheet for how I analyze, find setups, and depending on the strength of the setup, according to my processes, what sort of targets I'm looking for. So whilst it is discretionary, it's very much rules-based in how I make my discretionary decisions.
Okay, so what are some of the discretionary aspects of your strategy or your system? Is it mainly actually deciding which trades you're going to take and which trades you're going to let go, or is there something more to it?
Yeah, it's basically, if I have an area of interest, there's basically either there's a trade of it where I'm just going to put an entry in, so when it comes back it fills, or if the level is area of interest but it's not strong, then I'm looking for a trigger. So then I'm looking for a checklist of about 4 items, which I need at least 2 of them to enter that trade, or it's an area that I don't take a trade. I have to wait to see for new structures to form in there.
Okay, and once you do get into a trade, how do you determine your position sizing? I mean, is it always fixed? Is it the same for each and every trade, or does it vary somewhat?
It tends to be fixed because my stops tend to be roughly about the same. But if the level's wider than normal for that market, then my position size will decrease so that I'm always risking the same amount of, approximately the same amount of account each time.
Okay, and as you mentioned stops there, I'm keen to ask, how do you actually identify where you will place your stops for each trade?
Because I'm looking at, on volume profile for areas where I think there's a bunch of traders that either want to get in or want to get out, then my stop will go on that 2 ticks on the other side of that. So on the bund, that can vary between 5 ticks to 10 ticks. But it's averagely between 6 ticks.
Okay, so your stop placement is based upon the volume profile and not where the actual, not a price chart. Is that correct?
Yeah, but the volume profile on the price chart, yeah.
Okay, so you do factor in the price chart to where your stop will go as well.
Yeah. Well, I look at the price chart because the volume profile could be at the extremity of a high. So it will typically go 1 or 2 ticks above the high because that will be the other side of the HVN I'm looking at, or the rotational point.
Right. Okay. All right. Well, Adrian, let's talk stats. I mean, I've been really keen to speak with you about this. I'm really interested in this for personal reasons, of course, and I think it's going to be very interesting for many listeners to hear about how you use stats in your trading as well. So let's just start right there. How do you use stats in your trading?
I do about 20 stats, and for example, gap fills. But one of the problems I had with stats is that you could have 82% chance there's going to be a gap fill, but to be honest, the 82% chance of the gap fill by the end of the day, we could go 100 ticks offside, then come back and fill the gap. So you're trying to work out, whilst it was a good target, we're trying to work out where you enter to take advantage of that stat. So I ended up, not really being able to take advantage of the stats. So what I do now is once I've worked out a stat, and let's say, for example, it's a gap fill on the bund, that I ignore, it's got a gap above a certain size. So anything below 0 to 6, I'm not interested in, because that affects the stats. Because the original stat I had, I think, was 92%. But if you take out the 0 to 6 ticks gaps, then it comes to, so I'm looking at a range of a gap between 6 and 15 ticks. There's an 82% chance of filling. So what I then did was look at all the stats that filled that gap, that fell in that range, and then looked how far they went offside. So then using that, you look at the curve on that to find out what was the most common, how far they went offside, the most common price, and the standard deviation, what 70% of them did. So that gives me, for a gap up, that the most common offside is 11 ticks, and the standard deviation is 17 ticks. So if I get to gap up between 6 and 15 ticks, I am now looking for trades between 11 and 17 ticks for the gap fill. If it goes above that, then I know that it's more, whilst it still can fill, it's more unlikely to fill, and I'm not that particularly interested in that stat anymore, if that makes sense.
Yeah. No, it does. How do you actually get these stats that you want to know? Like there you mentioned some stats on gap fills. How do you actually find these? Do you use Excel? Do you have a programmer? I mean, tell us a little bit about how you actually get these numbers.
I used to use Excel, and it takes, to be honest, if you've got a fair bunch of stats, it takes forever to do them. I use RT Investor, the platform, and the beauty of that is that you can, and they have a whole homework section on their website, on RT Investor website, and you can drop the charts which will actually give you them stats by putting indicators on there that will give you those stats by programming in their language. And I'm not particularly good at programming, but what I did was in their homework section, I downloaded some of their charts on stats, looked at how they were done, reverse engineered them until they did what I wanted them to do by trial and error. So now I have a chart which I update my stats every month that I call up for each of my 20 stats, and it tells me what the updated statistics are. Then I fill out a cheat sheet, and that's how I do my stats. And that's how I can keep up to date with 20 stats. If I did them all by Excel, to do 20 stats would probably take me 2 to 3 days and lots of tears.
Okay, yeah. So this is something that the functionality is built into the Investor RT platform, is it?
Yeah, it has the capability, and they have loads of tutorials to teach you how to get that functionality out of the charting platform.
Right, and you mentioned that you get the updated numbers each month. What is the data sample in the stats that you're using? Like how many, how large is the data sample? Like, is it a moving window or is it sort of cumulative data?
It's a moving window, and the size of the moving window is dependent on the stat. So the typical moving window for me is 1,500 days. Some of my stats, which I'm trying to capture what he's recently doing, is like the size of the swings. I do on the lower time frames. I run a 30-day rolling window.
Okay. And do you find that certain stats are less reliable in certain types of market conditions?
Yes and no. Because in the day, the stats are the stats. And you have to take in context, and that's why I've done the maximum adverse excursion on the majority of my stats to find out where it's, if it's going to fill, how far offside 70% of them go. So then it gives me a clue that, if it just punches straight through that, then it's unlikely the stat's going to be fulfilled. So I'm not particularly interested in that trade, because you could get situations where the stat's open, but the price is going one direction away from the stat to be filled, and you're sitting there wondering, well, is it going to fill or is it going to fill? So by using the maximum adverse excursion technique, that once it gets past a certain level, I won't be interested in that stat again unless it comes back towards the gap fill, and then gives me a setup in that direction. So I use it as a qualifier, and it gives you a clue of the strength of the market.
Yeah, would you mind explaining maximum adverse excursion?
Yeah, maximum adverse excursion is what I use, is saying that if I have a stat saying that it's going to test the volume point of control, then I look at all, and that stat is 65%. So I look at all the times that it did test the point of control, and I look at how far it's gone, the maximum it goes offside, so maximum adverse excursion away from the open price or whatever point I'm measuring from. So that will give me, out of all the trades that fill, it gives me an idea of how far it's going to go away from, so if I took the trade as soon as the stat become viable, how far it will go offside. So I don't just take the stat when it becomes viable, I just use that to give me a gauge of how far it might go away before filling, and if it goes further than that, then I'm not interested. So that's what I call a maximum adverse excursion before the stat fill. Does that make sense?
Yeah. And on the other side of that, the maximum favorable excursion, is this something you also look at, maybe in terms of profit targets or something like that? Does that come into play in your analysis?
It comes into play in my analysis for my own trades. I track maximum favourable excursion and maximum adverse excursion in my trades after I exit, to see to monitor how well I'm placing my targets.
Okay, and is this something that you can track in Investor RT as well, or is this something, do you have an Excel spreadsheet that you track this in, or do you manually do it? How do you track this?
I track it manually, and I put it in a spreadsheet, and then I put loads of Excel sliders on it to so then I can break down the information into long, shorts, or whatever. Now, I did a post on my blog showing you the readers how to set one up. And I think that I put the Excel spreadsheets up there as well. So there's a video actually how to make your own MFE, MAE tracker.
Yeah, okay. I'll dig up a link to that and I'll make sure to include that in the show notes so anyone listening to this can find out more about that. I think that's well worth your time. We were talking a little bit before we hit the record button, and one of the things you mentioned is that traders sometimes use stats in the wrong way. Would you like to share, maybe an example of how traders may use stats in the wrong way?
Well, it really comes back to what I was saying before about that. If you have a stat that's going to do something by the end of the day, it doesn't really. So it might give you a context and it might give you a target, but it doesn't give you an entry. So you don't know if there's a profitable edge in that stat until you do more research. Because it's a stat by itself saying that I have a stat that the initial balance range, one side will be tested 98% every day. So virtually every day, one side will break. But by itself, it's not much of an edge because it could be either side and you don't know where your entry is. So you don't know what your risk reward is. So even with a 98% chance of breaking either side, whilst it gives you a target, it doesn't really help you find an entry. So that's why I think that a lot of people focus on the wrong side of the stats to get the stats, but they don't really know how to turn that into a profitable edge.
Okay, so once you have a stat which seems kind of interesting to you, what's the next step you do with that? Like, when do you decide whether that's something you're going to factor into your decisions or whether it's something that's just, I guess, essentially noise, like there's no edge in knowing that? What's kind of the next step you do once you discover a stat that grabs your attention?
What I do is, the first thing I do is actually, the only interesting stats are really that are above 65 to 70%, because you can have too many stats, and what I want is stats that are a high probability. If they're under that, then I'm not that particularly interested. And also that I'm not that particularly interested if it's a stat that's going to, generate only 2 or 3 ticks of profit. So I'm looking for the stats that have got a decent amount of profit in them, or potential profit, using common sense that I can actually use within my trading. Because some stats that you come up with, like the IB high, I use that stat all the time, knowing that one side's going to break, but it's not a major part of my, it's part of my analysis, but it's not, I don't take trades going, well, it's going to break one side. I would be looking going, well, I think this is an area where buyers going to step in. Then I'd go, well, where's my target's going to be? Well, the IB high hasn't broken yet. We're due to break one side. Buyers going to step in here, so that's a natural target.
Mm-hmm. Okay. And just to clarify for anyone listening, if you're not familiar with what IB is, it stands for initial balance, which is the opening 60-minute range of the regular trading hours session. That's correct, isn't it?
Yeah, I use a 2-hour on the Bundo.
Oh, okay, right.
On all other markets is 1 hour.
Yeah. Okay, Adrian, well, I'm really keen to ask you about how you create a trading plan for the day ahead. I know you post this on your Twitter feed, obviously on your blog, which you link to on your Twitter feed. How do you go about creating a trading plan for each day? What's included in it?
Well, I started with the weekly, which I do at the weekend. Have a look at the weekly charts to see if there's anything obvious. I have a process for every chart. So every chart I will draw in, highs and lows that are significant to me, any flip zones, and then using my same system, I draw in any areas where I think there's buyers or buy areas or sell areas. So I do that on the weekly to get just an idea of what's going on, even though I don't factor in, just to give me an idea of what the overall massive picture is. And then I do the same on the daily. So each day I look at the dailies to see if there's any breakout failures of inside days, which may give me a bias for the next day. and then my main analysis is done on the 16 and 15 minutes. So I look at what the 60-minute bias is, trend, whether it's in balance or is in a range or is actually trending, how strong the trend is. And then I ask myself, what's likely to hold if this trend's going to continue? No matter whether it's not a case of whether I think it's going to continue. The first thing I do is ask myself, if it continues, what should hold and what should break, and where I think it should test. I do the same on the 15 minutes, and then from that, then I draw up a long scenario, neutral scenario, and short scenario. So, and that's really how I just work down. I just work down from the 60 to the 15 minutes, looking at the daily just for overall bias, and analyse them both in the same ways, and just work out what I think should hold based on my, if it's in a trend or if it's in balance, and what should break and where it should test, which then gives me an idea of where I should be taking trades and red flag areas. So if I think that it's in an uptrend and it should break the high, next day if it doesn't break the high, then that gives me, or is struggling to break the high or breakout fails, then that gives me an idea that the trend may not be strong enough. We may have a change in behaviour in the market.
Right, and one thing that often comes up that traders mention that they struggle with is actually not doing up a plan, but once they do up a plan, they actually struggle to stick to it and follow it through. Is that something that you were ever challenged with, or had that always come fairly natural to you, considering your background in sailing and being very process driven for a good part of your career?
I've definitely found it a lot easier to follow my plan when I was trading dailies. That was a lot easier. Intradays, I struggled with that a lot. And the way I got round it was to draw up what I call mini plans. So I really drawing up 4 or 5 times a day what it's done since the open and where I expect it to test. So then I can use that to then look at my daily trade plan to see that, saying that if I think an uptrend but it's going down, then I draw up my plan and look at the 60-minute. So I kind of run a mental model of what's going on at the time, so you see how it fits into my major trade plan. So I have these little mini plans. So I trade around the mini plan until I get to my major plan, and then I trade around my major plan.
Mm-hmm. Okay. And I mean, I'd suggest if anyone's actually interested in seeing how Adrian goes about creating these plans, to definitely check out your website. What is your website, Adrian?
TakingOneTradeAtAtime.com.
TakingOneTradeAtAtime.com. I'll link to that in the show notes, of course. At the end of each week, I noticed that you review the week that's just been. How do you go about reviewing your trading week? What's that process like, and how has this been helpful for you in your development?
Well, the key thing is to be honest with yourself. Honest with myself. That's been the key thing. Process is one thing, but actually, no matter what process you put into place, if you're not being truly honest with yourself, and to be honest, we used to have review processes when we used to do sailing, and the one thing I've noticed with myself and the majority of people, that when you're doing proper reviews of performance, is that people really don't like being that honest with themselves. They don't like to admit that they made a tit of it, and that is to be the key, because no matter how you approach it or what your process is for your review, if you're not really being honest about the reasons why that it's going wrong or it's not going the way you want, then you're not really going to get any answers. So the key part of the review process for me is the question why, and to keep asking why am I doing that until it makes me uncomfortable, because normally once you get to a really uncomfortable place with asking why, you're normally going to get to the answers. But the actual physical process is that the first thing I do is I do a chart review at the end of each day. So I mark up all the areas where I took trades, make notes of them, areas I missed just because I didn't, or or interesting things on the chart. So the first thing I do at the weekend is go through all them charts at the end of the day, market reviews. Then I go through the stats for the week and see where when my results are in variance, how I'm doing against my goals. Look at the number of errors, look at the number of missed trades, compare that to the week before to get an idea of whether, I've had an increase in errors or missed trades, etc. So I started taking all them notes down, and then I go through my mini plans, because next to my mini plans I'm writing down what I'm feeling or what I've done wrong, and also I make them notes in the market reviews, and then it gives me an idea where I haven't particularly performed well in that week, and what I've done good. And also I grade my trades. So I go through the weekly grades and look for areas where my grading wasn't particularly good. And I also grade my days, the sessions for my focus. So I go through them areas and look for areas where I've scored lowly, and then go back through my notes and look for things in common, why that was happening, by looking at my mini plan. So that gives me two areas. I normally just trying to focus on two areas. One where I did well, so I'm not constantly beating myself up for doing shit. And one area where I did shitting, and then I go, well, I did shit. Well, why did I do shit? Why do I have what's causing me to do shit? What's causing me to, try and work down to the original cause? So I just keep asking myself why, so I can go down and find out really. And normally, to be honest, most problems with not following the plan or making fuck ups comes down to two things: fear of loss or fear of missing out. And then there's others where you're not focused or tired or you're distracted. But really, most of the stuff really comes down to the two fears.
Right. So how do you actually grade your trades? Like when reviewing these, how do you determine what's a good trade and what's a bad trade?
It changes over time. Hold on, let me just open my spreadsheet so I can tell you exactly. Because off the top of my head, I'll probably get it wrong. First thing I do is and each of these are weighted in different scores. So what's more important? So the first one I grade it on is it in my trade plan? And I have a score between either 0, wasn't my trade plan, or 10, it wasn't my trade plan. Then I score it for was I playing to win or playing not to lose? Because I do have a tendency to play not to lose. So take profits quickly rather than let them, as soon as I see a bit of trouble, get out of my trades rather than let them run to targets. Then I score myself for whether I was emotional in the trade or whether I was patient, so how I was actually feeling. I score it on whether what the risk reward was like, whether it was high risk reward, medium risk reward, or the risk reward was, if it's under 1.5 risk reward to the first target, I shouldn't be taking the trade. So I score that I shouldn't be taking the trade because it was rubbish risk reward, or it was an okay risk reward, i.e. 1.5 and above, or if it's above 2, then it gets high score. I also track intuition, and that's really just to see that whether my gut instinct is right or wrong. So it's part of my grading, but it's something to track. So if I feel that my system says take the trade and my gut says no, then I score that low. If my system says it's an okay trade, but my gut says yes, then that gets a high score. So that's really our ongoing project to see how well my gut instinct is working. I then grade it on entry, whether I was entered when I should do, I was a bit late, a bit early, and how I managed entry. Then I grade my exits on the winners, and I grade my exits on the losers. And then I divide that by the total number of points to give me an A, B, or C, D trade.
And we can see all this on your website, right?
Yeah, I've talked about my grading system before, and I got that idea how to grade the trades from Breaking Out Bad. At Breaking Out Bad, he's a trader on Twitter, and he has a whole screencast on grading days and grading trades. So I saw that, and I added that to my system.
Excellent. And how many hours would you say you spend each week reviewing your trades and, doing homework and this type of thing? A few?
20?
Outside of market hours?
Yeah.
Okay.
Probably.
Wow.
Probably slightly less than summer because I go sailing on Tuesday and Thursday. So my evening reviews tend to be I either don't do the evening review totally, market review. I will do my market prep, which lasts between half an hour and an hour, depending on what's happening in the markets. So that in the summer, twice a week, I probably do an hour every evening. But outside the savings season, I am doing between an hour and 2 hours every night. And then I do 11 o'clock to 5 o'clock on Saturday, and about 11 o'clock to 5 o'clock on Sunday, most weekends.
Right, okay. That's really impressive. Wow.
Well, my friends say it's sad.
Well, you got to do what you got to do.
Exactly.
Let's just do one last question, just for fun. What's one thing you wish someone would have told you before you started trading?
The mental side goes hand in hand with the trading edge, and more importantly is that trading, and I didn't realise this myself until halfway through my career so far, if you want to call it a career, is that trading has actually got loads of similarities with a competitive sport, as in like cycling, boxing, individual competitive sport, as in that what you do outside the session or the event counts just as much as what you do inside, but you still got to perform whilst doing the event. So if you was a boxer, if you didn't do any fitness or any skills practice, no matter how good a boxer you was, you would still do rubbish when you come to a boxing match. So, and trading's the same, but I didn't realise right at the beginning that how focused and processed you need to be in the prep side and your homework has such a big effect on the how you do actually in the trading session. And I think that's one of the biggest problems with a lot of retail traders, because I speak to a lot of people. I'm at stage 5 and I speak to people there, and over the years I've spoken to a lot of traders online. I've seen majority come and go, and it was a problem with myself to start with, but I see all the time is that the prep is never given the same weight as the trading sessions, and actually it should be given equal weight, or even more, at times more importantly. If you're not prepared before you go in there in how you're going to approach the competitive event, then you're not putting the odds on your side, no matter how well you trade in the competitive event. And I wish I'd known that in the beginning, because I would have definitely put more weight onto how I'm doing it now, the prep and the homework and the research and review process right at the beginning. And then, to be honest, I think I would have knocked at least 2 years off my progress.
Right. Yeah, no, I think that's really good advice there, Adrian. Where's the best place listeners can go to find out more about you?
I'm on Twitter at ADF69, and I have my blog where I post my trade plans and my weekly reviews, and I try and write articles on my process and basically stuff that interests me on that. Taking one trade at a time.com.
Okay, and would you mind just spelling out your Twitter handle, please?
ADEYF for Foxtrot 69.
Excellent. Well, Adrian, I'll include links to all of these, your Twitter handle, your website, as well as the maximum favourable excursion and maximum adverse excursion links in the show notes as well. So, Adrian, man, I've really enjoyed this. Thank you very much for agreeing to do an interview, and I appreciate your time.
No problems, mate. It's my pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
A pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome. What's up? How you doing? Welcome to episode 95, folks. I'm pleased you could be here, and let me briefly introduce my guest, then we'll jump right into the interview. So, this week I spoke with Nico, who asked me to keep his last name private, though he does go by @inefficientMRKT on Twitter. Put simply, Nico is a day trader with a thirst for momentum. He predominantly trades low-priced stocks that have a tendency to move fast and far, and roughly 90% of his positions are on the short side. But the main reason why I brought Nico onto the podcast is I feel as though he has a really interesting story which many traders will be able to relate to on one level or another. The short of it is Nico placed his first trade in 2007, made 4x on his starting capital year one, and then slowly bled his trading account for the next 7 years. He's now found his groove, but his overnight success was 8 years in the making. The subjects we discuss during this episode are very much centered around Nico's journey and development as a trader and how full-time trading became more than just a pipe dream. Please enjoy, guys. I'm Aaron Fifield, and here is my guest, Nico. Nico, what's good, man? What's going on?
Greetings. How are you?
I'm doing all right. How about you?
Great. I just spent the day and I set up my new war rig. I got
nice.
two 43-inch screens. I had to buy a new table for my desk though because they wouldn't fit before.
Trader problems.
Yeah.
Nice. 2 43-inch screens. That must be massive.
They are so cool. They're Dell's new multi-clients, and you can divide them into virtual screens. So even though I have 2 physical screens, I have 12 usable virtual screens. Okay.
That's really cool. What were you using before?
I had 4 24-inch screens and 28-inch vertical, like in portrait.
Yeah.
That I was using before, but this is much more. This is way better.
Oh, that's awesome. I imagine it might take a little bit of getting used to. Yeah.
It does. It was actually a gift from my girlfriend. She got me greatest gift of all, man. She got me one of these beasts for my birthday, and I wanted to use it, and my computer at the time was too slow, so I used that as an excuse to get a new machine that could power it. And man, I started using it, and I loved it so much. I was just like, I just need one more of these, and that's all I need. And I ended up getting rid of all my other older monitors.
That's very cool. And what's the resolution on those? Are they 4K?
They are 4K. So you get the standard 3840 by 2160 for each one.
Okay. Nice, man. I like it. You'll have to share a photo with us.
Definitely. I plan on it.
And how'd you go with the desk? Did you find a desk that fit?
Gosh, I was almost resigned to the fact that I might need a a custom desk, because these two monitors next to each other are about 76 inches wide. And I was hard pressed to find a wide enough desk that I could put both of them on without, a ton of monitor hanging off the edge and it looking funny. But I found one desk at IKEA that fit the profile, and I just mounted it to my elevator desk legs, and we're good to go.
Okay. Good stuff, man. Good stuff. Yeah, well, I look forward to seeing a photo of it.
Thank you.
Well, before we go any further, I want to say congrats on having a really good month in August. I think that was your best month to date, yeah?
It was. Thank you very, very, very much.
You must be stoked with that.
It feels amazing. Yeah, it feels really good.
Cool. All right. Well, I know a little bit about your story, Nico. And what I do know is that it's going to really inspire a lot of people who are listening to this podcast right now. So I'm really excited to have you on, and I'm looking forward to, the conversation we're about to have. So let's get this underway. Take us back 10 years or so, right to the very beginning. What got you interested in trading? Where did you start?
I was working for a small boutique software development firm out of high school, and I was developing software. And the short story goes, I wanted to make more money, and the owner was reluctant to pay me more money because he held it over my head that I dropped out of college, and I then had to decide whether I wanted to go back to school or go into business for myself. And I wasn't too fond of school at the time because I wanted to take computer science classes and whatnot, but they wanted me to take all these other classes, all these other courses I had a hard time taking. So I decided I didn't want to go back to school. So I went into business for myself, and I knew computers. I knew how to develop software. So I started building my own business from nothing. And one of the very first clients I had traded stocks, traded equities. And I'd heard of the stock market before, but I never had much interest to the degree that I would actually do something about it. But to finally meet someone in my life that was familiar with it, that was a good starting point and gave me good exposure to it. And once I understood the kind of money that could be made, that definitely held my attention.
So how did you find out that this guy, this client of yours, traded stocks? Did it just come up in conversation, or how'd that come about? I
eventually got comfortable enough to ask, hey, where's some of this money come from? And that was basically the answer. To have someone that you see you respect and who's doing well for themselves, and to ask them where their money comes from, and that's the answer. That was enough for me to finally start getting very interested in it and seeing what I could learn about it.
Okay, so it was obviously quite clear to you that he was doing quite well. I mean, was there any hints that sort of gave it away? Was he a high-paying customer? I mean, what sort of gave it away that he was doing quite well?
Yeah, I was definitely making more from having him as one client alone than I was working at my software company that I worked for 6 or 7 years. And he was just my very first client, and I knew I had to charge more than I was making at the software company, but it was a great situation for both of us, and I got compensated well, and I got to learn a little bit. But what I learned from him, it was very different than what I was ever really interested in the sense that he would trade big cap, large cap stocks, and he was interested in Dow Jones components and whatnot. And once I understood what volatility was and I had a sense for it, watching those stocks move 1%, 2%, or 3% in a day, 3% is a big move for stocks like those. That wasn't very interesting to me. But when I found out about cheaper price stocks, that was wow, these things move 10, 20, 50, 100% in a day, that was much more interesting to me.
Okay, so it's almost fair to say he was probably more of a longer term guy or a bit more of an investor, yeah?
Definitely.
Okay, cool. So walk us through your first year, like from when you became interested because of your client there until about 1 year on. So I think it was about 1 year before you actually placed your first trade with real money. What was going on inside of that year?
I was trying to learn as much as I could, and I was also going from when I was a software developer, I was living paycheck to paycheck, and I had no savings at all. So for me to try to start out with something in the market, I had some, not only did I need to save money, but I had some I had all these habits that I had to get in check for living paycheck to paycheck. Once I started having some income, decent income, I had to, at first I got excited and I was, probably spending more than I should have. But after a while I was like, okay, this is great having money, but I really need to save some money because it would be great to open up a trading account at a brokerage. And that's kind of where that first 12 months was after I learned about the stock market, was me rearranging some habits and saving some money. And meanwhile, learning, I won't say as much as I could about the stock market, but definitely learning some about the stock market and just kind of trying to be able to stand on my own 2 feet and get something going right from the start. But it took me a while, about a year.
Okay, so I just want to pick up on something you said there. I mean, it's a little bit off topic, but you mentioned that you had to break some habits so that you weren't just going paycheck to paycheck. Now,
yeah,
I know there are a lot of people who do this, and it's kind of crazy to me to think that people do that, obviously, when they don't have to. What were some of the habits that you had to break? How did you break those habits so that you weren't going paycheck to paycheck?
Well, for years, for all the years I worked at the software company, I was paycheck to paycheck. So that means I was, whether I liked it or not, but I was programmed to spend my entire paycheck every month because that's all I needed, every bit of it to survive, to pay rent, to buy food, living on my own, to, whatever. I was a lot younger, but, I probably spent money on stuff I didn't need to spend it on. But all that, that was a big habit for a long time, 7 years of doing that. So once I finally got some decent income, here I was used to spending my entire paycheck. So after a few months, I think I was spending my new paycheck when I went into business for myself, which, by the way, that wasn't an immediate thing. I made the decision I'm going to leave my software company, but I still worked there until I was able to get something going on the side and generate some, a good chance of possible income on the side before I jumped ship, because I did have bills to pay, just like everyone else, food and rent and whatnot. But eventually it was fine. But the habits thing, it was just, I was programmed to spend money, and it took me a while to realize, hey, just because you're making more money, you don't need to spend it all every month. Like save some and see what happens, especially if you want to, dabble in the stock market. Gotta have some money to play with. It's gotta come from somewhere.
Absolutely. And I think like when you go into business for yourself, obviously you don't kind of have that same sense of security as you do as a full-time job, where you've got another paycheck coming next month. And when you're out on your own, it's kind of like you don't necessarily know where your next client is coming from, or where your next when you're next going to send out your next invoice or whatever. So
that is the truth, man. Complete truth.
Yeah. I went about it much the same way because I used to run a graphic and web design business, which I kind of built up while I was doing my full-time job.
Oh, nice. That's the best way for anyone that wants to do their own thing, work for themselves, go into business for themselves. Please, do not quit your job and just do it. I definitely think, I'm of the opinion, at least for me, it's much better to keep getting your paycheck from your regular job and try and get something started on the side. See if you can get something to stand up on its own while you still have a job and you still have that paycheck you can rely on before you cut loose. Because it makes it so much easier, at least psychologically. For me, it did.
And I mean, that can even tie in neatly with trading too. So there's many overlaps there. So do you recall your first trade? Like, how did that go? What were the emotions like when you put on that position? What was it like?
Yeah, my first trade was in early 2007, and I bought some stock in Apple at the time, and I don't know what my time horizon was, how long I was planning to hold it, but I think I ended up selling it later the same day for maybe $100, and I just thought that was the greatest thing ever. I just thought that was the easiest $100 I'd ever made, and that I'll never forget it. And even though it was only $100, man, it stuck with me this whole time, and that was my first taste of it. Even though it was just Apple in a big cap stock, a large cap, it was just getting paid that much without, I couldn't even call it work. It definitely resonated with me, and that was the kind of money I wanted to make, compared with going to work, working in a cube or an office, and nothing wrong with that, but it's a different mentality. And once I got a taste of that, I definitely wanted more.
Yeah, I feel that for sure. And I think that's, a lot of people who are attracted to this, I mean, that's kind of what goes through their mind as well when they first come into trading.
Absolutely.
So, I mean, during that first year, what were some of the things you were learning about, about the stock market? What were you reading? Where were you getting your information from?
Yeah, so back then I was using a charting platform called Telechart, and Telechart's by a company called Warden Brothers. I guess they've been around forever. Apparently they had stock chart programs since before Windows. You could get stock charts in DOS. They had a DOS program for stock charts and whatnot. But anyways, I was using their Windows program and started using that in 2007, and it had a built-in chat window that I've always been into chat. When I was a kid, I used to chat on IRC when I was younger in high school and whatnot, and I've just always been big into chatting and whatnot. And to have a chat room with a bunch of investors and traders, man, I thought that was the coolest thing ever. And I got to see what people typed, and who knew what, and that type of thing, and that got my gears turning in all different sorts of directions. And it was really good for me to learn about other people, what they were doing. That helped clue me in. I was definitely self-directed towards technical analysis. I love the idea of looking at a stock chart and just going, okay, I know, do I want to buy this, sell this, or not touch it at all? And that appealed to me a lot more than the fundamental side. The fundamental side was it seemed like so much work. That seemed like having a regular job all over again, because it seemed like you can just pour all these hours and hours and hours and hours of research. Maybe you study something for days, weeks, maybe even months. I don't know. Just one stock or a handful of stocks, and you get to know them intimately and you understand their business. But it just seemed like, at least back then to me, it might take 6 months or a year for the market to realize whatever you may have realized doing your fundamental analysis. And even if you thought it was a great investment and you buy it, I mean, if the market doesn't know it's a great investment, maybe it takes 9 months or 9 years for market to catch up to what you were thinking, if at all. So just timing the market using stock charts, that was, I mean, instant gratification. I love that idea. that was big for me.
Okay, cool. So, we're about 1 year in at this point. You've taken your first trade on Apple. You banked $100. Your interest has been piqued in technical analysis. What was it like moving forward from there? Maybe walk us through the next year or couple years on from that point. What was your experience?
Okay, so for basically my first year since I placed my first trade, for the next 12 months after that, I was attracted to low price stocks. And I didn't even know what shorting was at the time. And I just thought the only thing I could do was go long. So I was just buying all kinds of low price stocks. I mean, on momentum. I mean, any stock that had volume coming into it, and it was on a rampage, ripping up. I was buying some, I was chasing it. I was, take your pick. I was doing it all. I was doing anything I could to get long and buy some shares. And I don't know whether it was the micro cap market of 2007 or just pure luck, but basically a year of doing that, I made about close to $20,000 doing that my first year. And that made me feel on top of the world. I thought, man, this isn't so tough. I don't understand why everyone says, over 90% of traders fail. This is so easy. Oh man, I'm going to do this the rest of my life. This is a walk in the park. I don't know what everyone's so fussing about. I don't know why they're having such a hard time doing it. This is easy for me. And that was probably the worst thing that could have happened to me, as you could imagine, because, well, I don't want to get too far ahead of your question, but yeah, that was basically my first year. So I had a taste of large success from basically not knowing much of anything. And I think it was just, like I said, I don't know whether it was the microcap market of 2007 or just dumb luck, beginner's luck. But I had a good year in terms of profits.
Okay. Yeah, I mean, that's a really decent first year to have made $20,000. How much capital did you start with?
So my first account I saved up $5,000 and opened up a Fidelity account, and just slowly over time kept saving more money and adding more money to it. But I never really, my first year I might have been a little strong with my position sizes just because I was doing so well and I didn't know any better. But I'm sure we'll get into it. But later on, I toned my size down significantly and kept it in check once I realized I knew that I didn't know.
Yeah. Well, let's get into that a little bit. So the first year you made $20,000. You felt like you were on top of the world and you nailed this trading thing. When did that begin to change? When did you realize that you hadn't quite nailed it yet?
Oh man, probably, I don't know, not soon after, maybe the next month after my first year, so a short time after that. I just, everything I was doing that entire past 12 months, it wasn't working anymore. Either my luck ran out and or the market changed, and what used to work no longer worked for whatever reason. And I, unfortunately, thoughtlessly, just continued to be the junkie, degenerate gambler at the slot machine, and I just kept pulling the handle. And even though it stopped working, I just kept doing it. I kept pulling the handle, and I'd say the next 12 months after that, I had lost all of that profit that I made the first 12 months, and I was just kind of left scratching my head the entire way, going, I don't understand why this isn't working. Maybe it's going to start working soon. It must start working soon because, man, I know it definitely worked that first 12 months, and I'm not doing anything differently. And it was just the cold reality slammed me right in the face and took all those profits away. Maybe even a little bit more that first year, or my first losing year after my first winning year. But that was the cold truth hurt at that point. It finally caught up to me. And okay, now I understand why everyone says this is so hard, damn near impossible, and over 90% of the people fail doing this.
All right, so let's just bring listeners up to speed and put things into perspective here. So from what I understand, it was the next 8 years that followed from there where you pretty much had losing year after losing year after losing year. Is that right?
That's right. Yeah, 7 years to be exact. And it was for those 7 years, at the end of every year, I was in the red.
Okay. So,
and again, it's just, yeah, go ahead.
Yeah, so I really want to dive into this because I think there's a lot of value in really kind of dissecting this and finding out why it took you so long, how you managed to break through and all that sort of good stuff. So, probably one of the first questions I'd like to ask you around this, 7 years losing year after year, it's got to be painful. How were you able to sustain these losses, and what sort of things did you do to manage your risk during this time?
Okay, so great questions, because after my second year of trading, I had my first year winning, second year I lost everything I won the first year. And at that point I realized, okay, it's easy to lose, or it felt better to lose money that I'd made from trading in the markets, but it really hurt to lose money that I worked hourly for, that I worked on the side, I had a real, I worked legitimate, I don't want to say legitimate for, but, I worked as my job, my work, my business. A lot harder to lose that kind of money than it was to lose profits I'd already made in the market. So once I started losing, job money, my work money, that's when the emotions that's when it just felt terrible. It just felt so hard because I'd lose it so fast, and it would take me, so long, so many hours, X amount of hours I'd have to work to like make up for those losses in the market. And so that's when I started understanding, and I just went, whoa, okay, I don't know what I'm doing. This was very misleading for me to have a successful first year. And I clearly did not do well the second year. And I think I'm starting to know that I don't know I don't know anything really. I thought I knew all this stuff my first year. I don't. And that's when I put my size in check. And that's when I said, okay, since I don't know, and I've got a lot to learn, I am going to dramatically size down. And I basically went to just trading very small. I don't think over, I say on average, maybe $5,000 positions. And, sometimes I might get up to close to 10, but I just kept it in check. I never ballooned up because I didn't want to do more damage than I could recover from. But that was tremendous for me because, and it's not to say I didn't have, spurts of profitability in those 7 years. It's just that I'd hit periods of profitability and I'd do well for some amount of time, but it was just inevitable that it just dried up and the drawdowns would return, and I just would continue to just lose back on the drawdown. I'm back to losing money and got to wait for something to change, or got to change what I'm doing. I try and change what I was doing, and I tried all kinds of things, and some of that just led me off into worse directions, I think. But a lot of it was just, I think, having poor habits for a large number of years. And also because I own my own business, I wasn't starving. So I didn't really have like dire motivation. So I was making a good living working for myself. So I had income. So even though I might have been in the red for 7 years, hey, I'll add a little bit more money each year, every 6 months to refund and make my accounts healthy again. And, hope for the best. I mean, that's basically what it was.
Okay. So you said you had like some spurts of profitability. Do you recall maybe what was your greatest winning streak? Like, were you profitable for, say, 3 months in a row or anything like that? Or
yeah, maybe nothing that good. Maybe more like I was, I'd hit maybe 3 weeks where I do really well, and then it was always 3 steps forward and 5 steps back. Anytime I hit some X steps forward, I was taking more than X steps backwards. It was just a matter of time in those 7 years. It was just really hard.
Okay. And how frequently were you trading during this period, just sort of on average? Were you trading, 5 day trades each day, or was it something, a couple trades a week?
So a couple years into it, I don't really know, but at some point, maybe if I was to guess, I'd say maybe 3 years into it, maybe a little less, 2.5 years. I don't know, somewhere around there. I kept funding my accounts, and I probably had one account at that time, and I got over 25,000. So I was getting a taste of day trader's margin and the ability to fly in and out as frequently as I wanted to with as much as I wanted to, and not being shackled by the pattern day trader rule. So that was really good. But you know, in hindsight, even though I had over 25,000 in the account, I almost wish like I didn't, because I probably would have saved a lot of time and money had I been under the pattern day trader rule. Probably would have been more of a service to me than a disservice. You know, I think a lot of people see it as a disservice, and it is. But I mean, the reason it exists is to quote protect people, at least the people that were as had degenerate gambling habits like I did. You know, I think that's why the pattern day trader rule to protect us from losing all our money so quickly, at least.
So how were you affected by the pattern day trader rule when your account was under 25 grand in the beginning?
Yeah, so when I break under 25,000, it was like, okay, now I'm shackled, right? I'm shackled by the pattern day trader rule. So then I would just do my best to either trade my way back above it. Even if I did, I was always nervous because I was so damn close to it. Or I'd go, all right, I'll just throw in another $5,000 and boost me up above it, so I don't have to keep being so paranoid about it that I'm going to break it and get below it again and lose all my freedoms of flying in and out of stuff as I please.
Yeah. Okay, so it was kind of like that $25,000 point was like a psychological level
Completely.
for you in some ways.
Oh man, I think I still have nightmares about it, even though it's not really a problem for me anymore. Just an old nightmare that won't leave me alone.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So what did your partner and your friends think about your trading efforts during this time? Like, I presume it probably came up in conversation as you're talking about your friends. Your friends might ask you, how you going with, how's your trading going? You know, you've been at it for a while now and, you know, you can't really say like, oh, I'm making much progress. What did they kind of make of it? What did your partner think of it? I'm keen to hear.
So I wasn't too... I was doing really well with my business on the side, well enough that I could fund my accounts. And because I kept my size in check when I was trading, it was just a slow bleed over time. And even though I was bleeding out for 7 years, it's not like I was taking, 20% hits of an account on a single trade or anything, So I was always around, I was always just trying to figure it out. I had deep deep aspirations. I had passion for the markets. I knew one day, I hoped one day, I mean, I'd figure it out, and I would rise and stand up, you know, and banish all these losses I've had, and figure out what I was missing, and find that holy grail, you know, that I've been looking for, and just always consider myself an intelligent person, and I love solving problems and puzzles and whatnot, and I've just always been mesmerized by the stock market, and just drawn to it since I was ever exposed to it. And I just always thought I could figure it out. So when friends, you know, girlfriends and whatnot at the time, and friends of mine would ask me, "Hey, how's it going?" You know, man, I just tell them, this shit's tough. You know, it's like the problem was I told them all my first year how great I was, and I was so proud of myself for my success for my first year. When they kept asking me later on, "Hey, you know, how are things now?" And I was going, "Well, you know, I'm getting a reality check. I'm basically getting my ass handed to me, and good thing I'm keeping my size small, because if I wasn't, I think I would have blown up by now, because that was definitely the course I was on." And seriously, the only thing that kept me going as long as I did was minimizing my size, just knowing I didn't know. When people ask me, I always feel good. You know, being happy is a habit. I try not to let the money affect me, but it's hard losing money for 7 years on something you're so passionate about. So when someone tells you that's close to you, "Hey, how's it going? How are things?" You know, I'd love to tell them, "Hey, things are great," but you know, instead I just smile on my face that this is hard, and I'm determined to figure it out. But as the years went on, yeah, I definitely started doubting myself. You know, maybe this isn't for me or whatever, but I pulled through. You know, I was just honest with people when they asked. I don't think anyone was worried I was going to lose all my money. Not that I had a ton of money, but I think everyone believed in me around me, and that helped me keep doing what I was doing too, even if I was losing money.
So speak to us about that doubt. You know what I mean? Because I think there's a lot of us who do experience some doubt, especially when we've been sort of chipping away at this for a few years, and it feels like sometimes we're just spinning our wheels. We're not making a great deal of progress. How did you overcome or push through those doubts? Like, what kind of kept you going?
I think I had hope from the periods of profitability I would encounter. I just, something inside me said there's got to be more to that than luck, and I just got to figure it out. Like, there's got to be more than just luck to that. And I mean, if it was just luck, then fine. You know, why am I even doing this? Because I'm proving that if it was luck alone, I'm losing money more than I'm making money. So, but I think that's what, even though I'd encounter those doubts, that's what held me together. It was my, you know, determination, perseverance, if you will. But I was just convinced it had to be more than luck. You know, poker is a game of skill and luck. It's got both factors, and I definitely today think that now more than ever about the stock market. But back then, I was just hoping it was more than luck. And the glimpse of that was those periods of profitability I would hit. And when I'd hit them, I'd love them, and it'd feel great. It was just unfortunate that my poor habits would basically, I attribute to the inevitable drawdowns returning.
Yeah. So what do you think were the aspects of trading that you found most challenging to come to grips with?
Just, man, it seemed like no matter what, like, it was really hard for me to understand. I'd learn patterns. I love patterns and whatnot, but I'd learn a pattern and I'd see it work. I mean, obviously nothing's going to work 100% of the time, but to see a pattern that looked like it would succeed, and it was the same, looks like a similar setup the past 10 times I'd seen it succeed, and then to have it fail, that was really hard for me to accept because I wanted it to succeed, because I wanted me to succeed. And I think I was just pressing a lot of beliefs onto, you know, a lot of hopes into what I was doing instead of being more of an observer and more objective and taking a step back. I was much more forceful trying to make things work. And there's a lot of aspects about trading that are challenging, no doubt.
Yeah, so if I was to kind of summarize what you said there, it sounds as though you were trying to trade what you wanted to happen instead of trading what was actually happening. Like you were trying to sort of push your beliefs onto the markets, and override what was actually going on. So let's cut to more recent times now. I think we're going back about 14 months or so now. And obviously, for anyone who's listening to this sometime in the future, we're recording this September 2015. So what was your turning point? What changed that you were able to go from a losing trader to a winning trader? What was significant about what was a significant change in how you approach things?
Okay, great question. First, I may have misheard you, but I think you said 2015.
God.
We're recording this. I just want to be clear. 2016. I might be wrong. I may have misheard you, but
you didn't mishear me. That's quite embarrassing. Yeah, that's.
No.
Maybe I wish it was 2015 still.
Embarrassing is losing money for 7 years straight and not doing anything different.
Sure.
To answer your question, what finally made me flip the switch? After about 8 years, I reached the end of I couldn't take it anymore. And I just had a serious sit down talk with myself. Might as well have been looking in a mirror. And I was just, hey man, I've been doing this for 8 years. I am sick and tired of adding money. I'm sick and tired of taking money I worked for on the side, income I make, and depositing it, adding it to my trading accounts, and just slowly losing it over time. It's not sustainable. I need something. I need to prove to myself that, hey, yeah, it's great to be passionate about the stock market, but man, I need to see some serious results and prove to myself this isn't just some pipe dream that isn't ever going to happen, and that I am able to do this. And man, Aaron, I wish I would have done that years and years before I did, because that was the catalyst for all my major changes to lead me to become a consistently profitable trader. I mean, there's so many things. I'd say all of these are factors, but it's hard to say any one of them was. I mean, they're all to different degrees important, obviously, but it's hard for me to pinpoint the most important ones. But 2 years ago, I went full time, so I had a perfect environment for trading stocks. I had no competition from work, from anything. So I was in charge of my own schedule, so I could be there when the stock market's open. I'm trading stocks. I had my full attention. I didn't have any competing forces. That was major. So all those other 8 years, I was trading part-time, trading at work, trading when I shouldn't have been trading, and it hardly ever worked out well, unless I got lucky. But so going full-time 2 years ago was a big deal. Not only that, this is surprising though, but I've always been actually a really private person, and I've never really been on social media. I've never had a Facebook account. I still don't. I've never had a MySpace account. I've never had LinkedIn or Instagram or Snapchat, or I don't know, all the crazy kids and what they use today. I don't do any of that stuff. And so all those 8 years I was trading alone, and I was by myself, and I had basically no one to compare myself to. And that created an environment for me to just float around and go nowhere, or even a little south, because I lost money for so long. Once I discovered Twitter, oh my gosh, that just changed everything for me, because I got plugged in, man. I went from being passionate about the stock market and knowing no one and seeing what other traders were doing, to being passionate about the stock market and getting plugged in to the to Twitter where all the traders are, and I could see what everyone was doing, and that just made the world of a difference, because surrounding yourself with people that are better than you is huge. And since for those 8 years I've surrounded myself with no one, that's a factor of why I went nowhere. So once I discovered IU and Nate, and I learned about shorting. I mean, for those 8 years I traded, I was long only. I knew about shorting at later on, but I didn't even know you could short cheap stocks, low price per share stocks. I just kept going long, bad habits, I guess. Once I discovered IU and, hey, there's multi-millionaire traders in this chat room. Wow, let's see what that's about. So I got plugged in there, and I just started watching what other people were doing. Between IU and Twitter, man, that just really gave me the social connection to other traders where I could thrive, because I'm a competitive person myself in a good way, and I think competition brings out the best in some people and the worst in others. But for me, I think it brings out the best in me, and I don't know why I went 8 years trying without any competition. But once I was able to surround great people around me, then I was able to start asking myself, hey, these guys are humans just like you. What are they? Why can't you do what they're doing? Not that I'm a multimillionaire trader, but they're consistently profitable. Why am I not consistently profitable? Like, it's not like I have worse luck than them. I mean, we're all getting the same luck in the market. Like, it's the skills. Like, what are they doing that I'm not doing, or what are they not doing that I am doing? And that was a big factor also.
Okay, so I mean, there were a few things which had a big impact on your own trading. So, they were your working environment. You went full time into this, so you weren't competing with your day-to-day job. You kind of reached a snapping point, and you had a big mind shift, and getting plugged in with other traders, like meeting others who were doing what you wanted to be doing and were better at it. So, no, that's really cool. Now, I do want to ask you, how did you prepare to go full-time trading? Did you have a significant amount of savings? Did you cut down on how much work you were actually doing, or did you just straight up close the doors one day? How did you actually prepare to go full-time trading?
So I actually still own my business. I just am not trying to grow it like I used to try and grow it. It is big enough that I am comfortable, and I can choose my own schedule, and I decided I no longer want to work on site. I want to work from home, and so I just do my own thing at home on my own hours, and that gives me the ability to trade as I please. And that was a big deal. So yeah, I do have savings. I do. It's that definitely helped also making the switch. But just being in charge of my own thing. I mean, that's really it's tough to beat that kind of freedom, and I feel very fortunate to have it. I really do.
Let's move on a little bit. Let's talk about how you're actually trading today. Let's dig into your actual methodology. So, how are you trading today? What is your approach, if you had to define it for us?
So I love shorting. I'd say I'm 90% a short seller, I think. I'd guess about 10% of my trades are longs, maybe less. And my ideal short is what they call flying pigs, junk microcap companies that are starving for cash, laden with debt, they're just terrible companies, and they're hurting, and they're forced to do dirty things to raise money. And when they do those dirty things, like put out fluffy PRs, and you get these stocks gapping up, 30, 50, 80, 100% or something silly, whatever it is, I'm highly interested. Those are great things. Good opportunities there.
So how do you find these junk stocks, as you call them?
I find them every morning by just looking at what's moving in the market and pre-market. What's gapping up? What volume breakouts do we have? What stocks are up today on more volume in pre-market than they've had for the average volume the past 20 days, month? Is their volume in pre-market up 400% from there? Well, I want to know about it. But it could be even much more simple than that. It could just be high a day gainers list in pre-market. What's flying high? What's flying high this morning?
Okay, so you said a little bit just before your ideal short setup or your ideal short stock that you would short would have some sort of fluffy PR around it, or they've done something sketchy to try and raise the price of their stock. Looking at your pre-market gainers list and that sort of thing, that's obviously looking at the price. Do you also need some sort of story to support this?
Sure. So as I encounter what a lot of us call pigs, I have a pig list, which is just a watch list I've titled pigs. And I recommend anyone that's interested in shorting pigs do this if they're not already doing it. But it's a very simple idea. Probably a lot of people are already doing it. I don't think I invented it. When I encounter a pig, I add it to the list. And over time, my pig list grows. Right now, I think I have maybe a little more than 200 pigs in my list. And this makes when they run in the future, former runners. So as they tend to pop up, a lot of traders know how they traded in the past. I always have my pig list up, sorted by net percent change on the day. And as something starts flying, if it's on my pig list, I already know I'm interested in shorting it. I don't have any homework to do. I don't need to go looking at the SEC filings to see what's going on. Although, I might look up at the headline to see, okay, well, why is it moving? I definitely want to know why it's moving today. Is it up? Is it up on nothing? Is it just up because traders are just buying it up? It's just chasing it up because it's low float, or is there some kind of fluffy PR? Is there some kind of, or is there an SEC filing? What's the reason it's up, and try and understand why it's up. But as long as it's on the pig list, I know I'm interested in shorting it. Once they start moving again, it's just a question of when and at what price.
Okay, well, that's the next question I want to ask you is when do you actually go short? So obviously you're identifying these stocks pre-market, which are significantly above the close of the prior day. At what point are you looking for a short opportunity to actually enter?
Yeah, so, ideally, I'd probably be waiting for the backside, for it to go as high as it's going, and then for it to, if it's going to fade off, or if it's going to snap VWAP or crack or whatever it's doing, high a day rejection, stuff off the high, whatever it is, and then just get in there, because that's typically much safer water to jump into for the short seller. But it's not to say I don't like a thrill, although that might be ideal. I tend to start shorting on the front side, which is definitely a lot harder than shorting the backside of the move. You're basically stepping in front of a train, and you don't just wish for the best, but you try and identify where you think it might top, or at least that's what I'm doing. And I'm just trying to read the chart, the volume, see how it's responding to VWAP, and make an educated guess.
Okay, so like you said, it could, some people might interpret this as standing in front of a train.
Oh, definitely. Momentum is dangerous if you're a short seller.
So how do you manage your risk in that case? Because I imagine, if you time this wrong, you could be very wrong very quickly. How do you go about managing your risk?
So part of it kind of goes back to that similar answer from how did I lose money for 7 years straight and just was still alive to keep being in the stock market. And for me, it's controlling my size. I'm not a gunslinging cowboy. I don't size up. I'm not throwing size around like a lot of other traders do. And I'm not saying that's bad that they do that. It's just, for me, I still have a lot to learn about trading, and I'm always going to be learning about trading, but I still have a lot to learn in the sense that although I've learned incredible amounts more than I used to, enough that I feel comfortable, I can step in front of on the short side or on front side and get short. I'm keeping my size controlled so that if something rips against me and goes, just ridiculous, parabolic or something, I'm not sitting in there with my entire account sweating bullets now, because I'm definitely not trying to put myself in very, very bad situations like I used to do, and I'm much more aware of that. So yeah, controlling size is definitely my answer. So scaling helps. If you're a one bullet shooter, it's kind of hard for the guys that are under the pattern day trader rule, because they can't scale, because they got one shot, or two shots or whatever, however many bullets they got, and that's about it for their, for a few days until they get their bullets back to take some trades. But scaling and controlling size is how I stay safe.
Okay, and on any given trade or short opportunity that you've identified, how many times are you willing to be wrong before you let it go and just move on? Like if you get in and, let's say you have a stop higher up that gets hit, taken out, you're out of the market, do you attempt to go short again X number of times before you just leave that alone?
Yeah, I used to not do that. I'd try it once, maybe twice, and then if I hit, if it got to my risk level, I just took my loss. And then it seemed like inevitably it would finally do what I wanted it to, and I was just watching it, not participating, and I'd go, man, should have taken it again. But some stocks are very, very, very difficult. I'm sure a lot of traders have the same thoughts. You have an idea on it and you take it and it didn't work, you take your loss. And then you could try that. In some of these stocks, I swear they're doing it just to mess with you. And you might try it, 4, 8, 12, 15, 15 times, and you're just exhausted taking small losses on it. But, then you get easier ones that they just crack, and you just get in there and you just hold on for the fade and you get paid. There's all kinds of different animals in these charts, and there's so many different types of plays too. It's just a lot of patterns and a lot of opportunities to make use of.
Okay, so just slightly changing the subject, looking at your Twitter feed, it's clear to see you're massive on documenting your trades. I don't know if you've always been this way, but what exactly do you do? Like, what do you go through and how do you document your trades?
Sure. So when I finally reached the end of my rope and was like, I need to see some results in my trading because I've just been losing money for so long. Part of that was I realized that, you can't improve what you don't measure. And I think some people will argue, well, your account balance is what is the metric. That's how you measure. But for me, I needed something more than that. And I started tracking my P&L. And to not be that degenerate gambler who's just pulling the handle on the slot machine time after time after time again, even though it stops work, even though it's not working, I wanted to start tracking my journey and see what I could learn from it. And it seemed to me from some of the books I read that, tracking your equity or your P&L curve is a good metric of how you're performing. So I thought, wow, that's interesting. I haven't done that for 8 years. Maybe I should start now. I'm trying to make big changes to make this trading thing work. I should start doing that. So I got a Twitter account and I said, all right, man, everything, whatever I trade today, I'm going to put it on Twitter for the world to see. And it's not really so much for those people, for everyone to see. It was for me. It was for my own benefit, to help me stop being a degenerate gambler in that sense, and to be more responsible and to hold myself accountable for my trading decisions each and every day. And that helped me get a handle on my overtrading. That helped me get a handle on my being impatient. That helped me get a handle on becoming consistent. It helped. There's a lot of people that don't believe in posting P&L. I'm pretty certain I'm outvoted. A lot of people don't think it's a good thing for the trader to do that. Me personally, I so firmly believe, for me, that it was a factor, and I even think to say a large factor, in helping me go from being a losing trader to a consistently profitable trader. Because the amount of accountability and feeling of responsibility that it provided me, thinking that all these other traders were looking over my shoulder. Not that they were, not that I had all these followers or anything. I mean, I didn't have any followers when I first started doing it. But again, I was doing it for me, not for other people. It changed something in my head. And I started making much better decisions when that was definitely a factor to me making much, much better trading decisions. Kept me from being reckless, because I was very easy to be reckless for a lot of years. I could go from zero to reckless extremely quickly, and I don't do that anymore at all. I try not to.
Yeah, I like what you're saying there, because when you do post, your P&L, and when you are, not so much that, when you do have that accountability, I mean, it's very easy to lie to yourself. As much as you don't want to do it, it's very easy to do. But when you've actually got, like as you described it, there's someone looking over your shoulder, that accountability and actually having to lie to someone else is very difficult, or for most people anyway. But I just want to throw in there, actually, measuring your P&L, I think, is probably quite effective when you're at least a profitable trader. When you're not a profitable trader, up until that point, it can be quite difficult to measure your success in terms of P&L. And Futures Trader 71, who was on episode 82, has a really good bit about how other ways to measure your success, or your progress, I should say, besides your P&L. So if anyone wants to hear more about that, chatwithtraders.com/82.
I think I want to hear more. I think I'll be listening to that one, because that sounds great.
Yeah, he's awesome. Definitely check out that episode with FT71. He's the man.
That's cool. Yeah, for me, when I could see that I was building a spreadsheet and putting my daily P&L in it, and it would change what my P&L curve was doing, I felt like I had something tangible. Like I felt for the first time ever, I was in the driver's seat, and I was going, okay, I can make good decisions so that I can end the day in the green, and my curve will go up. And I felt like I was drawing something slowly over time each day, and kind of felt like an artist. Like I was like, wow, this is really cool. I want a really nice line. And it helped me making my decisions when I was trading and going, before I took a trade, I go, what, is this really a good trade to take? Is this just a substandard trade I should be skipping? Is this really a trade that I want to affect my P&L curve? Because if it's not, I don't need to be trading it. I'll just wait for a better setup. And that was a big deal for me.
I really like how you framed that, as in, is this a trade I want to be affecting my P&L or my equity curve? I think that's a really good way of looking at it. That's cool. So just to wrap this up here, what suggestions do you have for traders who are just starting out today? If there was just maybe one or two things you could share with them, you've already shared a ton of great insight, but just to wind things down, one or two things to take away, what would you suggest to them?
We just got done saying it, but you can't improve what you don't measure. And for me, that was creating a P&L curve and tracking my daily P&L, along with some other stats that I've included also. But the other trader you mentioned had some good ideas you said about for beginner traders or struggling traders for tracking and measuring, some kind of metrics that they're using. Whatever it is, take a scientific approach and measure what you're doing. Please, if you're not, I really think it can help you gain insight into what you're doing and why you're doing it. That was a big deal for me. Another thing is habits. I'm a firm believer in, good trading is synonymous with good habits. And when you have bad habits, I had bad habits for 8 years. And it was very hard for me to unlearn those habits and create better, good habits. And if you're just starting out, it's great because you can start out from not having bad habits and you can develop good habits from the get-go. But if you've been struggling a while, identify what you're struggling on. Are you overtrading? Are you impatient? Are you just gambling? We all have the same problems. It's just identify what you're doing wrong and what they often, it's very common to say a chain is as strong as its weakest link. Find your weakest link and focus on it. Pick on yourself. What can you do to become a stronger person and a stronger trader? And lastly, I traded in solid, by myself for 8 years. I'm a competitive person. If you are too, surround yourself with great traders. Surround yourself with traders that are similar to you or a little better and like-minded. I have trading buddies I trade with, TWB 52, shout out to him, Fortrade, shout out to him. Those guys, we're like-minded people and we trade the same things. And if you're out there hunting, if you're just one wolf hunting for food, you're not going to eat like you are if you're out there hunting with more wolves or another wolf, or you have a team of wolves or a pack of wolves that are like-minded and are looking to feed on the same thing. So, connect with other people. Find people that are like you and see what you guys can do. It's the Boy Scout system. I used to be a Boy Scout. I don't remember what it is, but have their back, and they'll have your back, and try and keep each other out of trouble, and just do your best and always learn, man.
Good stuff. Good stuff. Nico, where is the best place listeners can go to find out more about you?
Right now, it would probably just be I guess my Twitter. So at inefficient MRKT, and that's my Twitter handle. I think I'm going to start a blog though, because over the past 14 months, I've had a tremendous amount of people ask me for my spreadsheet that I created where I track my stats and my daily P&L and my P&L curve. And I think I'm actually going to be releasing it very, very shortly into the wild for everyone to use, because I know a lot of people use TraderView, I think it might be called. I think it's free. Anyways, I don't know much about it, but if there's a lot to be said for just whatever it is. If you're using TraderView, great. If you don't want to pay for a service like that, I got a spreadsheet you can use. If you like what I'm doing, you could modify the spreadsheet however you please. And, I'd love to I've gotten an extreme amount of support from a lot of people for what I've been doing for the past 14 months. And I just want to say thank you guys. And hey, if you're not consistently profitable, I'd love to help you as much as I can. Send me a message.
Very good. So at Inefficient MKT on Twitter. That's it, right?
I think it's MRKT.
MRKT. Okay. Mark it without the vowels.
There you go.
Cool. All right, man. Well, I'll put a link to that in the show notes. And probably if anyone wants to get that spreadsheet that you're going to be releasing very soon, probably the best thing to do is follow you on Twitter, because I'm sure you'll put the word out then when it's available, yeah?
Perfect. Absolutely.
Cool. Well, Nico, I just want to say thanks a lot for coming on the podcast, man. I appreciate it.
Aaron, thanks for having me. I'm honored. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What is happening, team? Thank you so much for joining me. On this episode, I have our very first guest from China, Derek Wong. He is the Director of Systematic Trading and Options at a private fund in Shanghai. Initially, though, Derek got his start in the agricultural pits at the CBOT. Then following on from this, he's worked at various quant shops in Chicago, South Korea, and nowadays mainland China. After discussing Derek's backstory, we talk emerging markets, cultural differences of Chinese investors, convergent and divergent strategies, diversification, and some slightly unconventional ways of thinking about how you trade. Derek also has some awesome insight for traders who are discretionary and what traders should focus on once reaching profitability. I thought Derek was a really incredible guest, and I hope you get some value from listening to this episode. One last thing I do want to mention, and that is Derek has very kindly offered to answer any trading questions that you might have. So if you've got a question that you want to ask, just go to chatwithtraders.com/97, scroll to the bottom of the page and write in the comments area for a response from Derek. All right, that's all from me. Let's get into it. Derek, how's things? Good day for you?
Yeah, it's actually quite a good day. I can definitely say that. So today we hit our yearly target for the fund, actually. So it was quite nice.
That's very cool. Nice to hear. Congratulations.
Thank you.
How do you go about setting those yearly targets?
Actually, it's by our mandate and the CIO. So based on that, we look at what departments, what teams can contribute what, and then so we look to mix those teams together. So my team's target has been met, other teams may have not been. So we're kind of like siloed out, if that makes any sense.
Okay. So what does that mean sort of going forward for the rest of the year? Obviously, there's still, like another 2.5 months left?
You can consider it like we are in kind of take profit mode, if that makes any sense. So we've reduced our leverage, we've reduced our volatility, and we're trying to hover around this area for the remainder of the year.
Okay, so you're not like trying to push harder and really take it as far as you can. You're sort of being a little bit more conservative.
Right, because how our products work is we do have some guaranteed products that we need to make sure that we can deliver on that annualized return. And then we also do just a profit split. So I need to make sure that I can cover those costs and give that guaranteed returns to investors, as well as, have the other party who's doing profit split be satisfied as well. So right now we're kind of in that happy medium. I would like to kind of cruise out, basically window dress for the rest of the year.
Okay, cool. Well, like I said, man, that's really good news. So congratulations. And I'm really excited to have you on the podcast because you're actually my first guest from China. But if I understand correctly, you haven't always lived in China. Is that right?
That is right. So I'm born in Chicago, and I started my trading career in Chicago in the pits at the Chicago Board of Trade. And I always had an Asian leaning. So as I worked through different funds, and then I leaned over to South Korea, did a little bit of work there, and then eventually made my way to mainland China.
Yeah. And we're going to get right into that. But I mean, first of all, how did you actually become involved with trading? Because I know you were originally studying to be an engineer. So, how did this all sort of play out?
It's actually an interesting story, or rather, I was picking up the scraps. So my brother was offered a job to work for a friend of his father down at the Board of Trade, and he didn't want the job. So I ended up taking that job, and I said, hey, you're not going to do it, I'm going to do it. And that was it. I took the job, I interviewed, and, however that's going to be, and I just started, clerking and running down in the pits as electronic really started to make that transition in the early 2000s.
Okay. So what was your job specifically like as a clerk? Like what sort of things did that involve? What were you doing like each day when you showed up?
Okay, so each day, we were basically filling institutional order flow, and we had a couple of traders as well. So what we would do is we would look at what our clients wanted to trade in corn. It was our major pit, soybeans as well, rough rice, and the ags. So we would look at, the previous day's activities, what orders were sitting in our book, what we looked like to fill. And, we looked at seasonality. We were looking at, what kind of volumes we were expecting and how we were going to get that out there. And then basically just, filling, fairly large orders for these people, for these institutions and commercials for hedging or, trading purposes. And so we had one guy who had a big Palm Pilot, I guess you could think of it like that, or a big iPad type thing who could do electronic. And we had a couple of people in each pit that would fill by hand. So we had a mix of electronic and we'll say pit traders, and we could work the orders either side to fill their orders coming in over the phone.
Right. So if I understand this correctly, you were filling large institutional orders. So pretty much they would say, we want to buy X amount of whatever that might be, and then it was up to you to try and get them the best price on that order. Is that correct?
That is correct.
Okay. So how did they measure that? How did they sort of gauge whether you were successful in getting them the best price or otherwise?
Well, they would measure us by how the market had moved. I mean, back then it was still pretty slow. Not a lot of people had as good of tick data as we have now. So we're looking at average prices during the day, the settlement price, because it might take us a couple of days to work the order, or they might have certain conditions that needed to be met. So those were different benchmarks. Every company would give different criteria that they were looking to have executed against. And so we would look at that and say, okay, how can we best, suit their needs of the client?
Okay. So how long were you working at the Chicago Board of Trade for?
For 2 years.
Right. And then what happened from that point? Like, where did you go from there, and why did you decide to leave?
Right. So then that was still when I was quite young in university. So after that, I ended up going into the family business a little bit, and then transferred back into trading. So kind of a roundabout way. I'm the oldest son. So in a Chinese family, it is my duty to kind of take hold of the helm of the family business. And I tried to do that, but it really wasn't my thing. So I ended up using those previous connections I had built from the floor. And actually, I went to school with quite a lot of traders. My friends' parents, I didn't realize it until after that they were a lot of traders, a lot of people at the Board of Trade, Board of Options, stuff like that. And so I kind of used that to lean into it. And that allowed me to use my engineering experience to start to do programming and analytics on the more quant side. So I joined a small fund who had systematic trading strategies. And so that's how I got into the quant side, because using that engineering background. Does that make sense?
Yeah, no, it does. So, I mean, I'm just curious, what was the family business?
Oh, we were import-export and in beef. And so it's still physical commodities, but the actual cash business. And so we did have a seat on the exchange that would do the hedging. So I moved back to the physical side of things. So it was same value chain for a producer, but I was the producer instead of the trader.
Okay, I'm with you. So tell us a bit about the quant fund that you moved into. What type of strategies were they trading there, and what was your role more specifically?
Okay, so my role there was junior quant strategist, I guess would be the way to put it. They were a multi-strategy fund run by an ex-Merrill Lynch guy. He had previously worked in Japan, launching a desk there, and came back to the States and was doing a stateside fund. And so what we were doing was we had some PhDs, and we had 300 trading strategies, and it was just a multi-strategy, and we were trying to see how we could fit that together to trade the US and then still keep it leaning towards Asia, which is how it evolved into going into South Korea.
That's crazy. 300 strategies. Is that normal?
This is where I really learned how to manage, analyze individual strategies and then manage them into a single portfolio. And so really that kind of developed into my philosophy that really got baked into me really early, thinking about more than an individual strategy, more than just how any one strategy works with another strategy, but thinking a very 30,000 foot view of how to think about running a fund based on strategies, right?
Yeah, and I mean, that's something I really want to pick your brain about as we get a little bit deeper into this, because I know that's something you're very big on, is the multi-strategy approach. Going into this quant fund, did your engineering background help you? To what extent was that beneficial?
Okay, so actually one of my final projects, this was almost 10 years ago, more than 10 years ago, was doing self-driving cars, the logic for self-driving cars. So what we were doing was we were scanning the roads and taking input from, the white lines on the road to make sure a car could stay inside those lines and predict collisions. So by having that understanding of logic and, seeing, okay, if this situation, what happens, and programmatically working out a lot of different edge cases, that allowed me to transfer over quite well to the trading side of things, because I understood, this thing is going to be automated. It's already running by itself. How do you make that run, as well by itself that it can do? And if some unexpected situation comes up, like an unexpected collision, how is it going to react in those cases? So when I went to the trading side, it's the same thing. So you have a system, right? It's going to automatically trade by itself. When an edge case or high risk or high volatility point comes up, how is the system going to react? Is your automated car going to react? And I think that it was quite a very easy leap for me to go there and still to apply scientific process and engineering problem-solving mentality to the problem.
Okay. And going into the quant fund, previously you were trading you were a clerk on the Chicago Board of Trade, on the floor. Did it require much of a mind shift from doing things that way to actually working in a quant fund that was sort of juggling 300 strategies?
It was a bit of a shift, but a lot of people in Chicago come from the floor. So a lot of people made that transition and then went upstairs. So a lot of the analogies that I had are that basis of understanding. They could communicate it to me. I think it's a much different environment, say, in London or some other place that might not have as a strong pit structure. So those guys, I think it would have been a much more difficult transition. But because I was surrounded by guys, or the upper management was or had the pit experience, they can make a lot of analogies. So it was really transcribing down what their strategies were or what they had felt worked over the years, and then adding this level of engineering on top of that, or statistics and mathematics built around what they already knew worked. So they already had several strategies they had been trading for 10, 20 years. They wanted to make that programmatic and then use engineering and mathematical principles to verify or validate those strategies.
Okay, yeah, sure, that makes sense. And your role there as a junior quant strategist, what sort of things did that entail?
Honestly, it's just a glorified intern. Okay. I just watched a lot of the other guys, what their ideas were, watching their process, debugging code, because I had already knew how to code in C++, so having a coding was definitely important. I also could understand the formulas, the mathematical formulas that they were using, and so just being a sponge, man. I just learned as much as I could and figure out why were these things working? What was the analogy between the pit or the market and what this trading strategy is trying to accomplish? And why is this phenomenon they're targeting something that we believe is profitable?
Mm-hmm. Okay. So, I'm not sure how long you stayed there for, but what brought you over to South Korea and China? Walk us through that stage.
Right. So, like I said, a lot of these guys, well, actually the boss, he was in Japan first. So a lot of emerging markets, and I'm Chinese American and he was Japanese American, and the original guy I was working for on the floor was Korean American. So we had a lot of Asian influence there. And there is a big difference between emerging markets and, we'll say, mature markets. But for trading strategies, automatic or algorithmic trading strategies, you require a certain level of infrastructure to be in place. So earlier, say early 90s, late 80s, Japan was that type of market. They had the technology infrastructure. They had that type of thing. You could go do that. Then South Korea came online. They had electronic markets. They had futures. They had options. And then China is the next progressive step, because in emerging markets, there is a higher signal-to-noise ratio and a higher, usually, propensity for, we'll say, retail traders, less institutional, less HFT, less well-established players that have high amounts of infrastructure. So you can reduce your competition and increase your profitability by being able to navigate inside of those markets with strategies and technology and process that you have already developed, say, in the States. So I saw them do that progression, and so coming to China for me was just the continuation of that type of thinking. And I have done some quantitative research on this that you can look at price series and see that there's a lot more dispersion in, say, China versus the US. And in China, the stock market is, I'm going to say rough guess here, 80% retail, 20% institutional, while, say, in the States, it's the absolute reverse. So if you can imagine walking into a market that's like that, you can understand why it's such a tempting offer.
Yeah, okay. So, I mean, that's a really interesting answer, and there's just a few things I'd like to ask you around that. So, I mean, first of all, would you mind just explaining and just really clarifying, what do you mean by emerging markets? Like, what defines an emerging market?
So I guess I'm not using a traditional economist's view of an emerging market. I want to say financially developing and we'll say, securitization of certain financial products. So there is becoming to be so China is interesting because its economy is the second largest in the world, but their financial system has not caught up to, say, be the second most developed financial system in the stock market, in the futures market, in the options market that is equivalent to that, right? So you can look at many other countries that have a smaller economy but have a much stronger financial system. So it's not the economy part I'm looking at, it's at the financial system part. And so for there, say, the development of new futures or new exchanges or stock markets, things like that, that's the kind of development I would like to see. So another example of this would probably be India. Would be another great example of this type of emerging financial market. They have been a very strong emerging economy for over a decade, but I would say that their financial market and securitization of financial products has come to light probably in the last 3 years, where it's quite good to trade, where they have developed enough infrastructure, where you have developed enough liquidity, where there is enough institutions in the market and enough trading in the market to make it worthwhile to trade and not completely bonkers, but not so much so where it's become like the US or Europe, where everything is, highly efficient, high amounts of HFT, high amounts of, say, quant funds or, investment banks or things of that nature.
Okay. And you brought up a point about signal to noise ratio. What does that refer to?
Okay. So from, we'll say, engineering standpoint, we're on this call, right? So there is some noise in the background on this Skype call, but how much of the sound that is coming through your system is my voice, and how much of that is white noise or lag from the internet or other types of latency or, resistance coming from the wires of our, different setups. The greater the signal is, the clearer you will hear my voice. So any strategy is also trying to capture a signal, whether that's, we'll say, trend following, or a mean reversion or a carry trade or whatever. There's some signal you're looking to capture. How strong is that signal versus the background noise of what's going on in the market, and how easy are you able to discern one from the other?
Right. That's a really good analogy. I like how you did that. Very good. Now, the 80% retail versus compared to 20% institutional in China, why is it that way? I mean, do most funds in China trade US markets? Like, why is the ratio split like that?
Well, no, they do not trade outside markets because of the RMB exchange. So they have a certain quota that every Chinese national can do per year, which is not very large. And they don't have floating exchange rates. So that does put a crimp on how much they can trade abroad. So they're limited only to the domestic markets. Also, hedge funds, investment banks, a lot of that stuff is quite new. So it's not. Also, a lot of it is fraud or shadow banking, or there's a lot of guaranteed products that it's going to get you, 12% a year or something like that on leveraged properties or some crazy, insane products. So a lot of people are savers. They save the money and they manage it themselves. And so they're going to go out and buy houses. They're going to invest it in the stock market. They're going to invest it anywhere they can get a return, but they're not putting it in an institution like we would in the States with a 401k, or put it into like a Vanguard ETF or, SPY or something like that. They're out there investing in stocks themselves. And there's a huge population doing that. So that really causes that percentage ratio.
Okay, so probably a good portion, 80% of the retail, a lot of them are mainly investors and not necessarily active traders. Would that be a fair assumption?
Oh, no, they are active traders. They are 10 times more active than any American. Their average trade might be less than a week. Their holding period, 3 months, is long term. If you told someone you held a 3-month trade in China, they're like, wow, you must have made 100% on it or something. Like it must. That's not the type of thinking. It's just a totally different type of thinking and culture and background of the retail and the institutional here in China. I mean, it's quite a different perspective on things.
That's so crazy. So, you know that common thing that you hear floating about is 90% of traders fail. How does that sit in China? Like, do most people, like this 80% we were talking about here, do most of them do fairly well?
Okay, so in a bull market, everything is easy. China has been in quite the bull market for a very long time, so people are used to making money. After the stock market crash, I would say significant people took a hit. So I just talked to a coworker of mine last week talking about this. We trade mostly futures, so I can give you a better perspective on that. We were discussing the differences between, traders, both non-professional and professional traders abroad versus here. And he said in China, it's 95% of people fail for the retail area. So actually, it's a higher percentage of people are failing here because a lot of them trade rumors. A lot of them have, listened to gurus on TV. There are guys drawing charts and technical analysis, telling your grandma how to take a trade in her retirement account. I mean, it's wacky, man. I don't know. I cannot. If you have never seen it, it's hard for me to explain what it's like, but it's definitely a lot of retirees probably got very much hurt in the last year.
Yeah, it's funny you mention that actually, because I remember reading an article a little while ago now about, I'm pretty sure it was in China, and there was like a soap opera on TV, and they mentioned a company, and that company did something which would be interpreted as being good news. And this was only in the soap opera, like it was all made up. It was just acting. And that company's stock soared over the next week after that episode came out or something like that. Like, is that the sort of thing that happens on a regular basis?
Absolutely. The virality of news in China is extremely fast. So we have WeChat. For people who don't know, it's like WhatsApp, but for mainland China. And there are tons of investment groups, private ones, public ones, whatever. Someone makes a recommendation who's got, a high rating. You'll see thousands of people, buy into that. Definitely you'll have a volatility spike. Definitely you'll see the market move in a particular stock. I mean, it's no question that anything they see on TV, reality or not. I mean, if they pay these stars to wear, some clothes or some hat, if it becomes fashionable, automatically in the next 2 weeks, everyone's going to have one. I mean, just how things spread like wildfire in China, just because of the interconnectedness, I think does, play into that. And that definitely, when you think about retailers doing this, it definitely hits their psychology. I mean, if you imagine how retailers think, and you imagine how some of these people don't have a trading or financial background, and they're out there trading their own money, they're going to be hitting with these swings. So you compound the huge amount of connectedness with trading psychology, and you can imagine why the types of moves you see in the Chinese market exist.
Yeah, it's fascinating, isn't it?
Yeah.
Let's bring this forward to current times now. Bring us up to speed with what you're doing today.
All right. So today I'm working at a fund called Fortrade Investment Management Co-Limited, and we are a investment arm of a Shanghai-listed company. And for us, we are a private fund, and I am the director of systematic and options trading. So what I do on a daily basis is just trade a portfolio of algorithms that fit, like I said earlier today, our mandate and our target, and use a variety of systems and control my portfolio in such a way to generate a product that will satisfy those investors' needs.
Okay, so you mentioned earlier that you trade futures and you've just mentioned that you trade options as well. Are they the two products that you trade, or do you also trade anything else?
No, that's all we trade. And actually in China, there's only one options contract that exists. So, and it's highly regulated. You can only have 10 contracts on. So we are preparing for that. But like I said, developing market, there are no options on commodity futures yet. It just does not exist. That is an innovation that will come out in the future. So preparing for that is what my department is, and that's my official title. But just imagine that there is none.
So the options that are available, what are they? What's the underlying asset?
It's on the stock market index. On the stock market index.
Right. So how do you use those options? Like, what purpose do they serve in your portfolio?
I'll be totally honest with you. We don't trade them. It's just in my official title.
Got it. Okay.
So when it comes out, I can trade it, right? But until then.
Right. At least it's in your title. So when is that expected to take place? Like, is that happening sometime soon?
That's a fantastic question, because we have been waiting for it for quite a long time, and it's all up to the government regulation. Everyone tells me it's coming soon or next year. But until the CSRC, which is the equivalent of the Chinese SEC, approves that and the party approves that, there's no telling. I was actually down, I want to say about a month ago, a little bit more than a month ago, talking to the chairman of the Zhongzhou exchange and other exchange officials in Dalian to try to find out what the target is for this. And, it was still up in the air. Everyone is very excited, saying it's going to come through, but there was no verifiable date for that.
Okay. Well, I bet you're hanging out for it.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let's get stuck into the strategies part. Talk to me about what are the type of strategies that you're trading at the fund. What are your algorithms doing?
Okay, so I like to think of trading strategies in 2 families, divergent and convergent trading. Most people associate these 2 types with trend following and mean reversion, but I don't think that that's such a great definition. So I would prefer to use divergent and convergent. Majority of our strategies are divergent strategies because, as we know, China is highly volatile. It does have a lot of, big moves. So we do look to capture that and then backing that up with some diversification in the convergent strategies.
Okay, so would you like to flesh that out a little bit more? Like, why do you refer to these strategies as convergent and divergent rather than trend following and mean reversion? Like, are they Are they different in some way, or do you just prefer those titles?
No, I think the definition is much better. So let me see how I can put this in a very crystallized manner. So let's start with convergent. In convergent, we believe in something, and normally that something should occur. So in mean reversion, we believe that there is some mean or some true value, and when price is away from that, it should return. So we believe in this mean or that true value as a state or a price that we can hold. And when things are away from that, we believe it should approach to that. Another good example of convergent trading is value investing. You believe that the fundamental pricing of a company is X, and if the share price is not representative of that fundamental value, then we should buy it until it approaches that fundamental value. So that is something we believe in fundamentally, right? And this is something we have researched or we have found, and we expect the state of the market to maintain that relationship. Does that make sense?
It does, yeah. So when you're talking about convergent and divergent strategies, the trend really has quite little to do with that, right?
Right. So a trend, we believe it's not going to be normal. The state of the market is not going to fit into our criteria. There's going to be some radical shift, right, that's going to happen. So we can imagine a trend as a radical shift away from where price was before, right? So that means that whatever that quote unquote fundamental idea that it was in convergent trading is no longer viable in the divergent trading, right? Because, the price has moved so far away from that. So that is where we come to the difference. Another, I guess, characteristic of these two would be the distribution of the returns for both of these strategies. I think that's a much more important thing to look at because they have opposite return distributions, and usually you'll be able to classify what type of strategy that is by looking at that, or even look at a hedge fund or a manager's or a trader's return distribution and figure out which one of these two he's leaning towards.
Okay, would you mind just dumbing that down for us a little bit about the return distribution between the two?
Okay, so if I add up all the percent returns or the log returns I generate every day, and I put that into a histogram on my Excel, it will draw me a picture, right? And so we'll say that there is a line where my average is. So we put it on the Excel and we get the histogram. If we have the tail on the right side, okay, we have most of our losses on the left side. So that means we'll have a big fat lump where we're losing more frequently, and we have a big right tail, which means our profits will be much larger than our average losses, which is a characteristic of a trend following. So that'd be a divergent. On the other side, if we had a convergent strategy, our, big hump would be on the right side of zero, right? So we'd get a lot of winners a lot of the time. So we'd have a very high win rate, but our tail would be to the left. And that means we would have a lot of infrequent but large losses. Does that make sense?
Yeah, no, that does make sense. So, I guess my next question would be, how are your algorithms programmed, or how strategy set up to detect when to trade a convergent or a divergent strategy?
That's a good question. So first of all, we need to think top level. And for the most part, when you make a fund, you're making a product. And each one of these strategies is an ingredient. Each individual strategy is an ingredient. We need to mix those together somehow, right? That mixing together, we use something called dynamic portfolio. And what this does is allows us to look at families of strategies, right? So you might have some calendar carry trades. You might have, we'll just say, breakout trades or momentum trades, or you might have, statistical arbitrage, or you'll have all these different families of systems out there, all with these different parameters. And we need to, be the chef and combine these together in such a way that makes sense for our end goal, right? So how we do that is we go through the three-dimensional diversification model that I have developed.
Okay, so would you mind explaining that model maybe a little bit more?
Right. So we know that diversification is really important. Everyone knows it's the only free lunch on Wall Street, right? So let's take that as a fundamental building block of what we're trying to do. So how are all the different ways that we can diversify ourselves? We can diversify self across strategies, right? That's one dimension. We can diversify self across time frames or parameter sets, right? And we can diversify ourselves across markets. So looking at those three dimensions of diversification, we can pick the optimal set of strategies and strategy families to make up our total basket.
I think it might be helpful if you could walk us through your strategy workflow, right? Like from how new strategies go from idea through to implementation. Would you be able to step us through that part of it?
From idea to implementation. Okay, let's see how to break this down. So first, obviously, we're going to have brainstorming ideation, right? So the most important part there is we are hypothesis-based models, not data mining. So a lot of us here have trading experience, or we have other teams to lean on for ideation, people who specialize in different areas or came from the physical. We can talk about, some idea they have, right? And from that idea, we start to do research. We will start to say, okay, there is something we want to capture. Say that's a trend. Okay, we know trends exist in this market. If they exist, how can we go about capturing them? And so that's where the modeling takes place. Then we want to say, okay, we have modeled it. How well is that model capturing that phenomenon? So how good is this trading strategy good at capturing that trend, right? Once we have implemented that, then we want to say, okay, from the retail side of things, everyone's looking for the perfect parameter, right? Everyone's looking for the optimizing on the best parameter set and saying, hey, this, EMA at 29 and, that, Bollinger Band at 32 or, whatever, find this best strategy's best parameter. I don't believe in that, because I think if you're capturing a specific phenomenon, that phenomenon is also, it's fluid. It's not stationary. So you're going to have different phases. So there might be short-term trends. There might be medium-term trends. There might be long-term trends. If I'm good at capturing trends, I should also be good at capturing trends over different time frames. Or this idea should be good at capturing them across these time frames. So I'm going to cast a larger net, right? I'm going to throw a big net out there. And I'm going to say, okay, how does this trend following strategy follow? And so I would make a family of them. I make a family of all these different parameter sets. And then I'm going to treat that family as one unit. We'll say trend following strategy unit. So I might have very fast trends all the way to very slow trends. And then I'll be looking at all of them and see how to mix them, over different periods, right? So I'm rebalancing them. I'm looking at rebalancing my portfolio using different mixes of these things, because at that point, each one of these things is now no longer a strategy. They're all a return time series. They're all an instrument. I can now invest in any of this family of strategies as if it's a stock or as if it's a future. I'll say, hey, this one looks good. I'm going to put money into it. I just went and long the strategy because I've invested money into it, right? So that's how I'm looking at that. Once I've come up with whatever my portfolio is of these strategies, and we've done our, back testing with our in-house software, then we're looking at, simulation trading, implementing that, doing some, exchange-based small money trading, looking to see what any edge cases, what do we need to do, and then ramping that up to full-on investment.
Okay, so right at the beginning of that answer, you said that you focus on hypothesis-based strategies over data mining strategies. Would you mind just explaining the difference between those two?
Sure. So a hypothesis-based strategy development means I'm coming from a research or a human idea. Like I said, I believe trends exist. So how could I go about catching trends? Or I believe value investing works, or, companies can be fairly valued. So I'm going to go about researching that. Data mining would be, okay, I've got, 200 terabytes of tick data for 100 different markets. I'm going to run as much regressions and machine learning algorithms, support vector machines, whatever you want to run on it, and say, okay, now I have some model that looks like it's going to work. So one is coming from a much more human analysis, experiential research side, and one is a lot more data crunching, and I would say much more opaque, because if I start doing all these optimizations, machine learning algorithms, it becomes less and less clear what the underlying logic or what the underlying phenomenon I'm trying to capture. It just looks like something works, something is working. So that is the differential.
Yeah, no, that's a good explanation. And do you see, listening to your answer there, it kind of sounds like you're not a fan of the data mining approach. Do you feel as though it can work and some people do make it work, or do you feel as though it's dangerous territory?
No, I do believe it works. I have used it before, but there is like a voodoo line. Okay, there is a line where you start to do too much of it. It just becomes magic voodoo where the computer is spitting out some glorious answer. For me, it's always about unraveling it. I personally, as a human being, as a scientist, engineer, researcher, I want to understand what it is we're doing. Once it becomes so opaque that I can't unravel the logic, I can't unravel what is going on, or I can't easily do it, and it becomes, overly complicated and unintuitive, I get uncomfortable. So I would say up to supervised learning is probably okay. Classification is probably okay. But once you start to go random forest, deep learning, the kind of reinforcement learning where it gets very, very deep, and you can't, there's things that are going back into the system and it's evolving so much that you can't take a step back and open the box. Once it gets to that point where I cannot open the box, that's where I call it voodoo magic,
Okay. Very good. Also, in your answer there, you talked about you want to know how well is this model capturing the trend or the phenomena. So how do you measure that? How do you know how well that's working?
Right. So actually, I generate simulated data. I start with simulation data, and we'll just keep going with the trend following method because I think everyone's comfortable with it, and I'm a big fan of trend following. So I can generate a synthetic data that has a certain amount of trend in it and a certain amount of noise. So I can set a signal to noise ratio, and I can see what different parameters, this trading strategy, and how much noise can it take? How much trend does it require? And that way I can see, okay, in this, laboratory world, in this, clean room world, it can handle this. And then I can say, okay, I want to take synthetic data based on market data. And I can say, okay, is this still capturing what I believe it should capture? Which one of these, is catching, trends? Are the trends existing? Is the correlation between these two things high? And if so, then it is capturing something. And then we can take it to real data and start the backtest, because Chinese historical data is quite limited. Some of our contracts have less than 2 years of data, so I've got to be extremely, extremely careful on how much data I use. So we developed these synthetic methods, and it actually gave us ability to control things in a much more precisely tuned manner than just backtesting on live market data, because that is always going to have some component of noise, and that noise will be changing and you can't identify it. But when I put in exactly, 20% white noise, I know it's exactly 20%. I know exactly how much it's capturing, and I know exactly how much that's affecting my system's ability to capture that, we'll say, perfect, sine wave trend, or that perfect triangular wave trend. Those are the two types of waves that we use to check for trend following. Either, a triangle wave is like very sharp at the top, and then down, and a sine wave would be more smooth. So I can create different types of trends, different types of noise, different types of these types of things, and see how they're all performing in a very, clean and controllable environment.
Okay, so 2 questions. What is synthetic data, and why do you not just go straight to historical price data? I know you mentioned there that in China, there's only 2 years for some contracts that you'd want to test on. So you've got to be very careful that doesn't straight away become in-sample data. But I feel as though there's probably another reason for this as well.
Right. So synthetic data is data you generate yourself. So I will generate a random, time series or price chart, just, use the random number generator in Excel. That is synthetic data. You just generated, 10 years of data using a random number generator. What we have done is used that in such a way that allows us to control certain parameters. So it's much like before you, have any drug, right, released from a pharmaceutical company, you're going to have different testing methods. You're going to go through these different regimes. You're going to want to have very controlled environment. I want to do that with my trading strategy. I want to control the environment that it's released into. I don't want to just throw it straight into market environment, because there might be some confounding factors in the market environment that affect the strategy, but I'm not able to unravel why that's occurring. But in the laboratory environment, where I can generate these synthetic trends and synthetic noise or synthetic mean reversion, I can control everything. So I can see, okay, this much, additional noise reduces the profit of this trend following strategy by this much. But in the market data, if I say it's 2008 to 2009 or 2009 to 2010 or any given year, that's what I can change. But I don't know how much noise was added, how much trend each year had specifically, right? And each market is going to be affected by different factors each year. So it's not as easy to determine the exact, cause and effect that I can discover using synthetic data.
Okay. It's very interesting. I'm completely new to this idea of synthetic data. I've never heard about that sort of approach or read about it before. So that's certainly something I'm going to be looking into a little deeper. How many strategies are you trading today at the fund? You spoke a little earlier about how the first quant fund you worked at was juggling between 300 strategies. What's it look like at your fund?
Yes, actually, we have quite a much smaller number of strategies here. We just started this year, so we're only looking, at about a handful of strategies. But we're actually in development right now to launch a brand new family of strategies coming out. So it's a little bit less.
Okay, well that makes sense. You're only new, so I really want to dig into this a little more about mixing strategies together. So let's just start with the basics. What are the benefits of trading a mixture of strategies?
Okay, I want to preface this with a concept that I think is really, really important. Once a strategy is made, do not think of it as a strategy anymore. Think of it as a time series or something you can invest in. It is now a security, a stock, a future, or whatever you're trading. And that P&L line, that is the price line that you're going to be trading. When you consider the P&Ls or the return series of these strategies in that manner, it makes much more sense to use diversification, because if I'm going to diversify stocks and they have their price lines, why shouldn't I diversify strategies if they also have price lines? So I think a lot of people treat their strategy, whatever that P&L is like something sacred. It's different than the market. No, it is a market. It's generating a P&L or a price line that you either want to be invested in or you don't want to be invested in, or somewhere in between. And how is investing in that, going long that strategy, going to help the performance that I'm trying to achieve? So is investing in this strategy going to help me reach my overall objective? Is that going to, whatever that objective may be? And if so, can I mix more of them together to, reduce my drawdown, decrease my volatility, decrease the amount of internal correlation I have, decrease the amount of any effect any large market shock is going to give me? I mean, there's tons of benefits, and it really increases your return, risk-adjusted return. So for us, it's not about absolute return, it's about risk-adjusted return, because if you can increase your risk-adjusted return, I can always add more capital or more leverage. So as long as I can manage that, it becomes one of the best tools you can do to easily increase your risk-adjusted returns.
Okay, then. And what are the most important considerations when combining strategies?
Well, I would say correlation is probably the most important between mixing strategies. Also, conceptually, why are you mixing them? Don't just, use some, portfolio optimizer and just finding specific values. I mean, we do that, but you want to have some logic to it. So like I said, we divide our strategies into different families. We are looking to bring these families in because they contribute in different ways, right? I don't want to just, have all of one type and none of another. I want to say for the Chinese market, I want to have a lot more divergent strategies than I have convergent strategies, because the Chinese market is a divergent market. So I can start with this kind of logical step. Then I want to say have some objective criteria that I want to, optimize against, whether that, increasing risk-adjusted returns, decreasing my drawdown, increasing my Sharpe ratio, whatever that may be, and take my correlation into account. So I want to say, okay, if I mix these together, what is the optimal mix of these types of strategies or these strategy families that will, hit whatever that target is, which is usually, risk-adjusted returns.
Okay, so when you talk about correlation as an important factor to consider when combining strategies, do you want correlation between your strategies, or do you want them to be uncorrelated as much as possible?
Uncorrelated as much as possible, just like you would want your stock portfolio to be as low correlation as possible. You want your system strategies to be as uncorrelated as possible. You also want that will probably also lead to their drawdowns occurring at different times, so then they can neutralize each other much better, right?
Exactly. Yes. I know you said that once you sort of deploy a strategy, you like to think about it as not being a strategy. With that being said, though, when do you decide when to actually add new and retire older strategies? Is that something you do in regard to the retiring older strategies?
Yes, absolutely. So we do evaluations every quarter, and we also take that time to re-optimize our weights or do, new back testing and checking with the simulation and the real trades. And there's looking at, is this portfolio what we want to continue with? Is it working? And that is all automated. So we have our criteria. It's just re-optimizing, distributing new weights to these strategies on a quarterly basis. Now, with retiring old strategies, if they no longer fit that criteria, or they're no longer giving us good risk-adjusted returns, their weights will be reduced. And if they lose a lot of money or they start losing money, the optimal allocation will be zero, right? So eventually it will retire. But there's another part I want to overlay on that. There's a risk overlay or a supervisory overlay where we're monitoring that on a daily basis, where we use statistical process control to see if these strategies are continuing to act as they should. So one is a performance-based, one is seeing, is this doing the job it's supposed to be doing? So the strategy can be turned off from either of those situations.
Okay. Now, that's a really good answer. And what software, programs, and languages, etc., are you using to do all of this? Like everything we've sort of been discussing over the last, half an hour when we've been talking about the actual strategy part of it. What are you using?
So we mostly use R, Python, C++.
Okay, so it's all sort of stuff that you've custom developed?
Yes.
Okay, so you don't use any sort of, or very little third-party software?
I don't use any like third-party retail software, but we do leverage a lot of open source. I mean, there's a lot of great open source out there in the R community, like QuantStrat, Performance Analytics, and in Python, they've got Quantopia, and they've got the Zipline backtest. We don't use that, but I'm just, for example, there's a lot of different great packages out there. So actually, we do use the Anaconda SciPy Python stack, and that's a great open source resource for us that allows us to build on that, and then all of our other infrastructure, back testing, risk control, execution is all tied up in our own in-house software.
Right. So I mean, that sounds like a lot of work. Like how much time has gone into setting all of this up, like set up your infrastructure there in regard to your programs? Like, how long did that all take? Was that just like 6 months of solid coding before you even started trading anything? Like
significant time. I would say like a team of coders is going to need 6 months.
Just sort of taking this down a level. I don't know if that's the right way to frame it, and I'm not really sure the best way to frame this question, but some of the things we've talked about here, I think to some people are going to seem like they're really advanced. Are these really advanced subjects? I mean, I don't want people to think, oh, this guy's got an engineer degree. This is well beyond me. I don't have an engineer degree. How advanced is this sort of stuff we're talking about, or is it something that you think could be picked up, if someone actually sort of committed to it and wanted to put in a bit of time and effort, it's something that could be learned?
Okay, so 100% it could be picked up. And I want to say that because I have done some trader education. So I have a group here in Beijing called the Beijing Investors and Traders Group, and I give free lectures, on trading, how to think about trading, how to trade, how to do it for the retail. 100% can be picked up. Each individual concept I've discussed today is not complicated in and of itself. Talking about trend following is not complicated. Diversification is not complicated, right? Looking at, your strategy and saying, okay, how can I make some data to put into it that would be the most 100% perfect data it's ever seen, and then from that add some random noise to it so I can see, like, push it to the limit. Definitely you can do that in Excel. It's how it has been put together that's where the complexity gets added in. So if you break them up into components and you say, okay, I just want to focus on how to do hypothesis-based systems building. So I need to come up with an idea, and I need to see how good it is at capturing that idea. That's, one block. I want to practice, building diversified portfolios. Well, I said, okay, there's a ton of books on that. I recommend, active portfolio management. That's probably the holy Bible of, the diversification. So I'm a big fan of that book. And when you look at that and it's portfolio building, you say, okay, how can I do this? And you can even look on simple websites like how to use stocks and practice just doing it with stocks. Because I remember your strategy is no different than any other time series. So if I have a return series of stocks or I have a return series of my strategies, I can practice doing it that way. So just break it down to the more fundamental building blocks and then assemble them together. I think I have given just too many of the blocks combined together. I've shown you the dish, but I haven't shown you each ingredient. And so if I just teach you or someone teaches you each ingredient individually, you'll understand how to mix them together to create that final dish.
Yeah, I think that's well said. That's a great answer. And, a lot of things we've talked about here have been very kind of quantitative based, I guess you could say. If there's just one thing from this conversation which you think discretionary traders should take away from this, what would that be?
Systematize yourself. Use research to back up your hypothesis. All discretionary traders have a hypothesis. They believe that there is something that they see or something that they understand that will have an effect on the market, whether that's a technical trader looking at a chart pattern or a value investor, doing a fundamental, or, some guy trading, an agricultural calendar spread or something like that discretionarily. There is a reason why you want to take that trade. Look at other examples of that trade, distill it to its most first principles and back test that somehow. Excel by hand is iffy because you can discretionarily leave out trades that, but just try to take a look at it. Try to take a look at other examples of that and think about what could go wrong. What are the situations, like I said, edge cases where you might not be able to capture that? And then structure yourself, be disciplined, and say, okay, this is what I believe. This is why I want to take this trade. So I'm going to execute this trade in this way every time. Reduce your own volatility. Reduce your performance randomness.
Now, when you say systematize yourself, you're not telling discretionary traders to become systematic traders, right?
No, I mean, if you say, okay, I trade only head and shoulders, or I'm a head and shoulders trader, okay, define what a head and shoulders is. Look at all examples of this predefined head and shoulders that you are committed to trading. Look at all the statistics of this head and shoulders and say, okay, this is what it is. I want to trade. Generate rules for yourself to say, okay, I want to do on this situation, I like to do this. If something goes wrong, what am I going to do, right? I want to look at, not just something goes right. I want to go look wrong, and I want to say, okay, I want to build yourself a process. I guess that's the key point. Whatever you're trading or how you came to the decision to take that trade is irrelevant. You should have a process once you have decided to put that position on and execute that process the same way, because if you don't execute it the same way, you have added personal volatility, performance randomness into your system. So when you are into your trading performance, so when you look at I'm sure everyone's using Excel or a journal, or you're looking at a broker statement, it's harder to find out where you want to improve, right? So you want to improve yourself in a step-by-step manner. It's much easier to evaluate what to improve if you've, got a process, and then you can change, whatever is in that process and move forward. I think it makes it much easier to see clear growth in where you've come from, because you've made these changes, and it's a clear indicator whether the change is working or not. And I think those are the two most important things for any trader to look at to see how their journey is going. And you have a very clear picture of, is what I'm changing working, and am I getting better at doing this job?
That's a really awesome answer, man. I like that. I'm going to squeeze in one more question before we wrap things up here. And this is a question that came up in the Chat with Traders Facebook group, which you're, of course, a member of, and that's how we met. You answered this question in the group, and I think you found the question to be quite interesting. And that question was, what should traders focus on once becoming profitable? So how would you answer that?
Well, I think a lot of retailers and a lot of people in the group think that becoming profitable is the end result, right? That is where you, like, once that happens, you're like, yes, I've made it. That's where I want to be. But it's only the start of your journey. You can only really call yourself, not to be offensive, a trader when you can consistently make money at it. I don't want to be too much of a dick, but if you're not, you're still a student of the trade, we'll say. Well, you're a student of the craft. And then after that, you're not an apprentice anymore. You have evolved into someone who understands it. So from that point, there's so many more steps to go. You're not the perfect trader yet. You're not even close. You have just stepped into the world of consistently profitable traders, the world where, people do this for a living. People trade, millions and billions of dollars. You have just, got an entree into that circle. So you can improve yourself, improve your strategy, right? Improve how you're managing your strategies, right? Look at maybe, getting some assets under management, right? Look at expanding yourself, leverage yourself. You now have a skill, right? Don't just look at yourself and say, hey, I'm only going to trade my money. If you have a skill, don't do it for free. Go try to find other people who require that skill from you. And just think about how you can continually improve. You are not the optimal trader just yet. I don't think you ever become the optimal trader. So what are your strengths? Make those stronger. What are your weaknesses? Either go around them or nullify them, and have a continuous self-improvement. And as you continually self-improve, as traders, we are rewarded. And through that reward, it becomes a fantastic process where you get to feel good that you have improved yourself. And then the world and the market verifies that you have made that improvement by giving you that reward. And so now you get to go into a virtuous cycle of becoming the best trader that you can be.
Very good. I feel like I'm repeating myself, but that was a really cool answer. Derek, this has been a lot of fun, man. I've really enjoyed having you on. I think we should do it again sometime. But where can listeners go to find out more about you? Do you have a website? Are you on Twitter? I'm not sure if you have either.
I honestly don't have any of that. I'm in China, and Twitter and all that kind of stuff is blocked. I cannot, because I'm in a fund, I cannot solicit externally. So yeah, just find me Chat with Traders.
Yeah, well, you are in the Chat with Traders Facebook group. So if anyone wants to join the Facebook group, of course, it's totally free. chatwithtraders.com/Facebook will redirect you straight to the Facebook page. Just hit the green join button and I'll let you in. Derek, would you be open to answering maybe some of the listeners' questions in the comments on the Chat with Traders website? I probably should have run this past you before we got on the call, but would you be open to that?
Sure. If anyone wants to post any questions or comments or anything like that, I'd definitely check the website or the Facebook group and drop me a message, and I'll do my best to answer it as best I can.
Excellent. So guys, just to summarize, either you can leave questions for Derek in the Facebook group, chatwithtraders.com/Facebook, or in the comments section below this episode on the website. So you can get to that by going to chatwithtraders.com/the episode number. I'm not quite sure what that episode number will be right now as we're recording this, but you'll see it. All right, Derek, well, once again, man, thank you very much. I truly do appreciate it. It's been a lot of fun.
No, that was great. Yeah, I had a great time.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, ladies and gentlemen? Welcome to episode 98. Let's get straight into it. This week on the podcast, I have Peter To. Before day trading equities, Peter played a lot of online poker and did fairly well for himself. He then dabbled in markets as an investor, but was soon attracted to OTC stocks after discovering a strange inefficiency. In this episode, we spend quite a bit of time talking about Peter's prop trading experience, both the good and the bad, trading nihilism and doing everything you supposedly shouldn't do, why Peter accepts he's not a cold-blooded assassin and does trade with the influence of emotion, plus we briefly touch on Bitcoin towards the end too. Peter writes about a lot of this stuff on his blog, which I feel would have to be one of the best personal trading blogs I've come across. I know if Peter ever decided to write a book one day, it'd be a hit. You guys can take a look at Peter's blog for yourself at ptotrading.blogspot.com.au. And I also want to mention, I am doing a Chat with Traders hangout / get together in Sydney. This will be on Sunday, the 20th of November, 2016. For more info and to RSVP, just go to chatwithtraders.com/Sydney. Okay, that's it. Please welcome my guest, Peter To. I would really like to start this interview by talking to you about your early days playing poker. At what point did you start playing poker and how'd you get into it?
Yeah, that was the very beginning. That was, let me count down, 2004. That's when I started playing online poker. I actually got into the game in 2003 after Chris Moneymaker won the 2003 World Series main event. And this was kind of the start. This is what many people consider the start of like the online poker boom, because it was kind of a perfect storm. Online poker started to get popular, and there were hole cards introduced on ESPN's televised broadcast of the World Series of Poker, so people could see what hands players would play, and that got a lot of people interested in the game. I think it was like 2 a.m. on a summer night. No, there wasn't school, and I was just watching ESPN late at night, and I saw these guys play, and I was like, hey, I can do that. I had a pretty competitive drive. And, I wasn't really all that athletic. It was just for me, it was just all intellectual power. So I thought, poker was a great fit. And I started playing home games with older kids from high school, whoever would invite me over and whoever had the chips. And that was a pretty good experience. I took the game pretty seriously. I read a lot of books on Texas Hold'em from going to Barnes and Nobles and looking up anything published by 2plus2.com, 2plus2 Publishing. I believe David Sklansky, he wrote like The Theory of Poker. A lot of his books were like the foundation to my game. And then in 2004, I believe I was like 15 years old. I just thought, man, I'm ready to play online. I played like I played with fake chips, and I observed some of the lower stakes games, and I thought I could beat these games. I could beat these games because it's just poor players who are just gambling. They're just playing every single hand and practically donating their money away. And I'm just like, why are there laws against me like being able to go online and take these people's money if they're just giving it away? But I had to find a way to get the money online. I actually put this into a blog post of mine. I had to sort of deceive my mom into putting money on PayPal, thinking I would buy something on eBay. Like she thought it was probably like Pokemon cards or baseball cards. I was actually giving $25 to a random stranger on his proposal that he would transfer $20 through PokerStars player-to-player fund transfer feature. And that's what happened. I paid that guy $25 so that he can give me $20 of credit. No ID needed, no credit card needed. You know, it really was that. It's hard to believe it in today's environment with all the legislation against gambling, but you could just get money from someone else. So I started with $20. I lost the initial $20, which is pretty devastating. But I actually asked my mom for $50 initially, so I had one more try at it. And the second 20, I said, I'm going to make this work. I'm going to make this work. I'm going to play the lowest possible stakes if I have to, which was like 10-cent big blinds if I had to. And I started to study it even further, you know, and I think initially I had certain assumptions about, you know, if I just played the right hands, you know, the top 15% pre-flop hands, and I just play ABC poker, or what I thought was ABC poker back then, I could just take money from these people. But that wasn't happening. What was happening is I would wait until I get aces or kings. I would raise the flop. Everybody would call, and some donk would like flip over 5-3 suited with a flush and beat me. And like it seems like I'd be winning 20-30% of the time with these hands and kind of just breaking even and not really going anywhere, not having the bankroll growth that I anticipated I would have. And I did a little more diligent hand analysis on 2+2 forums where you could dissect each individual hand by putting your hand history into a converter, and then you would have other more experienced players kind of critique your line, so to speak. You know, your like call, check raise the river. That's like a line in poker, like what decisions you made, the path to get to the end, basically. And what it turns out is that I was only half right. I was playing conservatively tight, which is what you need to do at the low stakes, at the lowest stakes when everybody's playing, you know, the worst hands all the time. You need to have that edge, but I wasn't playing as aggressively as I thought as I should be. What was happening is that a lot of players, they have this barrier at the lowest stakes where they play the right hands, aces and kings, but they get busted too often, so they get cynical. They're like, oh, my aces will always lose. My kings will always lose. I might as well save money. I might as well stop raising the pot. I might as well stop getting my hand to the showdown. And I didn't realize how much money that cost me. I didn't realize that I had to push flush draws and straight draws, even though I wasn't greater than 50%. I still had like a 20 to 30% chance to win the hand. And when you're in an 8-way pot, you know, 20 to 30% equity was a huge edge, and you had to push it. I was just calling flush draws. I wasn't pumping them and trying to get the pot as big as I could on like a 7-8-way flop. So I learned all these nuances, and I had to reevaluate my whole framework of how to think about a hand and how to think about like expectation. So after that breakthrough, I finally started becoming a consistently profitable limit hold'em, and I was a limit player. I played both limit and no limit tournament style. I finally became a profitable limit player. I became a profitable no limit player just a little bit later, applying the same analysis and reading the same, you know, from learning from the same community. I believe I played online poker for seriously for 2.5 years. I turned $20 into $20,000. And, you know, I could go on about how I studied the game and that made me a better player over all these terrible players, which is, you know, true. But I also want to make the point that I was very lucky in the sense that I didn't really have a lot of innate talent for poker. You know, just getting the fundamentals right was enough to carry me through because there were so many bad players, man. It was like a poker bubble. It was the poker bubble. It will never be like that again. Like, you will never have people making six figures playing 2-4 limit ever again. And there were people making six figures making 2-4 playing 2-4 limit back then. If you play 2-4 limit in a casino, you're probably making minimum wage, honestly.
So are you still playing poker to this day? Obviously, trading is your main focus, but is poker still something you do in the background? I mean, I understand it's since become illegal to play online poker in the States there. What's the deal?
I don't play any poker anymore.
Okay.
Like, just none. I live in New York City, so there's not a lot of poker casinos. I come from Southern California, where there are a couple places. When I do go back to California, I'll play recreationally, but any serious play is pretty much over for me. I think the game has just advanced well beyond my capabilities. Like, this can be a topic I could go on and on for over, because I have, it's kind of a crossover from poker to trading. But I really think the gambling, the intellectual theory that's out there in gambling and poker is just so much more sophisticated than it is in trading. Even if there is more money in trading, or at least the day trading that I do. I'm not talking about like hedge funds or institutions. Like, the game has gotten so advanced with what people throw out as this popular phrase now, game theory optimal. Like, everybody knows what like the correct line is now for like so many different common situations, I should say. I feel like and now that like the fundamentals are so widely known, it's almost like it's becoming an efficient market. Like, now what carries people through is just like pure talent, the ability to just stand in there and make the big bet when people can't, or be unconventional when people can't. Because if you just try to outplay people on fundamentals or betting patterns or taking the correct lines or playing the right math, you just don't have that edge anymore. Too many people know that stuff. Just too many people. So I'm not interested in playing poker, even if the online opportunity came back to the United States. I wouldn't be interested. I think the edge is too small, and on top of that, I didn't really have the passion for poker that I initially thought I had.
Fair enough. Okay. So, I mean, you said there that you turned $20 into $20,000. I mean, clearly you were doing something right at the time. Why did you decide to get into trading? Why did you not just stick with poker?
Well, it goes back to what I said just a minute ago. I lost passion for it. I felt like the way I was making money is I'm chasing around these bad players donating their money, and it didn't really tap into my competitive drive to the point where I was like, okay, I want to be a world champion, or I want to be a high stakes player. I want to be like a really great tournament winner who can make like $1 million a year through poker. I just wanted the easy money. It burnt me out quickly. The variance in poker is a lot higher, I believe, in trading. And I didn't really want to deal with that as well. I guess what initially led me to stop was when UIGEA went into act around like 2007, like Unlawful Gambling Enforcement Act. That's when it was just so much harder to move money around. So all the bad players stopped putting their money online, and just a diminished edge from that standpoint.
Sure. So how did you come across trading? Like, was it, had it always been something like in the back of your mind while you were playing poker? Like, where did the motive come from to go into trading?
I guess while I was playing poker, I knew nothing about the stock market. I never even thought about it. It was only until I was in college where, I guess it's just happenstance. My now best friend who lived in the dorm next to me, I would talk to him about poker, and he would talk to me about like trading and investing. Like, he had all these books about growth investing and technical analysis. Up until that point, I had no idea that anybody made any investment decisions based on a chart. It didn't really make any sense to me, actually, at that time. But he told me that he had been investing in these little small biotechs. And it piqued my interest a little bit, because I had stopped playing poker at that point. I never spent that money. And I thought, maybe there's like a natural transition here. based off my existing skills and my existing background.
Yeah, right. And when you did first get into trading, you weren't really trading as such. You were actually more of an investor type. Is that correct? Like you were following kind of some of the things that obviously your friend had been telling you about, more of the value investing.
Yeah, that's right. I actually had like three stages, like one before being an investor. So I got interested around like 08, 09, obviously, because like the headlines are all about how the market is in a panic and going to the lows and Lehman Brothers, et cetera, bailouts, et cetera. So that was a very unique crisis period to be introduced to the markets in the first place. So because of that, the first stage that I was in I'm going to label as a market participant, was that it kind of leaned on my political biases a little bit. I was basically a gold bug. I was a total crank. I ate up all that stuff from Zero Hedge, Peter Schiff, Mark Faber. The market's gonna keep tanking. It'll never recover. The Federal Reserve, who I just hated, they're gonna keep printing money and create hyperinflation and all that crap. And I was, and so my first action as a market participant, you know what I did with my 20K? I bought gold coins, actual bullion gold coins. I paid an 8% spread to buy those coins, which is huge. And I didn't even, from my vantage point as an experienced trader, 8% spread is just friggin' huge. There were 1 ounce Canadian maple leaves. Because this crank forum that I was drinking the Kool-Aid from told me that if I bought GLD, the ETF, in the case I ever needed to redeem the gold, I wouldn't be able to because GLD is a scam. So that's the kind of stuff I was eating up for like a good 6 months. I laugh about it when I think about it, because I'm still a big libertarian, but I no longer have those same, I'm going to call fringe economic theories about how the U.S. economy works. I no longer really believe all that. So, I guess you can kind of glean back from that and see that I can kind of change my mind quickly. I can buy into something really quickly, and then I can at least have the wherewithal to debunk myself because, I kept an open mind to look at other forms, and eventually level-headed, reasonable people, smart people seemed to just debunk these guys and show facts and evidence that they were basically, right once every 2 decades, like a broken clock, right twice a day. And that they've been screaming about this stuff for years. And when you put the math out there and look at the gains that they missed from not being part of the market, I thought, yeah, that makes a lot of sense. There were just people who were just talking heads, and I'm just kind of just drinking the Kool-Aid on their stuff. It kind of woke me up a little bit. So my second stage, as you alluded to, I was more of a value investor, growth investor. After that, I sold. I actually bought my gold coins at like a short-term top. It was on 800 something, and it went down to 700 something. And it managed to get back to my break-even price, and I sold it. Obviously, it went to 2,000 afterwards in the next year and a half, which is pretty nuts. But I don't even think about that. It just doesn't matter. The second stage, as a value growth investor, I started reading books off my parents' shelf from Benjamin Graham, The Intelligent Investor, the Bible of value investing, and Peter Lynch's books, which is like the Bible of growth investing, buying what like Amazon, Netflix, brand names that will keep going up, doubling forever in perpetuity, stuff like that. So I thought that approach was pretty sound, and I just I didn't really have much of a research method. I was so eager to just put it in play and thinking, well, we just crashed. Everything's at the lows. Why do research? Why spend time doing research? Why not just buy? So I bought Apple at 79 pre-split, which was the day that Steve Jobs announced his illness. I think that's the 8-year low. I bought Baidu at 100 something. I bought Wells Fargo at lows. I bought Dow Chemical at lows. I had like a portfolio that, in hindsight, was at rock bottom. And I had stocks that, you know, I had a conservative stock. Even the conservative stocks went up like three, four, 5-fold from these prices. But what ended up happening was, you know, I didn't really have the patience to just keep holding. I found out that I didn't have the patience. I thought I had the patience, but I did not. I started reading about, I read too much about people's opinions on where the market was going to go. And they thought the market was going to double dip. And I'm like, well, I'll sell it now and I'll rebuy it. Wrong. That's not, you know, that's not, if you're going to be a value investor, don't do it that way, please. You know, it can make a lot of money if it's the right style, but, you know, if you got to commit to it. So from all of that, despite all my ignorance, I managed to turn 20K into like almost 30. And that actually put me over the pattern day trader rule, which leads me to my third stage, which was when I started day trading.
Yeah, cool. Well, let's hear about that. How'd you get started as a day trader now in your third phase?
So I gave after a lot more reading and digesting what other people thought about technical analysis, I decided to give it a shot. Some of it made sense, like in the sense that if you have an existing edge, you can use charts to at least time your existing edge. You know, you can't just use charts by themselves, in my opinion. And I guess I sourced a lot of my education from many different backgrounds. My mom had a retired friend who trades a lot differently than I trade now, but she taught me how to read charts and, you know, kind of structure trades, saying like using, just reading candlestick charts. I joined some online chat rooms that would discuss momentum stocks and penny stocks. I read a lot of different blogs, just kind of learning from all over. It's hard to source one particular group. I started to gravitate towards penny stocks because of one particular kind of glitch. And I wrote about this in my blog. I call it, you know, it's called the ARCA low offer. It was on these OTC stocks where pre-market, the market would cross on ARCA like 10 to 20% lower than the previous closing price for no real reason. And then this would just revert back to unchanged at the open.
Could you just flesh that out a little more? Just explain what you're referring to there. I know
Sure.
We'll put a link in the show notes which references that blog post. I have seen it. It's a great post.
All right, so let me start from the beginning. I got attracted to the OTC because there were a lot of like scam stocks and junk stocks and pump and dumps and stocks that would just go up on, you know, just the silliest reasons. And the OTC is different from the listed exchange or the New York Stock Exchange / NASDAQ because it's a different market. It's not an instantaneous electronic market in the sense that you can just hit a button and get out of your entire position quickly. In the sense that you can ping the book, the bid and the offer, and fill your orders instantaneously. It was actually a hybrid market where you had one electronic market where you could do that thing. You could ping the book and get instantaneous transactions on ARCA. And then that was half the market. The other half of the market was run by market makers. When it trades off these market makers, they actually fill you manually. What would happen was that some quotes would not be honored, especially during illiquid rushes or bottlenecks, like whenever there's a panic or a squeeze. Like if you try to ping a 100 share order from a market maker, you might not be able to get it. You were probably too late, and they were slow to move the quote. So it made for a very inefficient market, kind of a weird little hybrid market. So what I observed from these OTC stocks is that pre-market, the electronic market was the only market you could trade on, ARCA, where it was instantaneous, just like a listed stock. And a lot of the times on these pump and dump stocks, I don't know if they were deliberately trying to manipulate the stock or mark it down or get everybody to think one thing and then switch it up. It's all speculation, honestly. People always speculate on what the market maker is trying to do. Nobody really has a clue. But it happened, which is that, say a stock was at $1 and it closed at $1 and there's no news on it, ARCA would come in at like 85 cents and you could just pay the offer, and you would see the market makers who you cannot make a transaction with until the 9:30 open stay at $1 bid. So you're essentially buying a $1 stock temporarily priced at 85 cents due to this weird efficiency or whatever conspiracy theory you want to use to explain it. And this kept happening over and over and over again. And by the time it got to the 9:30 open and I picked off all of ARCA's offers, it would just remain a normal market. It would be it would open at roughly at the same prior close, and I would sell to the market makers right away. I didn't want to wait until something changed, otherwise a bottleneck could happen and it wouldn't get filled. But I would just sell it to them, and it felt like free money. Like, why is this person just giving me this huge discount that I can just unload 90 minutes later at the equilibrium price or correct price or fair price or whatever you want to call it? It didn't make any sense. It kept happening. And I wasn't even really making money off classic ABC trading at that point. I was just making all my money off this market inefficiency.
So how long did that last for before that inefficiency closed up?
I want to say a little less than 2 years. Then it slowly became more sparse. I just want to say it didn't really happen on a day-to-day basis. It happened on certain special stocks that had unusual order flow. So it wasn't like I could do this every day and make all the money in the world. It was more like every now and then, a few times a month.
And as you came into day trading, what were some of the biggest challenges that you experienced, that you encountered, challenges that you had to push through and overcome?
I feel like most of the challenges that I don't even remember. Like, I don't even remember what trading was just such a different ballgame. I can tell you about the trading after I moved to New York and started prop trading. Like, those are the challenges. The reason I say that is because now without having to lean on that specific glitch, I have to make money like most traders, which is I have to have an idea, I have to be right about it, and I have to time it correctly. And that's when, the typical psychological hurdles started to kick in.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let's just start with, how did you actually get into a prop firm? Like, what did you need to be accepted?
So I just want to throw out there that I don't want to name the prop firm that I worked at, like, just out of respect for them, because I also blog about them and maybe might want to blog about them in the future. And I don't want that affecting anybody, like, perceptive, because a lot of times I'm just trying to be entertaining with what I say. But so the firm that I joined, which I won't name, what did I need to join and be accepted? Well, what they asked for was college students who would show an interest in trading and would kind of follow through with that based on their actions. Like they would try to paper trade, or they would get a small amount of money from family and try to trade that. And because I had basically been trading 2 years with my own money pretty much almost every day, because I was over the pattern day trader rule and skipping class to trade, I was basically a shoo-in because I had the track record. They requested the track record, and I sent them all these pages, and they're like, wow. And that was pretty much all I needed. I had a lot more than that. Like I started a trading club in college.
Okay, so you didn't need any sort of a certain level of education or any higher education of any form?
At this particular firm, no, I didn't. What they emphasized was some kind of track record or a way to show interest, even if you understandably did not have the money or capital as a college student.
Okay.
A lot of firms are different.
Yeah. And why did you decide to join a prop firm? What were your motives for doing so?
I had read testimonials about this particular prop firm. At the time, I felt impressed. I thought, if I joined this firm and I was part of their team, I could maybe take the next step in my own trading. And, I'd be in the financial capital of the world. I'd know people. It seemed like the sky was the limit. And that's kind of what I thought at that moment.
Okay. And so is that what it was like? I mean, what was your experience?
It was not quite like that. So about my prop firm, there were good things and bad things about it. It was a great experience that I would never take back. So when I first came to my firm, let's call this like firm ABC, they were under an umbrella of a bigger firm. So we had a bunch of like sister branches under this big firm that were kind of unrelated to us, managed by different people. And I'm just going to say that this umbrella firm was not a good firm. Like my branch, I feel like the people there were solid. They had an interest in my success and in the success of my colleagues, whether they were able to follow through with it or whether we were able to meet their expectations, a different story, but they at least had the sincere interest in our success. Whereas a lot of the firms that I ran into during my time there, I don't think they had that interest at all. It was pretty cynical. It was just burn and churn, get a guy in, get the commissions, and leave him in dust when he blows up. So that big firm, I just didn't like how it was run. It just feels like there was no real advantage in trading there. They have an online presence where they sell a lot of things, and just being on the inside, I feel like I can just dispel a lot of what they're selling. They would fine you for the smallest things. There were all these regulations and rules that, a retail trader didn't have to deal with.
Can you give us an example of some of those rules that you had to deal with that a retail trader wouldn't have to deal with? And also, what sort of things were you getting fined over?
Yeah, so one rule would be like, based on exchange regulations, they didn't want us trading odd lots. An odd lot is like 50 shares or 77 shares or 11 shares or 3 shares instead of 100 or 200 or 300. It was supposed to be round 100 share lots. And anytime, so basically if you try to trade a higher price stock and you try to take a partial position, you either had to you didn't have a lot of options if you were just trading 100 shares. And like sometimes I would like trade like Google, and I'd trade a 100 share lot. I'd try to sell 50 and they fined me $50 over it, and you wouldn't have to deal with it. if you were a retail trader.
I don't understand. Why was that rule in place?
So the firm was a member of an exchange. I believe it's like the CBMX, Chicago Mercantile Exchange. And they had to comply with certain rules because, I think there's some methods of manipulation that involve odd lot trading, because odd lots might not appear on the consolidated time and sales. And to avoid even the appearance of this manipulation, so they didn't have to deal with any questions or inquiries at all, they just outright banned it. And the penalty for doing so was basically some kind of fine levied to members of of our firm. So I think that's the reason.
Right, okay. That's really strange. I've never heard of anything like that. Not that I've been involved in the prop world.
Yeah,
before.
I thought it was completely silly. I thought it was silly, to be honest.
Right.
But I think what happens is, when you're a big firm, you're like, hey, we just don't want these headaches. We're just going to say, you can't do this. You can't do that. And there's no room for nuance. They don't want those inquiries at all, even though they probably wouldn't happen. I mean, like I buy 100 shares and I sell 50 shares and then I'm out. I mean, does the exchange really going to send a big inquiry asking what I'm doing in that situation? Probably not, but they just don't want to deal with it at all.
Okay. So, given your experience, it's kind of been a little bit mixed, in regard to trading with a prop firm. I often get this question, someone who's listening might email me and they might ask, should they join a prop firm? I mean, I obviously can't really answer that too well, but I think you're probably in a position where you can shine some light on that. I mean, when is it a good idea for an independent trader to go with a prop firm?
There's a lot of different variables that come into play, variables about your individual situation, and then obviously what the firm has to offer you. For example, if you don't have any capital access whatsoever, and that's your only option, I don't want to say I recommend it, but it's like, if you really have to trade, then what else are you going to do, right? So, but there are many different situations, not just somebody who's in dire straits that doesn't have money. If you're let's say you're a decent trader and you can make money on your own, what could a prop trading firm possibly offer you? Well, they can offer you more capital to scale up your existing strategies. They can offer proprietary technology that enhances your strategy. I feel like that was what was happening at the firm that I was with in the latter half of my prop trading career. So I want to establish what happened with my prop trading career for a little bit, okay?
Sure, go for it.
So I just went over this firm that I disliked, this big umbrella firm that I won't name. So what happened 2 years after starting that was that my managers kind of were fed up with that umbrella firm, and they merged with another existing prop firm. So they went in an entirely different direction. And this was a much better firm. They had, in my opinion, the best retail trading, or not retail, but the best just execution platform that I've seen. It's completely proprietary. It's not on the market at all. They were there was a much better risk-taking culture. There was a culture that says, if you're a profitable trader, go for it. It's not just we're making money by burning and churning people over and over playing the volume game. The game was raise a consistently profitable trader, make him take risks and make money through good trades. And so it was a better culture, better technology, better capitalized. And also, there were existing traders who were making 7 figures who were willing to reach out. So that was the positive of my experience. It just kind of did a 180. So I saw, kind of the good and the bad. And I started to understand why some of these 7-figure traders didn't make the decision to go independent despite such an amazing track record. It's because some of their strategies, which is far and away from the ABC chart breakout strategy that most people, and myself included, employ and talk about on Twitter, some of these strategies depended heavily on the deeper capitalization from the firm and the superior technology of the firm. They could not execute these same strategies using retail platforms. They absolutely could not. So I totally understand why there was a mutually beneficial relationship, and that's why they stayed. And that's why I think prop trading has a place for certain traders.
Okay. So if a certain trader is thinking about or considering that going into a prop firm might be a good way to go, what are some of the red flags that they should be aware of before actually joining?
You got to ask yourselves, what's their business model? Are they trying to play the volume game where they get people in and out of the rotating door and make money off commissions? At least when it comes to equity prop shops, it's a little different, and I'm less familiar with like the future shops and option shops in Chicago. But with equities, are they playing the volume game where they just want you in and out, or do they have a vested interest in raising profitable traders? Are they trying to make money with profitable star traders, much like how like a baseball team tries to grow prospects into superstar players and win a World Series? Is that what they're trying to do? Because if that's what they're trying to do, even forget about the profit split. It's a great opportunity. They have a vested interest. They want you to succeed. There will be mentoring to make sure you succeed. And, if anything, a 50-50 split, 60-40 split is more indicative of the fact that they need you to succeed. They're incentivized to make sure you succeed, as opposed to like something extreme like 95-5. Like if it's 95-5, what do they care if you make a profit or not? They're just trying to churn you. And you got to like go through Glassdoor or go through forums, talk to the people who've been there and ask them what was their experience, and like, did they actually learn anything from it, or did they just get sucked in without really knowing anything about the markets in the first place? So there's a lot of shady practices out there.
Yeah. So just going to the other end of the spectrum, and just so that someone who's listening to this has realistic expectations of what to expect from a good prop firm or a fair prop firm. What sort of things could a trader expect from a firm that's above board?
They're going to have a legitimate training program. They're going to try to start you off slow when you're not consistently profitable. They're not trying to make you trade full size right away. They don't ask for a deposit. I think that's a big red flag that I didn't mention. They provide mentoring from experienced traders who are transparent about their trades, and they're not just making calls and sitting back and claiming they know everything about the markets. They say, I made this trade with X amount of shares at X price and made X amount of money.
And just your point about the deposit, why would a prop firm ask for a deposit?
So a lot of the volume-based business models in prop trading, who are just trying to get guys in and out for their commissions, those are the type of firms that want deposits. They don't want to take a chance on a trader that he's a smart guy who can make money. They don't want to take that risk. So they ask for a deposit as kind of this safety cushion. So, if you blow up your account real quickly on a certain trade, they kind of cover that with that deposit. So they're not really the type of firm it's not indicative of a type of firm that wants to grow star traders, profitable traders.
And when you were a prop trader, how much were you influenced by the other traders around you? And was this a good or a bad thing?
They had a lot of influence. I sourced my trading education from so many people, and that prop trading experience was overall a net beneficial one, because I was able to meet good traders and great traders and learn from them. One thing I want to say was that even though it was a good experience overall, there were some drawbacks. Like, I think our firm in the first couple years, with all like the kind of the core traders who were able to last longer than a year at our firm, we kind of stuck together a little bit. There was a lot of groupthink. There was a lot of people saying, okay, this is the play to be in, and then we all pile into that play and get stopped out, and we all trade alike, and it was a little bit of a herd mentality. And what happened was, like, you know, you develop a little cynicism. You're like, we're just crowding into it, and it's gonna stop us all out. And there wasn't enough variation, so you don't get exposure to all the different types of trading that may be better for you or your temperament or personality. Like, we were all kind of taught like one, like, momentum trading style, instead of, say, like some of the more obscure strategies that I encountered after the merger with the new firm. And it just opened my eyes to all the different ways that traders can make money. It's not just, you know, the price action trading that you see on stock twits and, you know, financial Twitter that covers equities. Like, I feel like 80-90% of it is the same thing. And I do all of that. So I'm not saying it's like not profitable. I'm just saying there's a lot of tunnel vision in saying that that's the only way to make money, is to find a stock, have a thesis, and use a chart to time it. Way more different approaches than that.
Right. Yeah, well, tell us a little bit about how you are trading today. Like, what is the style that you've developed into? How would you describe your trading methodology?
Well, I've tried to develop a varied playbook of different types of trades, so that I don't feel dependent on one opportunity arising. So I guess in a very broad sense, I trade a lot of short-term price action, and I try to generate trading ideas that can give me a big move from the open to the close. Like, that's the meat of the move I'm trying to catch. Something that opens high and closes low, or something that opens low and closes high, and I'm just riding it all day. Like, catalyst-driven ideas, stocks with unusual volume, volatile movement. That's what I'm looking for. That tends to be biased towards certain sectors like biotechs, IPOs, micro caps, growth sectors, tech. So I'm looking at those certain stocks, and those stocks tend to have kind of the same people trading it, same audience. They're looking for those big moves just like I am. And a lot of the times, like, it comes down to just being able to read the psychology of the stock and find the turning points, and you know, not being part of the crowd. And it's not that intellectually, like, deep, really. It's a lot of it is like, you read and react. You use certain tools like short-term charts, 5-minute, 1-minute candlesticks, volume, the level 2, aka reading the tape, VWAP. You use all these indicators to try to feel out the short-term supply and demand. And then when things kind of coalesce and, you know, the price action looks right, and you have a thesis about where a stock's going to go, that's when things line up. That's when you make your move. So that was a lot of rambling. So let me try to give an example. Like, I guess, God, so many people do this. They short parabolic penny stocks, and I'm just so tired of talking about it. But, like, let's say like, it's the easiest example because it's one of my best plays as well. Let's say a stock goes from like 1 to 5 over 3 days, and it's a complete junker, and your thesis is that this extended stock is going to collapse like 30, 50%. So how do you just make your play on that thesis without getting run over by shorting after it went from 1 to 2, and then you have to ride it to 5? Like, how do you avoid that? Well, that's when your skill comes in. That's when your trading ability comes in. That's what I honed for many years comes in, that timing ability of reading the charts, reading the volume, reading the tape, and trying to keep risk minimum until the play is ready, until that turning point comes and it's ready to collapse. That's what it's all about. So you have an idea, and then you try to use the timing to capture the most out of the idea when you're right. And of course, you also minimize damage when you are wrong or when your timing is off. That's what it comes down to. And it really is just a skill that you hone over many years. it's not that hard to understand, like in terms of the intellectual depth.
Yeah. And something interesting which you said at the beginning of your response there, you wanted to create a varied playbook so that there was, a bunch of different type of plays that you could identify and participate in. What was your thought process behind that?
Well, I believe in the equities market, themes, certain themes go in and out of fashion. And when they go out of fashion, there goes the order flow. The order flows out. And you want to make money where if you're trading, at least if you're trading my style, momentum-based style with unusual volume and a lot of attention, you want to go to where the order flow is. And if you're just, let's say you're only trading those plays where you short the big microcap. Well, microcaps will go out of favor and they might not move for a certain time period. It might be several months, it might be 1 or 2, 3, 4, 5 months, or maybe barely get any plays in those months. How are you going to be consistent and take money out of the market on most of those days if you're only depending on that one play? So these themes go in and out of fashion. I think you have to try to trade both sides of themes, like long and short. And, sometimes the order flow is in hot IPOs. Sometimes it's in mid-cap earnings breakouts. And those are going to have different audiences, and those are going to trade a little differently. So you're going to have to have a feel for how they trade. And when they're in fashion, you're making money out of that. When the money rotates, you move along with them, and you're trading the order flow, and you're making money there. And when that money rotates to a different theme, you follow along with it. If you're just stuck on one type of edge, like penny stocks, then you're not going to be able to move to where the money is, and you're not going to. And it also you're not going to be able to develop the skill that you need to, because you're not exposing yourself to the stocks that are moving at that time.
Okay, yeah, no, that's a fair point. Now, as we're talking about your trading style. This was something we briefly spoke about off air, and I'm probably going to butcher his name, but I think it's Jimmy Ballodimas, something like that.
I think that's right. I've never even actually heard his name pronounced.
Well, now you have.
I can't even. I'm not even. That's how I pronounce it, so I assume that's correct.
So he was a prop trader who was in. He was the only prop trader who was in Jack Schwager's most recent book, Hedge Fund Wizards. I know you read this book, and that chapter in particular, that trader in particular, had almost like a lasting impact on you. And I know you wanted to speak about how that had kind of affected you, and you really liked his ideas on the conventional wisdom and how a lot of his ideas kind of contradicted it. We'd love to hear, why you kind of resonated with what he spoke about.
So the Jimmy Ballodimas chapter, I looked it up. It was called "Stepping in Front of Freight Trains." It's a great title.
It's a good title.
You can read so many books and so many trading memes off highly followed accounts, and one of those memes is going to be, or one of those sayings is going to be something like "Never catch a falling knife," or never fight the trend, or the trend is always your friend. And I'm sure that helps a lot of people, but man, there are people just making money off these unconventional ways that defy all the conventional wisdom. And I've seen it in real time. I've seen it in the chat rooms, in the prop firms, that it gets to the point where I've kind of developed this trading nihilism in the sense that it almost feels like the process doesn't matter. It matters, but it's like you have to find the right process for you, which is such a cliche thing to say, and I hate saying that, but it's true. You really have to find the right process for you, and it could be a process that's just so wrong to all the conventional wisdom. And that is why I love that chapter in that book, because that guy did everything that people say traders shouldn't do. He would fight the trend. He would add to his losers. He would take profits on his winners. He would give himself a lot of leeway on trades. And I was told by other veterans in the prop trading industry, there are guys like that. There are more guys like that than just him. He's not just this one of a kind savant trader. There are many guys like that. They love to fade big moves and make money when the market is clearly wrong, even though we're always trained to think as traders that the market is always right, and how, you'll go insolvent before the market corrects, or all those sayings. But then, even in my own prop firm, the best day that they ever had by far was buying the shit, pardon my language, out of the fucking flash crash in like 2012. And they put the firm in jeopardy. They put the entire firm in jeopardy, and their attitude was it was somebody else's money. But they were like, fuck it, the market's wrong. We're just going to do it, and we're going to make a bunch of money. And that ended up being their best day. Now, it's like, what can you say to that from just from a judgment on their risk management? Is that right? Is that wrong? Did they get lucky? Was that skill? I mean, I don't know. I don't know. There's no right answer. And that's like the difference between like gambling and poker. In gambling, you have this mathematical framework where you can pretty much say this decision is wrong, this decision is right, calling this bet is wrong, playing this hand in blackjack was wrong, or et cetera. You don't really have that in trading. So you just can get completely lost in this hindsight management. You can get lost in wondering whether this once in a lifetime trade that will never repeat itself for you, whether you should have played it the right way or not, because it's only going to happen once. This is not like a blackjack hand that's going to happen several times in repetition, and you can say, oh, over time it'll play out like this. You have no idea how it's going to play out, because it's only going to happen that one time, and it's going to be completely different that one time. It didn't, because crashes happen over and over, but that crash is going to be different. The 1987 crash, Black Monday, that took much longer to correct. But now we're in an electronic market where things melt up quickly and make back their gains on low volume. And so the flash crash was nothing like 1987. It corrected the same, within 2 or 3 days, which is just insane to me. So it's like, in some sense, I get lost in wondering, what is the right thing to do? What is the wrong thing to do? It's trading nihilism, because so many people have done it the quote unquote wrong way that, I feel like you got to throw the book out sometimes.
Yeah, I love that. I like that sort of breaking out of the mold. I like how you described it as trading nihilism too. I think that's a really cool way to put it.
I don't know if it's affected my trading. It's given me some good moments where sometimes I would trade a certain way, and I would write down in my journal, you have to do this, you have to do this, you have to trail in when it breaks VWAP, you have to take profits when it moves a certain standard deviation from its opening range or whatever. And then there are times when I'm like, fuck this, I'm not going to do that. I'm going to hold everything because I think it's going to work. And it's all gut instinct. And then there are times where I do that and it blows up in my face and I'm like, fuck it, I should have just stuck with what I usually do 80% of the time. And it's like, how can you write down in your journal whether you did the right thing or the wrong thing? People are always saying, if you did the right thing, it doesn't matter whether you won or lost money. And that's true, but how can you tell? Because it's not gambling, it's not poker where you have a clear framework to evaluate everything.
That's true. That's true.
You just can't tell.
So how do you find conviction in what you do? And do you have any sort of tips and pointers for how other traders might find conviction in their own process, their own way of doing things?
Oh boy, conviction. That's a topic, man.
Or does a lot of it come from experience and intuition?
Oh, absolutely. It comes from experience. It comes from how your experiences develop that intuition. Yeah, basically, it comes from repeated observation of situations playing out a certain way over and over and over again. And that when you see it happen in real time, it's good. Then it's like that added conviction that it's acting right for you. So, and you know what? Some people don't even need that. Some people just have all their conviction on their idea, and they just barely trade the price. They're barely sensitive to the price action. Whereas I am a little more sensitive to the price action. I want the price action to kind of show me that the this is go time right now. Like I kind of need that oomph. Where once I see that turning point, then I'm starting to like go all in. I'm like, this used to be a really hard thing for me because, what I struggled with when I first started in prop trading was not profitability or consistency. I was consistently profitable right away, which is pretty rare. But I made nothing. I made like I didn't even make enough to get past living costs because I was such a piker. I was scalping around. I was taking profits quickly, and I was hit and miss, and I just could not put it all together to make actual real money. And it just took a long time. I don't even know how I got to the point where I am now, where I'm able to take pain on certain stocks for a certain amount of time and let it play out. I really don't even know how that happened. It doesn't happen by design, where I'm there's a careful process where I'm going to make myself do all of this and it's going to happen that way. It just happened through experience and through trial by fire. My instincts just get honed through repeated experience to the point where my emotions kind of work for me. I'm a very emotional person. And it's funny because I say that because I was just talking to somebody and he was like, I'm really surprised at reading your blog how emotional you are. I thought a trader is supposed to be like a cold-blooded assassin. I'm like, no, fuck no. I'm like a big head case. But these observations kind of give me an emotional experience that help me in the trade. They don't hurt me in the trade but by making me panic. They help me because I'm I know this is what is about to happen based on all the bullshit and the pain and the fire that I've been through. I know this is about to happen. I'm going to get greedy. I'm going to allow myself to emotionally get greedy, and that's going to help me in this trade. That's going to help me trade to win instead of trading to take profits and be green on the day. It's a totally different mindset. And those are my best days. Those are the days where trading is just awesome. And it's just I can't get enough of it. But it's also the days that can occasionally blow up my face and become the worst days too. So, it's a trade-off.
Well, let's get into that a bit more. I think that's really interesting how you kind of embrace the fact that you aren't a cold-blooded assassin, as you described it, and that you do allow your emotion to affect your trading in some ways. And I was reading on your blog before we got on this call, and to anyone who hasn't seen your blog, I strongly encourage you to check it out. It's incredible.
Thank you.
You do a really awesome job of it. You spoke about a point at the end of 2015 where you took your longest break from trading. You kind of lost confidence in what you were doing. Do you want to tell us a little bit about what happened?
It really wasn't anything crazy. In hindsight, it really wasn't anything crazy worth. I'm gonna say the Fannie Mae trade that I made, which is my most popular blog post, which is also my biggest loss ever. That was a crazy thing that happened. That's one of those where did that come from type of loss. What happened in November of 2015 when I took that break is I think it was just a really gradual buildup where I would have these on-off periods where I would just get into trading, get burned out, get into trading. I would take a 1 week break, and then a few months later, a 2 week break, and then a few months later, a 3 week break. And in November, my emotions were kind of at highs and lows simultaneously. So it kind of exacerbated that effect because I had made my best trade in the first 2 weeks of November by shorting this biotech, AVXL. And then I gave back more than half of that money by just being an idiot, and just donking away money by God. And, it just built up all this, all these negative emotions that I just couldn't really deal with at that time. I would wake up and I'd feel all this dread about trading and I'd be like, I'm sleeping in today. I don't want to have to deal with my mistakes from yesterday. And that's one of my kind of one of my weaknesses. A lot of really good traders I admire. I'm totally jealous of this. They just treat things like, oh, I lost a ton of money, but hey, next day is a new day, right? I can tweet that, I can say that, but it will never actually be that sincere feeling that I feel inside. I can carry a lot of baggage with me, and I'm a bit of a front runner. That's why consistency is very important to me. Being green almost all the time, Because when things when the wheels fall off, like I get really, really hard on myself. I start to feel that self-doubt, creeping in, and it just becomes impossible to trade. So I decided I have to take a break. I can't take this anymore. I hate trading. It's a love-hate relationship. I hated it. So it wasn't anything crazy. It was just bad trading, run-of-the-mill bad trading.
Right. And is taking breaks something that you like consciously decided that you were going to do, or is it just something that, like you said, these mistakes kept kind of happening and you just didn't want to face them and you just kind of got to a point where you couldn't be bothered, so you're like, I'm not trading this week? Or was it an actual something that was predetermined as like a good thing that you would have a week away from trading?
When a boxer gets like knocked out by a punch, did he decide to lay down in advance? That's how I want to put it. That's just the visual that came to my mind. Okay. You just reach your limit and then you're done. Like, I mean, that's how it is for me. I didn't calmly sit aside and say, okay, I'll just take a loose period and it'll be like, and then everything will be okay afterwards. It's just like, I'm just like, I can't do this, and like, I don't know when I'm going to come back and trade. I really don't. Like, maybe I'll never trade. I started having these worries that I'll never trade again, and I think that's what makes me trade again. So I'm always kind of on that emotional edge. In fact, I'm on that edge right now. I actually did have my worst month this October. It's my only red month. So I'm actually kind of on that edge. Not to the same extent, because I've had a good year overall, but still. I'm actually dealing it right now as kind of as we speak.
So why do you think that October was your worst month? Is there anything you can pinpoint that to?
I started trading these OTC names again. They used to be so lucrative for me. I haven't been trading them for what feels like 2 years because the order flow just died and people moved on. And then they started trading again, and they just became like, I mean, the way they traded, it was just so crazy. Like, the market makers take away all these routes and you can only route through ARCA, and it's like, it's just so hard to get in and out of the stocks. Whereas like executing on the OTC used to be a strength. It just became a sudden liability. I would get into the size and I couldn't get out of it. And so if I thought I was risking X, I ended up realizing a loss of 3X. And that just kept happening, and that got to me emotionally, and I started revenge trading, and it just became like this terrible spiral. And so there are structural reasons why I lost the money. I feel like I kind of ran into a buzzsaw in some sense, but in another sense, there's some indeterminate percentage of my losses that I would attribute to myself. I took existing losses and I probably made them a little worse. But for the most part, I think there was no way to avoid that buzzsaw, honestly. I could have made better adjustments for sure, but I mean, I kind of built like a muscle memory in how to trade certain stocks, and it just totally betrayed me in this circumstance.
Right. So, going forward for the rest of the year, obviously recording this at the beginning of November 2016, do you plan on doing anything differently, or are you just going to keep grinding it out?
I'm just going to keep grinding it out. I'm going to try to stay away from the OTZ, to be honest.
Now, reading around on your blog before we got on this call, there was something I read on a couple of your posts, and you talked about how you perhaps weren't pushing yourself as hard as you should, or going as hard as you could. Would you mind sort of talking to us a little bit about your thoughts around that?
Yeah, when I compare myself right now to myself like 4 years ago when I first moved here, like I feel like I was kind of like the model. Back then I was kind of like the model trader to emulate, or at least starting trader to emulate. I did things the right way. I kept a detailed journal. I come up with very detailed trading plans right away. I wake up like at 7 o'clock when the open was at like 9:30. I would trade the entire day and try to have detailed observations and learn from everything. I'd go through a detailed trading review at the end of the day. I was obsessed with trading, and I just wanted nothing more than keep pushing myself, set goals. And now I'm like, kind of ashamed to admit it, but I'm like the worst role model for like if I had to like teach aspiring traders like on a daily basis, I'd be such a horrible role model. I'd just kind of like roll out and just wing it. I'd be like, okay, what are I'd look at my filters and I'd be like, okay, those 3 stocks look good. I'm just gonna bag into it. I'm gonna figure it out on the fly, and I'll just play out my gut instinct, see what happens, and it works out more often than not, actually, which is what keeps reinforcing the bad habits. And I feel there are a lot of things I can get better at, and sometimes I don't consciously try to think about it because it's like it becomes a little burden, you know. It kills me to say this because I feel like I'm betraying the 22-year-old me who was just all about like excellent habits and pushing myself and all those things that people should be proud to do and proud to say. But like in some sense, trying less hard has taken the pressure off of me, and my results are, you know, aside from this month, are like as good as ever because I take the pressure off myself and I don't trade as tight. You know, I can get pretty tight on my risk tolerance. I don't really have a naturally high risk tolerance. It took a lot of work and trial and to just get it to where it is now so that I don't get shaken out so easily. And it still happens. But because of that, you know, a lot of my mental energy is just dedicated to making sure I feel relaxed, pressure free. I can just like let things go. Money's not an issue, you know. And just let it be, you know, free and open and easy.
Yeah. Okay. I mean, I really appreciate you being so honest, Peter. I think this is really cool. You know, this might be a bit of a strange question, but, you know, for someone who has been doing this for however many years now, you're profitable most months, or pretty much every month except last month.
Yeah.
Has trading become quote unquote easy for you?
No. Sometimes it's like deceivingly easy, and then they change it up on you. It's just, and that's what ensures that on the grand scheme, it's never that easy. I feel like when markets can change up even a little bit, even if your strategy still works, your timing method might be your usual timing method might not work. Even if your grand strategy works, your timing method might be really inefficient, or it might lead to more shakeouts and stopouts. It might be like less optimal, and that drives me to a lot of headaches. Where, you know, I kind of have like a template to execute a certain stock. I kind of follow that mental template, and then the stock trades in this crazy way where if I just did the opposite of that, not in the sense that I switched my buys up, but if I did the same execution, but I had the opposite idea instead of following that template, I did kind of a different way, it would have worked out instead of getting me stopped out. And that's what drives me insane, and that's what makes it never that easy. That's what makes scaling up hard, because I can never really follow that mental template all the time, knowing that they're going to change it up. They're going to find a way to make the improbable happen to keep me on my toes.
Okay. Yeah, I was just interested to hear your thoughts on that. I mean, it might probably a bit of a strange question, but anyway, we're getting on a bit here. There was one more thing I wanted to speak with you about briefly, and that's Bitcoin. What are your thoughts around trading Bitcoin? I know this is something you've dabbled in. What do you like and not like about Bitcoin?
I want to say what I used to like about Bitcoin was that it was just this new fascinating phenomenon 2 years ago. And anytime you have a new fascinating phenomenon, you have insane trading volatility, insane emotion, and anybody who is skilled at trading those type of environments, which is what I cut my teeth on, can make a lot of money. And that's what attracted to me in the first place. Like, a friend of mine at my firm showed me the chart, and I didn't even know what a Bitcoin was, but I saw the chart. I'm like, holy shit, I'm in. I got to trade that. And it traded much like the momentum names, the hype names that I trade that, you know, they kind of have a certain psychology and certain subsets of patterns to them, and I was doing great at it. So that's what I liked about it initially that attracted me to trading it. I feel it does not have that same level of craziness that it did 2 years ago, because it kind of sunk in. People have learned about it, and it's kind of a bit more entrenched. So if you look at the day-to-day chart, it doesn't have the same type of range. And that's only a minor problem compared to the serious problem of exchange security. The exchange that I traded almost all my volume on for like 2 years, Bitfinex, got hacked for millions of dollars worth of Bitcoins. And their solution to that problem, because they're not regulated and they don't have to they can just come up with the solution on their own and force you into it, is that they made everybody take a 35% haircut across the board, whether you were a cash holder or a Bitcoin holder or a Litecoin holder. They just made everybody take a 35% haircut. And it's not just Bitfinex, it's multiple exchanges. So I just don't feel safe as a short-term trader. I used to just leave my money in there thinking, oh, okay, if there's a crash, I can wake up and trade the volatility and make some money. How can I do that if I think I can wake up and see that it's hacked and I just lost half of it? It's a different ball game if you're a longer term time frame trader, because you can just store your Bitcoins in a wallet and see how it plays out. But for me, I was just in it for trading, long and short. I didn't care what happens to Bitcoin in the future. And for me, it's not safe anymore.
Yeah. So why are these Bitcoin exchanges so much more vulnerable to hacks like that over, other exchanges like for equities and futures and that type of thing?
I'm not the most technologically sophisticated to give a great answer to that. My answer would just be there's just less money and less and inferior infrastructure and security in those and security procedures in those exchanges. Whereas stock exchanges have been around for forever, and there's a lot of government oversight, and they've kind of created certain practices to prevent this from happening. And honestly, it's it's not like I don't know how the equivalent of stealing a stock certificate from a vault can be applied to stealing Bitcoins from an exchange, because even if some guy stole the underlying certificates, it would still be recorded on a bunch of different ledgers that the stock was in your name, right?
That's true.
So the same thing can't really happen with these Bitcoins, where nobody really knows who owns any of it. It's not logged to anybody. It's just all part of that exchange.
Yeah. Okay. So no plans on getting back into Bitcoin anytime soon?
Not for now, no.
Those days are over?
I hope they're not over. I hope I can come back. I mean, I want there to come back, because it means there's opportunity, but I think I got to be prudent with my money.
Yeah, no, that totally makes sense. Well, Peter, let's leave it at that for now. I just want to say thank you so much for coming on to do the podcast. I know I've been hassling you for quite a while, so I'm pleased I could finally twist your arm enough to get you on. Where can listeners go to find out more about you?
Just go to my blog, peterktoe.blogspot.com. I got to write more, but some of the existing posts are good, I guess. And that's about it. And I have my Twitter linked on there. Peter K. Toe. It's just my name. And that's it.
Okay, excellent. And like I said earlier, guys, definitely check out Peter's blog. He does an incredible job of it. Some really badass illustrations too. Good for a laugh. And yeah, I think that's it. Let's call it a wrap. Thank you very much, Peter. I appreciate it, man.
Thanks a lot, Aaron. It was a blast. Thanks.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, team? I hope you're doing just fine. My guest for this episode is Bryn Kelly. Bryn is an electricity, natural gas, and crude oil trader who has spent the majority of her career on merchant trading desks for the likes of BP, amongst others. She has also been a prop trader and has experience as a hedge fund portfolio manager also. A few of the key topics we hit on during this episode include Bryn's responsibility as head of trading desks, how she taught, trained, and managed newer traders, and an overview for how Bryn trades relationships using fundamentals and macro trends, and plenty more. For many listening, much of this may not necessarily be directly applicable to your own trading, but you will get some great insight to how things work from the merchant side of things. I really hope you dig it. Please welcome an awesome guest for episode 99, Bryn Kelly. Let's just get started. So probably the first question I'd like to ask you, Bryn, is, before trading came along, what were you doing?
It's a good question. I obviously, or maybe people don't know, so it's not that obvious. I did not start or enter begin my career in trading. I wish I had known about it when I first graduated from college with my little finance degree, but I didn't. My father had been a CPA, and I got my first job working for Cargill right out of college. I grew up in Minnesota, went to the University of Minnesota, and Cargill is Minnesota. So I got my first job right out of college working in, I guess, what you would call today the mid-office for the trading arm of Cargill, which at the time was called the Financial Markets Division. And I was responsible for mark-to-market, P&L, and everything that goes along, with supporting a trading desk for a group that traded baskets of stock on the Nikkei and the Topix exchanges. Very, very manual at the time, but I don't want to date myself too much. And from the moment I saw what that industry was like, I knew that's what I needed to do. And I spent quite a bit of the following years of my career advancement working to position myself in a place where I could get on a trading desk, which I ultimately did, thankfully.
Okay, yeah, and I heard you talking about this briefly on Anthony Crudelli's podcast, Futures Radio. And you said to him that you had to fight really hard to get onto a trading desk. Tell us a bit about that, like how so?
Sure. I guess anybody who's been, a kind of comeuppance in on a trade floor and in the trading world understands that there is not a logical career progression from the mid office or really any other office to the front office. You kind of, you either start, in a low rank position, work supporting a trading desk in what's called the front office, or you're on a different career path. So, I mean, I recognize that. I saw it, I understood that was the case. So I had to continue to look for opportunities where I felt like I worked for companies that had exposure and had trading desks, and where I could excel enough and get enough relationship with management or with the head traders on the desk so that I could make a move over. And it's not easy. I went through several different companies, and of course, along the way, I'm also advancing my career because I was young, and next thing you know, I'm the controller of Koch Industries in their supply and trading group. Getting a little worried that I was getting too far along in, another career, and, you become kind of untouchable. When you're you're too overqualified or whatever you might be labeled as to, move in to start your career over. But I was persistent, and I continued to make relationships with the trading desks, and really was laser focused. And I ultimately got my break, and it took, I think, about 7 years.
Wow. Okay.
To make that happen.
So when you came onto this trading desk, presumably you had no or little prior experience as an actual trader. How did you learn and get to know what you were doing?
Yeah, interesting. So I think there's a few things in the 90s, early 90s, when I did, kind of get my first role on a trading desk, and it was in the electricity industry, which was just deregulating and just getting started. But it was also prior to really a lot of electronic trading. So the understanding of trading was a lot more logistical and physical. So understanding the physical commodity that you were trading, and I was trading commodities and energy. It was very, very much about understanding the commodity itself and all of the logistics associated with it. So the fact that I had spent so much time in and around the physical commodity helped me out a lot more then than I believe it may help today, just as the landscape has changed to so much financial aspects to the trade itself. So I really was able to transfer a lot of knowledge from that standpoint, and I really just had to learn things like execution, the guts to execute, the guts and the willpower and the stamina to make a decision and take a P&L hit. Those were things I hadn't been directly responsible for prior to that. And those were things I think you either are able to do or you're not. And that really is a big differentiator, between the smartest person in the room and some of the greatest traders is, your ability to actually execute and live with and manage through crisis scenarios, because it's always an immediate crisis once you've put risk on.
And was that something that came somewhat naturally to you, or was it something that did kind of develop over those first couple of years?
For me, it was like I'd come home. I mean, it was so natural to me. I was always competitive, and And I loved it. I loved the black and white nature of it. I was so thrilled to be gone from a career where things were based on nebulous items, performance reviews and who you knew or what you did. And it was really right on down to the black and white. And I just felt like that's exactly where I belonged. And I was so happy.
Awesome. So did you get much help from other traders on the trading desk you were a part of?
Yeah, my first, when I got my first break, it was at a merchant power and gas company in the Midwest, US. And since it was startup, it was very much a team that was navigating through this uncharted territory that had not really existed before. So it wasn't like just sit yourself down at a desk and there you go. There was a lot more dependence and team reliance on strategies, trading strategies. When a specific commodity is deregulating, there is a lot of arbitrage that is wide open if you can understand the logistics. And very early on, what our team did was surround itself with very strong logistical people. And we were all coming together and finding these opportunities. So from that standpoint, I was really, really lucky that I wasn't just, trader number 72, here's some capital and have a good time. It was really building a business.
Okay. Yeah, that makes sense. And, during this time, was there anything which was particularly challenging for you?
The landscape did change enormously in the 10 years. In my first 10 years, and it actually has changed enormously in the next 10 or 15 years. And that's always a challenge. The market went from no transparency to some technology and transparency. And, you almost could think about it like you hear people who have worked on the floor of any exchange quote they'll use, back in the day. And it was one particular way. And you made a living in a particular way based on, the flow of information. And the same thing happened, especially in electricity, but even, in all of the commodities, there was a period of time where if you could make relationships geographically across the US, you could make money. And it seems quickly now evolved into something much different where contracts were not bilaterally limited. In the beginning, you only could transact with people via a bilateral contract. So it limited the amount of people who could be even playing, who could show up at the table. It wasn't like you just opened up an account and posted some margin. I mean, you had to negotiate with another firm's credit department and individual bilateral contracts that you were, backing all of your trades with. So there were a lot less players, a lot less transparency, and that was definitely a challenge. Can you move from going back to the example of the floor to when it went upstairs, quote unquote, and everything was electronic? It requires really a huge shift change in your skill set. And that was a challenge for sure.
Okay, so when you say bilateral contracts, I'm not really sure what that is. Would you mind explaining that a little more?
Sure. Yeah, that tells me how much they're just, that's how much it's changed. For example, when I worked at BP in the 90s, and counterparties were Enron and all of the other kind of trading counterparties that you can think of in natural gas and electricity, you traded directly with each individual company. So there were voice brokers that are OTC brokers that would call, and you would have a squawk box and they would make you markets, but they weren't online. And when you hit a bid or lifted an offer, you were given the counterparty's name that you were done with. So you could transact with people in the market that you had set up a bilateral contract, meaning that we can purchase and sell to your company via our credit rating, via posting some collateral with that other counterparty. So every single credit relationship was individual. And when you were transacting, you were transacting specifically with the counterparty, not with a clearing bank. So it was, looking back now, completely inefficient, right? Because you were having to post collateral with a lot of different people. There was no margining on these contracts. So there was just really a netting of purchasing and sales. And even in the very beginning days of, for example, Intercontinental Exchange, when you hit a bid or lifted an offer, your trade ticket revealed to you who your counterparty was, and it was not a clearing bank. It was a physical utility purchasing, and there was a lot of knowledge in that. There was a lot of knowledge available once you found out what counterparty you were transacting with that just doesn't exist today.
Yeah, I had no idea. So you spoke about working at BP there. I'm really keen to spend a little bit of time on that. So what exactly did you do at BP? What was your role there?
Okay, so just to preface that with, most of my career history in energy trading has been on the merchant side, and BP is an example of that. So BP had a merchant trading group, meaning it was unrelated to their core asset business, but it certainly, enhanced, or you could consider it a diversification of the business that they were in. So for me specifically, I was in their gas and power group, which was in Houston. It wasn't my first merchant group that I'd been involved in, but when I started there, BP had just recently purchased Amoco. And hence that's why the office was in Houston, because Amoco that's where their core business had been. And Amoco was in natural gas. So BP had a merchant trading group called BP Energy Company. And it was primarily electricity and natural gas trading on a speculative nature. So it was not trading any of BP's production. It was, the group didn't own on it, any assets per se. Now they did get involved with moving production that BP had, but it wasn't, it really, other than molecule flow, there wasn't a lot of proprietary information that you had. So it was a speculative group, and I ran the Eastern electricity desk. So over the course of the, 5-7 years that I was there, I built from 2 team members really up into a fully integrated desk that consisted of real-time electricity traders all the way through to term electricity traders. And what we did was try to make money. We essentially, I set the desk up to look like a virtual power plant. So if you don't actually own a power plant and you're not having to dispatch electricity and deal with real-time flows of electricity and moving power across the US to various grids, if you have a real-time trading desk, which is staffed 24 hours a day, 7 days a week on 2 shifts, you essentially can look like you have a power plant by buying and selling every hour on the hour. So you're basically calling utilities all around the U.S., purchasing their excess or selling to them if they have a deficit, and then sourcing it speculatively in a way, but it's via your relationships that you have across the country. I mean, you're taking price risk on an hourly basis. All the contracts are firm with liquidated damages. So it's very interesting. So I ran everything from the, real-time hour-to-hour group all the way through to supporting a marketing desk and taking risk out 10 to 20 years. So on the other end of the spectrum, there would be a marketing group that also worked, for this BP Energy group that would go out and meet with utilities or users, long-term users of electricity, and try to do a 10-year deal with them, sell them power for 10 years that was shaped a specific way that was different than, if you look at a NYMEX contract, right? Like if we'll take natural gas, for example, it's 10,000 MMBTUs. And even more specifically, it's 10,000 MMBTUs per day is generally the delivery at Henry Hub. But marketers will be out meeting with people across the US, and they might find a customer that needs 6,000 in the evenings and 22,000 during the day, but the option not to take any on Sundays. And they come back to the trading desk and they say, I need you to give me a price on this. So of course, as a trader, you have to be out in the market. You have to know what's going on, what basis exists between different locations, and you have to provide a 10-year non-standard price that requires different volume optionality and whatever to this marketer. And if the marketer goes to the customer and the customer, accepts the deal, then as the trader, you now have this deal on your books. And so you end up with an accumulation of non-standard deals that you have to figure out a way to hedge. And when you ultimately go to delivery with them, you have to optimize and figure out how to make money off of it. So it's a pretty diverse role when you're in the merchant side of the business. And the hub products that are listed on the exchanges are really such a small part of it.
Yeah, so I mean, it's safe to say that most of your trading there was done off the exchange, right? Like it was off exchange is what I mean.
I'm trying to think about the right way to put it. I would say that pricing and delivery of deals, once you take them to delivery, was not to or from the exchange. The exchange is certainly used as a price benchmark. So you have to be very familiar with, for example, if I was pricing a deal in the Northeast, with the cost of pipeline capacity in the Northeast and how much risk you're willing to take on that pipeline capacity in a winter month. So there's a lot of pricing of deals that are off exchange, but risk is laid off generally at hub locations. So I don't know if it's exactly that it was so much off exchange. It's just that's only one part of it. Any merchant portfolio does not consist, even a producer of any commodity, they don't get the exchange price. Their wellhead or their generation point of the commodity is nowhere near where the delivery point of the exchange contract is. And so while you might think that natural gas is $3 at the exchange, it's well known that producers up in the Pennsylvania area are getting a third of that because it costs them $2 to get it to the delivery point at the exchange. So everything is relative to the exchange, but it doesn't, change the complexity of the story.
Okay. Yeah. So when you talk about, having to actually make deals with other merchants,
yeah,
how long would that take you to actually put a deal together and close that deal and actually make the transaction? Like, what sort of time frame are we looking at?
So marketing deals can take a long time to get to the pricing of the contract. From the day that a trader gives a price, that price is generally good for a few hours, overnight potentially, in today's markets and in really all markets since, years, you can't leave a price open. It may take 6 months for negotiations to lead to, a price quote, whether that's getting contracts in place, submitting a price once and nothing happening and them calling back. But once a price is given, that price is only good for, generally that day. Because as a trader, I can't give someone a quote and then not know if I have if I need to lay off risk or not, because the minute the deal is done, it's, the trader's responsibility to lay that risk off in a way that they think will make the most money for the company, and then continue to manage that risk and optimize it.
Mm-hmm. Okay. So this sort of thing that we're talking about here, I mean, it's quite different from what we've spoken about previously on the podcast. Is this kind of the real reason why futures commodity markets exist?
I suppose it's chicken and egg, but for sure it is the, exchange contracts are price indicators, right? And if there was not a liquid, reliable forward price indicator, it would be difficult to do long-term contracts because people would always feel like, they would never pull the trigger because they wouldn't know. They would feel like they had no price information. And it is certainly a reason why a lot of the futures contracts move. It's always based on, sure, there's speculation day to day, but in reality, there are real consumers and real suppliers doing long-term deals in the market. There is an airline purchasing, 2 years worth of fuel supply from a bank, let's just say. And now the bank has to go out and hedge that, right? There is a utility locking in their, gas for their power generation. And so they have to go out into the market then, whoever sold it to them, right? And lay that off. So it's a constant push and pull of, were a whole bunch of supplier deals done in the market or a whole bunch of producer deals done in the market? Because of course they're never going to be done at the same time. But generally who those deals are done with is how you can understand, what will end up showing up in the market. So many of these deals, for a long time and probably even still today, airlines haven't had the best credit and the best balance sheets. And really even producers, small producers, it's not as if they can just go out and sell the exact price on the exchange. They're delivering a product that is interruptible, right? If you're producing natural gas and you're selling it into the market and something happens to your well, you're not going to have that production. And so it's interruptible. When you're selling your product on an interruptible basis, you're not going to get as much for it because the exchange products are firm with liquidated damages, meaning that if I sell NYMEX natural gas futures and I deliver on that and my supply gets interrupted, whoever I sold it to has the option to go in the market, purchase supply at whatever the prevailing market price is and bill me for it. And producers are not in that business. So when we talk about producer hedging, what they're doing is selling to an intermediary that's willing to take that risk. So they're going to give them less money for their Cal 2017 product. And then they're going to take what's called the firm or interruptible to interruptible to firm risk. And there can be a lot of different, basis in that. It was one of the fundamentals of the, first 3-4 years of electricity trading that I was involved in, and not just me, but, the industry. You bought electricity generation from a utility on what was called non-firm, and then you sold it into the firm LD, liquidated damages market, which is what all exchange products are, and you take the risk that you'll be able to resupply it and you'll make more overall than you'll lose. But, people don't think of that when they talk about producers hedging. Producers just don't get to go out and sell 100% of their production into the NYMEX firm market. They have to sell either to a bank intermediary that will accept their C-rated credit or BBB minus credit. They'll give them a huge haircut, and they'll also give them a haircut because their product is interruptible. So there's, I find it very interesting just listening to high-level commentary that's done on some of price action on exchange products, because that it's really only relative to people that are not going to delivery or aren't, are willing to take that risk, the firm to non-firm.
Yeah. I mean, this is all very interesting and much of it is quite new to me. So, no, very interesting.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
You know, in a number of roles that you've had over the years, I was snooping through your LinkedIn profile before we got on this call, and I noticed that you were hiring and training new employees in several of the roles you've had. Were you training traders specifically?
Yeah, if we're going to talk about the past 20 some years in trading, then yes, it was if I ran the trading desk, I was responsible for the hiring and firing of everyone on my desk. And that could include P&L analysts, so clerks that, entered trades and did, that kind of thing, to, traders that I would bring right onto the desk. So absolutely. I mean, as the head of the desk, you're responsible for, wherever it is that experience level that you brought them in, training them, and it's a hard job. You could be having your own bad day trading, but so could three of your staff, and you have to be able to pick them up and teach them the lesson and get the most out of them, regardless of what's happening in your own book. I mean, it sucks on a day if a trader comes to you and says, hey, I'm down $2 million. I mean, that's part of my P&L, right? I mean, I'm the whole desk. So you have to learn the art of, teaching somebody to navigate through a crisis, and also determining if it's a fireable offense, although those are generally very clear. Luckily, these days there are things like hard risk limits and volume limits and whatnot. And I mean, really, you almost hope someone violates something like that, because then it makes it easier if you have to let them go versus if they're just kind of not very good for a while.
Okay. So what were some of the things that you'd teach these people when they first came onto your desk? Let's presume they don't have much experience trading. What were some of the first things you'd really try to drive home?
Well, for junior traders, knowing the systems that support, the desk, I think for me, and it could be the way that, I came up through my background, you have to know whatever system it is that is supporting the trading business. And by system, generally people refer to them as like an ETRM system, or maybe they call them your P&L system. How are trades getting captured? How are they getting, organized into your book, your strategy? How do you know how, to have clarity if you've had an error in that? Because, I mean, of course, understanding what your position is so that you can trade it is the most important thing. So I personally never tolerated people saying, I don't know. The system says I'm long 100, and, they're not. It's their responsibility to know what's going in and out of the system that is there to tell you how much risk you have. So for me, those were very, very basics at the very beginning. And for me, I didn't tolerate people who threw their hands up about quote unquote the system. Probably doesn't happen today. I don't know. Everybody knows how things flow, but it still seems like people find it a mystery how a corporate ETRM system works, and they have no ability to problem solve. They're like, I don't know. The system says I'm long 50 and I think I'm flat, but no ability to figure out how that error could be there. I mean, could be massively costly errors. So absolutely 100% know your position and know that it's right, because the amount of price movements and the amount of P&L errors you can have if you don't know that. And maybe that seems like a funny thing to people who are maybe, right now trading online with some broker and all of their trades are there. But in a more dynamic scenario where there are trades and positions and they're physical in nature as well, coming in from, a multitude of areas, it's a little more complicated. So number one, I always was a stickler about that. And then two, I guess what I really did was train people to have their opinion and not overmanage when they're wrong. I had teach them things that I look at, indicators that I look at, suggest, market thoughts, but you don't want a clone of yourself. So it's definitely about getting someone else's thoughts out of them and giving them enough confidence in those thoughts. You can't really, there's no manual, you just learn the commodity and you learn the flow and you learn it by sitting there and you really learn it by, your holy crap moment when you're responsible. So
yeah, so you spoke about a couple things that almost frustrated you there. How many of the traders came through, were able to do this? Were there traders who just didn't get it? You got frustrated with them and they ended up making some errors and you had to give them the boot. How many traders kind of made it? How many didn't? I don't know if success rate is the right word, but that's kind of what I'm getting at.
I don't know actually that I've ever looked back at it and given it a percentage number. I have fired my share of people who weren't cutting it. And I've also moved people to roles that maybe were more suitable to them. There a lot of times the way a trading desk can be structured is the hierarchy seems to go from scheduling or ticket entry or, very, more manual type of data collection roles to shorter term trading to longer term trading. And so many kids starting on the desk sort of thought as soon as they were, a long-term trader, then they were, that was the right progression. And I can't tell you how many times, there'd be some young trader who was responsible for just trading, 1 month in, right? They had a short-term duration, who believed that the longer term duration was, where it was at. And, I'd give them a chance and you'd find out that that wasn't the case. And so a lot of times it was just educating and moving them back into the shorter term role. I always felt and tried really hard to make it known that as long as you're making money, it really doesn't matter which part of the curve you're trading. So don't try, to be at a different part of the curve. A bottom line is a bottom line, but that did happen a lot where people tried to come, they wanted to come to the next table and didn't have the skill and they were either fired, or demoted.
That's really interesting. So why do you think it was that the shorter term traders wanted to become longer term traders? That seems really unusual.
I think there is a majority of structures that can exist at companies where the longer term traders have exposure to more capital, have access to more capital. It just takes more capital to commit a 10-year deal than it does to commit a 1-month deal. And so the stakes can be higher as far as, your P&L targets. And so the money, the payouts can be higher. However, those are the people that also get fired more often too. I mean, you have to understand that, the higher your P&L targets are, the first one you are out the door. But there are so many structures that exist in the industry where the term traders get paid more. So because they have access to more capital, but it's not always the case. And I think, it was my responsibility to guide and to make sure that somebody who was just trading next day or next hour power, had this, same drive and understanding, and access and the ability to deliver to the bottom line. There are some schedule things that are crappy about the shorter term duration you have as well. So, if you're working on a real-time electricity desk, you're on 12-hour shift work. So, of course, you'd want to get off of that, right? And move up to a day job versus working, 6 p.m. to 6 a.m., 4 days in a row, then off 3. There are some schedule things as in any, sort of career advancement, right? Whereas you move up the ladder, there maybe is some more flexibility. And the assumption is there's more money, but I would argue there isn't always.
Okay. And why do you think it was that some of the shorter term traders found it difficult to transition to more longer term trading?
The knowledge isn't necessarily transferable on the fundamentals that make sense in the shorter term versus the fundamentals that make sense in the longer term. They're very different. And if you want to get really granular, you could talk about, if you were thinking about electricity or even like cash natural gas, right? Next day natural gas. The fundamentals of the pipeline relationships and the capacity available and weather is very different than the fundamentals that would drive a Cal 2018 trade. You could look at interest rates in 2018. You could be concerned with LNG. There's a different, it's just a different set of market influences. And I think that can catch a lot of people making that move. They've got their arms and they really are good at the fundamentals that drive the short-term market. And it's just not the same.
Yeah, no, that really makes sense. Actually, that's a good answer. So, bringing us forward to current times now. What's your current situation, and what type of trader are you today?
So, having spent almost all of my energy trading career in merchant roles, I definitely am a much more fundamental trader, in that I care and I pay attention to, and I guess the way I trade revolves around relationships of one thing to another, because that's how my whole experience evolved, whether it was the relationship of power at point A to point B, or it's all the way, evolved to a frac spread, right? Or a heat rate between electricity and natural gas, or, LNG, or, gas in one point or another, or, as ethane factors into the picture. I really, my approach is that I like the bigger picture. And I'm always interested in how relationships are changing. And I mean, I'll even call algorithmic relationships part of that. So that's how I look at the market. I have done a couple stints at prop shops. I don't know if it's just because that was not how I came up. I don't find specifically an exact technical charting, exact reversal entry point, scalping type of thing to be how I approach the market. But there's a lot there. There's absolutely a lot there. I kind of wish I maybe had a little bit more of that, but I can't force something that's not there. And I focus more on relationships and structure when I look at the market.
Okay, cool. Well, let's talk about that a little bit more. But just before we do, like, what's your current situation? You said you've done a few stints at like prop firms and that sort of thing. And I know you recently were managing a fund at Millennium Partners. Have you since moved on from there?
Yeah, not by desire, but it's what you sign up for when you sign up to be a trader. I was until last year, I was was portfolio manager at Millennium Partners, which is a hedge fund in New York City, and they had started up or allocated funds towards commodity only trading. Not that they weren't involved in commodity trading, but it was more embedded within equity groups. And I was their first electricity trader. And I would just, I guess, say that at the end of the day, it wasn't for them. Their systems that weren't geared for it. Their understanding of the market wasn't deep enough, at all. And it's not anything. I mean, they're a class organization that, was trying new things, and it wasn't, I would say that they weren't probably quite ready for it, and good for them for knowing that they weren't, that they're just, it's one thing to have a corporate system to handle equities and debt. It's another thing to have a system that can track the hourly flows of power, and it's very complicated. And I've even written prior to one of my prior roles. I went to work for a software company as a subject matter expert and designed from scratch an entire ETRM system just for power, because it is that complicated to model and handle. So they gave it a shot for a year, and the black and white world, they said not for us. So I'm back to as most, I think, traders who can't, it's in my DNA, working on, sort of managing some family money and doing some of my own trading and working on a bunch of different startup ventures and anything, related really to what's happening today, especially in the deregulation of electricity. I think it's fascinating what's going on. And it's hard to even pick somewhere to focus. It's fascinating.
No, that's excellent. Very good. So going into sort of your trading methods and the way you approach things, you said that there wasn't, I can't remember exactly the wording you used, but you said like you don't see an exact entry point on a chart and that sort of thing. So how do you turn these observations and these relationships of macro trends, how do you actually turn them into actionable trade ideas? Like, how do you go from having an idea and seeing something, anticipating something, and then actually executing that?
Tough question. So, like I said, I am a student of relationships, and I respect, areas on a chart or sentiment and all of that stuff, but it's not like, yeah, you're right. It's not how I use to get in or get out. I find a few things can tell the story pretty easily, and that is time spreads. So calendar spreads along the curve. And I, just like, not you can be right or wrong, but for me, you could take an example of the situation this summer in the United States with natural gas and the structure of the price curve, and how do you translate that into something actionable? And all summer we saw the daily cash prices exceeding really the balance of the month or the next, the prompt futures contract. And to me, that is actionable because that tells me what will happen with storage operators. And luckily it played out, right? If you own storage and you could either buy some natural gas in the market today that costs more than natural gas for delivery in the next futures month, you're just going to wait. And of course, this is a simplified, people will call, people have to ratably inject into storage. I understand that. But there is a global macro kind of step back, effect that the price curve can have on what ultimately plays out in the market. And so for me, they're very obvious. And the actual price, I don't care if the cash market is 5 cents over and we're talking about $10 and $10.05. I don't really care what the actual price of it is, even though people want to focus on that and ask about and talk about all the time. What's a good price? Do you think $3.50? Do you think natural gas will go here? Do you think crude oil will go here? I don't actually care. I care that the spread levels tell you what the next move is going to be. And so I certainly like either trends of relationships and spreads or outliers, especially if there are certain parts that I think will mean revert. So a lot of calendar spreads can, get pretty far from the mean. Doesn't mean that, it can't go another 3 standard deviation outside of it. So, but if you believe that something will mean revert, then you're never going to pick the exact point to get into it. But, put enough on it then that you can, stand to wait until that mean reversion happens. I don't know if that was specific enough.
Yeah, no, I think that gives us a pretty good overview of how you're approaching things. By nature, you're a longer term trader. When we talk about longer term, like what are we referring to? Like what's your average holding time for a given position?
It's gotten shorter, that's for sure, because the markets are really different now. And no matter where it is in the term structure, I would say probably not more than 3 months, because you're just not going to have enough. By then, either the spread you have on is going to delivery. It's gotten a lot shorter, and some of the moves have gotten a lot more violent, definitely.
So why do you think that is? Why do you think, like you said, the moves have become more violent? And what are some of the other really big changes that you've seen yourself, having been done this for now over 20 years?
Well, of course, this is just my opinion, but I think there is a whole generation of, number one, trading itself is more accessible. So the pool of players, market participants, is just so much bigger than it was even 10 years ago. And, beyond that. And we could go back to my discussion about, bilateral contracts. This central clearing of all contracts is not that old. It's relatively, a newer phenomenon. And Dodd-Frank kind of helped that along as well. So the pool of market participants is so much bigger. And the transparency, the market transparency is also, it's more transparent. There's just, everybody and their brother can see what prices are. They don't have to wait for the newspaper to be printed or not have, access to something online. So there's a lot more participants. There's a lot more participants with shorter durations. And so, they can get pushed in and out quicker, with, less capital that they're applying towards their trades. And I mean, high frequency trading, or I don't even know what you call it, but I'll call it algorithmic trading is really where it's at. And I'm not saying that for me personally, but if you could imagine when there were market makers on the floor of an exchange before we went to the decimal system, and so the bid, it was like a half by a quarter, and the spread between, being a market maker was so great and lucrative that's all you had to do. That exists today for algorithms, and it is being exploited until it's not there anymore. And what I mean by that is relationships that exist between when people start buying soybeans and then how that ultimately flows through to ethanol, or, I'm not even using that far reaching of an example, but it's all the psychology of all of that and the ability to execute those relationships faster and faster and faster is what's happening now. So it's an amazing moneymaker for those who are buying tick data and developing relationships and running, machines. And I don't mean big, huge ones that are pushing it around, but, you add a psychology component into it. And, we've just taken the fraction system on the floor before decimals to a new level. And that's where I think it's coming from. I'm not saying, I'm not making a judgment at all, but I think, you can't be naive and not understand, which, really kind of goes back to what I like best is understanding relationships. It's just that people are doing it using computers at, levels that are beyond me.
Yeah. And do you think this has made it somewhat more difficult to be a fundamentally driven trader?
It's made it more difficult to be a fundamental trader if you don't have enough capital.
And what do you mean by that?
There are a lot of scenarios in which the fundamentals will ultimately win out, I suppose. Is that the right word to use? But a lot that can happen until that does. And if you don't have enough capital or enough VAR, and you're constantly getting chopped and stopped out until your fundamental play happens. We can, let's say the deviations from the mean have gotten bigger. And so if you have a $10 million VAR and you can ride, that $50 million P&L swing, or you can ride that until you come back and make, your money instead of having to stop out and then try to get in. I mean, then you're just chopping up your capital the whole way. So the tolerance to, take those hits. And I don't think there's as many players as there used to be that can do that. Or it's very concentrated. It's very, very concentrated. And even hedge fund structures aren't as much like they were in that they silo out allocations of funds so that any one group may not have, as a whole, it's a lot of money, but individually risk limits, they keep being parsed down further and further. And so, a simple thing as a front month spread, like, December, January, so many players have to get out of that spread before even the last day in futures because of, T+1, margining limits and whatnot. And, if you don't have enough capital to post it, or you can't risk making or taking physical delivery, the amount of players that can actually take advantage of the real fundamental story playing out is smaller. So there's just noise on the intraday.
Yeah, now this is a question that I'm pretty interested to hear your response to. And I'm not quite sure what the best way to perhaps frame it is, but, you've spent your entire career pretty much focusing on this sector. How well would you say you can actually read the market? Like, are you often surprised by certain things that happen which are opposite of what you'd anticipated, or does something like that really happen now?
I can say that I'm not surprised, but I wouldn't want anyone to mistake that for that I get it right. I could tell you, I was more surprised in, I guess, was it the end of 2014 when crude was trading $80, $90, and the fundamental nonsense and stories and whatnot that went on when, for sure, there was no other path other than $30. The calendar spreads told you that, everything did, and yet. So what can surprise me still is the interpretation, the story, the blinders, that the signals that people are unwilling to pay attention to. That can surprise me. Or now after a year and a half, 2 years of markets cratering, in energy, everybody still wants to be on the story of full storage. It's like, move on. But full storage after 2 years is not the same story, right? As after people have had to try to cut and do this and that. So I guess it does. Yeah. I guess what continues to amaze me is interpretation of the story from the market. I'm certainly not saying that in a way that I'm, that means I get it right. It's just the fundamental story is can be pretty obvious, but you can't trade fundamentally alone either. That you'd get killed.
Of course. Yeah, no, I think that's a good response. So, Brent, I'd just like to ask you a couple more, I guess, sort of more general questions, which might be really helpful for anyone who's listening to this podcast, anyone who might be an independent trader who is sort of just coming into things. Like, what would you say to someone who is entering this business of trading? What would you say to them to ensure that they have realistic expectations?
Okay, good one. So, and I heard you say independent. So at some levels, are you talking about someone who might be just
trading from home? Let's say that. Trading
on their own. Okay, so I've said this before and I'll say it again. You have to decide if you're trading, from on your own, if it's your hobby or your actual business. Because a lot of people have a hobby of, restoring cars or, whatever it might be, but there is no chance they could ever make a living at it because it would take marketing and buying, setting up a shingle and advertising and blah, blah, blah. You get the gist, right? So, do not for 1 minute, misinterpret, you decide, is it a hobby or if it's an actual business, and you need to check yourself all the time if you're deciding that it's a business. And, not everybody makes it in a startup business. All across the world, people try to start up a business and they don't make it. If once you do that, you can't just, that's not the right word. I would recommend don't spend your whole time, especially if it's your kind of first career, just trading on your own. You got to step in and out of things and experiences throughout it. So go work for some place for a while, and then maybe do it on your own. You will not believe the different perspectives that you'll get and how much it will evolve over the years. It will blow your mind, what you think you know and what you can learn. And I would never limit myself to just, trying to master a skill, on your sitting alone and banging it out. It's no fun, and it's not going to lead to a very well-rounded person. Go do other jobs within the trading world, whatever that looks like, right? Work at a broker desk for a while, go, be an analyst for a bank, in and out. If you do a full-time, you do a part-time, you got to have more, you got to continue to get other experience or push yourself, take classes, but don't assume that it's as one-dimensional as you think it is, whatever that dimension is, because it never is. It's never that one-dimensional.
So that's really something you do strongly encourage, is that, someone does try to get some sort of job related to trading.
Well, and maybe I'm old school when I say job. I mean, maybe it is that you can get that perspective and knowledge other ways, right? Through social media or something. I mean, maybe I'm just too old school, but, don't just align yourself with people doing the exact same thing that you are.
Yeah, sure.
I mean, certainly you want that, but, push the dimensions hard.
Yeah, no, that's good. That's good. And when you say you've got to decide whether you want trading to be a hobby or a business, for anyone who might not quite understand what you're saying there, how would you differentiate those two things?
So trading hobby is, you're not focusing as much attention on it as you would a full-time job. I like seeing people say, oh, I'm trading, and so I can go out on my sailboat or go do this in the afternoon or do that. I don't know any other startup business owners that do that. I don't know someone that's started up a restaurant or opened up, some app whatever the startup Silicon Valley things are. I mean, I don't know anybody that's like, brags that they can do it for 2 hours in the morning and then move on. A business is a business, and you are, devoting your endeavors to that 60 hours a week, 70 hours a week, and you're not putting bad trades off a side, in another account. I mean, you have to hold yourself accountable, and you have to be constantly expanding your business. So that in no way, shape, or form do I like comparison. If it's a business, it's a business, and everybody knows what a business means.
Yeah, I really like how you talk about this as a business. Like, a lot of people say you got to treat trading like a business, but you're really sort of saying that trading is a business, you know what I mean? Like, even if you are an independent trader, you need to treat it as though you're actually, here you are, you're starting a new business, and you've got to run it like a business. So
you got to run it. That's right. Absolutely. And you business plan, sales techniques, they all apply. They all apply. Not that you're selling things so that, some other, but maybe you should be. Maybe you should be also thinking about honing a talent that you could turn into something sellable based on your information, that you're getting in trading. I mean, it's just not swatting the market around on the screen a few hours a day and then going, but I'm sure people are going to laugh at that and say, oh, that's what I do. It's so great. I mean, I just wouldn't say that that's a majority of people.
And what if it's not feasible for someone to put in, like you said there, 60 hours a week into their trading business because, they're just not that profitable as a trader to be able to, that they need to have some income to, support their day-to-day living.
Yep.
What tips or pointers would you have for someone in that position just to make things a bit more feasible?
Well, I mean, if we're going back to the hobby scenario, right? I mean, you may like to refurbish cars in your spare time, but you can't quit your full-time job for that, right? But you can still refurbish cars. I think if you want to allocate money towards something that you enjoy, which is looking at investments, that's a good hobby. If you want to progress towards a career as a trader, then apply for a job involved somehow. So because if that's the thing you need, right, an income, then go be, please, I'm just using examples. I don't mean these, but right, like a clerk on a desk or an analyst or intern for something, and join an investors club, something, right? I mean, if that's what you're trying to progress to, then work your way into it, just as you would try to work in your way into it from any hobby that you had, that you were trying to turn into something you wanted to make a living off of. I just, take a serious road towards it, right? I mean, anybody could imagine what they might do if in any other business they were trying to leave their current job to move towards full time. And there's a lot of preparation that goes into that.
Well, Bryn, let's leave it at that. I just want to say big thanks for doing this. I mean, I've really enjoyed it. This has been very good. So where's the best place listeners can go to find out more about you?
Well, I'm on Twitter. I think that's where a lot of people find me, at Bryn and Rick, BRYNNEANDRIC. Or that's a great place to find me. You can check out my LinkedIn, but yeah, I'm on Twitter. At the moment, the only time in my career where I have been able to use Twitter, when I've never been allowed based on corporate employment to actually speak via Twitter, and I'm just taking full advantage of it and trying to get my market my market research style out there.
That's very good. So at Bryn and Rick is your Twitter handle. Anyone listening, go follow Bryn on Twitter. And Bryn, I just want to say I really appreciate you taking the time to do this. Thank you very much.
Yeah, I enjoyed it. Thanks a lot.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
You see what I'm saying? So all these questions are all personality questions. So like I tell people, trading, only a small part of trading is mechanics.
Chat with Traders, collaboration with Quantopian, episode 2. Hey, what's up, folks? Welcome to the second installment of the mini-series in collaboration with Quantopian. On the previous episode, we discussed various biases that traders and investors can be affected by. On this episode, we begin the discussion by talking about the things that quants consider when determining their trading universe. From there, we explore alpha factors and risk factors, and then we finally go through an example of how all of the above are relevant in an actual trading strategy. Delaney is with us again for this episode, as he will be throughout the series, but we are also joined by Jess Stouth, who is the VP of Quant Strategy at Quantopian and has a pretty impressive background in the field. This is the point in the series where things do become more specific to quantitative methods of trading and slightly less relevant to those who favour discretion. But still, there's no harm in listening if this is something that interests you. As the subject starts to get a little more advanced, I would encourage you to listen over this episode twice if need be and make use of the resources that we mention throughout the episode. All of these have been curated for you at quantopian.com/chat with traders. So anything that gets mentioned, you can find there all in one place. Also, if something doesn't make sense to you and you would like to ask a question, you can do so at quantopian.com/questions. We will do our best to tackle all questions on part 6 of this series. And before we get going, I'd like to say a massive thanks to DataCamp for sponsoring this series. You know, I often get asked by traders who want to learn how to code, where should I start? And honestly, I think DataCamp is the best place, in my opinion. They specifically teach you how to work with data, manipulate it, visualize it, and run statistical research, all using programming languages Python and R, which are, of course, ideal for quantitative trading. For more info and to start any one of their online courses today, for free, visit datacamp.com. All right, guys, let's skip to my discussion with Delaney and Jess. I hope you enjoy it, and thank you so much for listening. All right, well, Delaney, how's things, man? What's new?
I mean, that's a loaded question because we're always doing a lot of stuff here. So I don't know how much time do we have for just that question alone, but a lot of stuff is the short answer. And we're just kind of busy all the time.
Excellent. Keeping busy. I like it. Now, we also have Jess Stouth joining us for this episode. Jess, how are you?
Great. Thanks. Thanks for having me.
No, my pleasure. It's excellent to be speaking with you. So, I mean, tell us a little bit about your story, Jess. Share with us a bit about your background. I think you were originally a physics and chemistry teacher, right?
I did 1 year of teaching physics and chemistry, but I'll certainly take credit for that. So my background really was in basic research, did physics undergrad, but I went to UC Berkeley and did a PhD there in biophysics, which is a very, very broad field. I ended up in a computational neuroscience lab. So I learned a bunch of analytic techniques there for analyzing complex large data sets, really enjoyed data analysis, didn't really enjoy all the data collection. And so really looked at quant finance as sort of the best possible world where you got to ask really interesting, complicated questions about large data sets, but you didn't have to necessarily go through all the blood, sweat, and tears of putting grad students in an extremely high magnetic field. So that seemed attractive to me. So I took my first job in San Francisco, actually, for sort of a quant modeling research team. So I became a quant analyst, got to learn a lot about the financial markets and specifically equity stock selection models. So at that company, Starmine was called at the time. I did things like building a stock ranking model that took inputs like how much short availability for certain stocks was there. So I spent a few years there. That company was sort of a startup. They got acquired by a much larger company called Thomson Reuters. So I spent a few more years there, kind of more broadly looking across their quantitative analytics and data. I got the chance to visit quantitative asset managers, hedge funds, really around the world, which was an amazing experience. I got to see inside quant shops, anywhere from, 2 or 3 folks working as a small team up to, desks of, 100 researchers or so. Through the course of that, moved from San Francisco back to the East Coast in the US to Boston. And that's where I met John Fawcett, who was sort of in the process of starting Quantopian. He had a back tester. He had a community that was really taking off. So I just got really excited about, sort of all of the cool stuff that Quantopian was doing in this space that I felt like I already, kind of understood reasonably well. From sort of a professional side, Quantopian was sort of opening this up and blowing the doors open, I guess, to this, sort of really elite, secretive, kind of high tech field, and letting, sort of anyone on the internet with access to a web browser sort of have access to these same tools and data and analytics that, I was previously seeing sort of be available to, a very, very small select, group of folks around the world. So I joined Quantopian about 3 years ago. And my role at Quantopian is VP of Quant Strategy, which entails running a little research team. We evaluate algorithms on the Quantopian platform that have been written by our community members. And we're looking for strategies that, beat the market, basically. Really, to get a fine point on it, we're looking for strategies that sort of have risk-adjusted returns. And I think we'll probably end up talking a lot about that later on. And so we're looking to evaluate strategies, and we then actually strike license agreements with folks in our community, and we license their intellectual property, and we make allocations to their algorithms and then monitor how they're doing.
Excellent. Well, that's a very cool story. I just want to go back to the startup that you worked at, which you mentioned there. Sounds like a very interesting kind of business that you were working in there. So you were creating these trading models essentially, but you weren't actually trading them. What were you doing with them? Were you selling them off to like larger firms? Like, how did that work?
Yeah, great question. So we were building these stock ranking models, and we had sort of a whole suite of models, anything from, basic technical price-driven factors up to one of our flagship models was looking at analyst revisions. So, there's a whole cohort of sell-side analysts rating stocks all the time. And we had built a model that would ingest all of those estimates from the IBIS estimate service, and basically make predictions about, as analysts were changing their opinions, what did that mean for stocks? So the output of those models got productized in 2 ways from that team. One was they would be sort of fed into a dashboard that portfolio managers could buy access to. So they would kind of be shown as like, red, green, and yellow lights, right? Like this stock looks like a buy or a hold or a sell based on our model scores. And then sort of more interesting to me was that we would actually sell a data feed of these 1 to 100 rankings. So we'd sort of be delivering a file, on a daily basis to quantitative managers. Every single stock would get a score every single day across all these models. Now, those folks, you might say, why would they want to buy a stock ranking model? That's their job. But it turns out, as we'll dig into, there are so many steps in the process of going from raw data to, a portfolio that you want to buy and trade. So there were a lot of folks that were interested in buying sort of these Lego blocks from that company, Starmine. And I should say they're certainly not the only type of company that sold stock selection factors like that. One other big one was called QSG, and they've been acquired by one of the other large, data vendors. So there's a number of companies like this out there, and their value sort of is, in that range where they're going from unstructured or raw data, processing it, cleaning it up, productizing it, and reducing it down to a more simple factor.
Okay, now I'm not sure if this is going to be a good question or not, but was anyone ever put off by the fact that you were selling these feeds to multiple firms or multiple funds? Like, was that ever an issue?
Yeah, so folks would ask, okay, why am I going to buy this model from you if there is any predictive signal in it that would be arbitraged away by other people using it? So that's like definitely a common sort of objection to purchasing like an off-the-shelf factor. And we could answer that in a number of different ways. One thing we would say was, so there are, how many people directly looking at analyst estimates and trading off of that information, either systematically or not. And compared to sort of that number of people in the market analyzing that data, there's actually a relatively small number of people that would be, necessarily like buying these models from us. So sort of one thing we would say was like, sure, in the limit, if we sold this model to every single market participant, then everyone has the same information. But to the extent that not everyone can afford this model, so we would make it, it's funny because you're in a business where, your product almost sells better the more expensive you make it. So there's an interesting, sort of supply and demand curve, I think. And actually, I think it's a great question because it doesn't just apply to, those factors that we were selling then. I see it actually in sort of the boutique data vendor space, just more broadly, even today. You have this interesting tension between, if you think you have data that's very, very valuable, you're trying to figure out how valuable is it and how do you maximize your revenue on it? Do you try to sell it for a very high price point to a very small number of people, or do you sort of risk selling it, more broadly at a lower price? It's not a solved problem. It's a really interesting question, I think.
And if I could just jump in quickly, I mean, first of all, obviously this term factor is being thrown around pretty liberally right now. And I think we should actually get to defining what that is. But I also wanted to make the point that something that was interesting to me when I started figuring out, how data sets are actually used in finance is there's kind of this sense that if you develop a stock prediction model, that the only thing you can do with it is use it to try and buy and sell stocks to make money on those trades. But that's actually not the case. And there's a lot more uses, a few of which we'll get into today, for, being able to score every stock. And just as a quick example, if you know that some other firm is located closer to an exchange than you are and can make trades faster, and you know that they're using a certain factor to trade, then if you can get a hold of that factor, you might actually use it as an indication not to trade yet, because if you know they're going to trade on something like that, then you might want to say, well, I know that they're already going to trade on it. I know that they're going to trade faster than I can. So why would I just throw in this order, which is just going to get behind them in the queue? So there's more sophisticated uses of this data than just using it to try to directly make money based on trades.
Right. Okay. Yeah, I mean, that's a fair point. Well, Jess, I know you're going to be an awesome fit for the topics we're going to get into during this episode. Just quickly, last episode we covered biases. So anyone listening to this, if you haven't heard that first episode, make sure you go back and check that out. It was a very interesting episode. And Delaney, you might find this funny. It actually inspired me to go out and get a copy of Fooled by Randomness by Nassim Taleb. So I've just started reading that. I'm sure you've probably read that at some point.
I actually haven't read that book yet. I mean, I've taken a course in the past which covered a lot of, kind of this notion of structural uncertainty and tail risk and how different. It was actually a course offered by a philosophy department, so it was really fascinating because beyond just the numbers behind it, we got into what does risk even mean and how different people think about it. And we did read a lot of Taleb's stuff for that course. But what I find interesting is there's actually a little bit of a war going on right now, I think, where if you look at someone else who's also very high profile right now in that field, which is Nate Silver, he's actually been in a little bit of a feud with Nassim Taleb recently. So I think it's what's actually also fascinating is to kind of see how they fight each other on these concepts.
Okay, very interesting. I'm not familiar with who was it? Nate Silver? Is that who you said?
Nate Silver. He's a little bit of a celebrity in the U.S. now because he's a modeling guy who started a business based on being able to predict political elections and has predicted the last two federal elections in the States like incredibly well. And also maintains a lot of sports predictions. And he runs a website called 538 and has a book called The Signal and the Noise. And I think those are kind of great resources for just learning more about the notion of statistical rigor in general.
Very cool. I'm going to check that out for sure. Now, this episode, we're covering various factors in a quant workflow, in particular alpha factors and risk factors. And we're also going to go through some examples of these as well. Before we do so, though, let's start with universe selection. So I guess the first question I'll ask around this is, what are some of the ways that quants decide which products or markets to include in their universe for a particular strategy or portfolio?
Sure. So there's a lot of ways to think about this. I'm going to take the tack of answering this with respect to what I'm going to call sort of a cross-sectional quant equity strategy. So that's the type of strategy that we're sort of seeking in our community and looking for allocation. So if you're going to do something where the design of your prediction is to take a set of stocks and compare them all against each other to try to find out which of these stocks do I want to own and which of these stocks do I actually think may go down in value, then really what you're looking for is to find a big basket of stocks that are all relatively comparable to each other. So, what are things that make stocks comparable to each other? Are they all trading in the same market? Are they all, to some, broad extent, liquid? So they can all, you can sort of exchange one for the other without sort of really undue conflict. And then liquidity covers a lot of it. There's a lot of different ways to look at how liquid a stock is. So one thing people will do is say, okay, maybe I want to choose to select a universe of stocks that are all large cap or large and mid market capitalization, or at least exclude something like micro cap stocks. So a lot of the way that I would think about universe selection would be to say, okay, let's consider if I can buy US stocks, right? Or any market stocks, publicly traded stocks. I actually tend to think of it a little bit like, what do I want to exclude that are going to be stocks or traded instruments that are going to be in that set that don't really rank very well against everything else. So some common universe selection techniques we see people apply would be getting rid of illiquid stocks. Actually, like if you just look at sort of every ticker listed on the US stock exchange, for example, and you go into, Quantopian's backtester and just ask for everything, you're going to not only get stocks, actually, you're also going to get ETFs. You're also going to get ADRs. ADRs are depository receipts that are an instrument trading on one exchange where that company is actually located in another country. So you could sort of look through those things and say, maybe an ETF, exchange traded fund, that itself holds, another couple hundred stocks, or it holds futures or holds commodities. Maybe I wouldn't want to treat that in an apples to apples comparison way with, Apple or Microsoft or IBM. So it's a lot. The way I think about it, for this type of ranking workflow that we think a lot about, is really trying to get to a sample of choices, tradable instruments that are kind of comparable to each other.
And I think another important point there is that a lot of it is trying to make the real world implementation of your strategy as close to your mathematic, formulas as possible. What I mean by that is, like, if your math works out to purchase $10,000 worth of this stock, and that stock is going through a very illiquid time right now, you're not going to be able to do that. And then how will that throw off your portfolio risk? How will that throw off your strategy in general? So if you're trading on stuff that's illiquid, or you're trading on anything that's weird, or maybe is prone to bankruptcy, like super microcap or volatile stocks, it just means that in the future, when you try to implement this strategy, you might get a model that looks great on paper, but is just not going to trade well at all. So really, what universe selection does is not only makes it, like Jess said, more like a comparable thing when you're building these models, but also just saves you time, so that less of the time you build a model, it looks great, but then you try to trade it and it turns out you can't because of real world constraints like liquidity.
Okay, so how should a trader or a quant think about the size of the universe? Is this dependent on maybe the amount of capital that they have? Does that factor into it? Yeah, maybe speak a little bit about how a trader should think about the size, like how many stocks or products or whatever it may be to include in their universe.
Yeah, so I think this is pretty capital dependent. And in general, the way I think about it is, let's say that you have some predictive model, some predictive methodology. Well, you want to make as many independent predictions as possible. And it's for some of the reasons I think we discussed a bit in the previous episode. And we actually have a full lecture on this. If you go to quantopian.com/lectures, there's a lecture called Position Concentration Risk, which does a bunch of simulations to really show you that, if you have a slight edge over random, you should really try to exploit that edge as much as possible by applying your prediction to every single thing for which your prediction is valid. And the more things you apply it to, the more diversification you're going to get in your portfolio, the less risk you're going to face overall. But of course, like you said, if you don't have that much capital, then the amount of positions you can enter is going to go down, because you're going to be paying some kind of fixed trading cost for each position. And at a certain point, the ratio of trading costs to profits is going to be too high. So effectively, the way I think about it, and maybe Jess, if you have another perspective, you can jump in. But the way I think about it is you want to always be invested in as many things as possible. The constraints being, what can your model predict on, and how much capital you have available for allocation.
I think that's right. I think the only thing I maybe would add is you can sort of also draw a distinction between the size of the universe that you're ranking or that you sort of want to look in, and then the size of the portfolio that you sort of choose to trade. So you might decide, okay, I've got, a relatively small amount of capital I want to deploy today. So I'm stuck, with a portfolio where I'm really only going to be able to buy and sell short, 10 or 20 names, stocks or instruments on each side. But I still want to look at and evaluate a universe of, let's say, the top 500 most liquid instruments. So you can take a large universe, rank it, and then you can say, cool, now in theory, maybe I've ranked this universe like 1 to 500, where 1 is my favorite stock to own and 500th is my favorite stock to sell short. And then you can kind of just decide as you build your portfolio of longs and shorts, kind of how far in do you come from that edges of that distribution. And so like Delaney said, the further you come in from the edges of the distribution, the less position concentration risk that you have. And so, sort of the smoother the returns that you're likely to see are going to be. But you have, again, this fixed cost where, each individual stock that you trade has probably some cost associated with it. And at, small portfolio values, you get rounding issues with you're not going to be buying round lots. Not only are you not going to be buying round lots, you might have a really small portfolio size. You're not even going to be able to afford, round numbers of shares, right? You'll get these weird rounding errors. So I think, there's just a little bit of a distinction, or can be, if you think about it, between the universe that you look in to find your portfolio and then how big of a portfolio you decide to trade.
Okay, just to pick up on something you said there, Jess, I think that was a really awesome answer, by the way. When you spoke about rounding, what are you actually referring to there?
Sure. So usually when I think of, and I'm maybe like skipping ahead even past the end of this session, but when I think of building like a portfolio, the way I think of it is, let's say we don't know how many dollars we invest in this portfolio. It's sort of like a unit portfolio. Then instead we're thinking, well, what percent of my portfolio is going to be, in any one stock? And so I'm going to come up with sort of a target portfolio, right? Based on my model, it's going to say, I want to be, 10% in Apple, 10% in Microsoft, 10% in IBM, however. So then you go to like actually implement that, and then you're multiplying your percent weights that you want in your portfolio by the amount of dollars you have to invest in your portfolio. So let's pretend I have $1 million and I want to put 10% in each of 10 stocks. Great, I have $100,000 to put in each of those 10 stocks. And let's say the stock price is, $50. Well, fine. Then, that does, that divides in evenly. But what if I want to invest like $1,000 in each stock, right? If I instead have only $10,000 to invest, well, now I have $1,000 to invest in each stock. What if that stock itself costs, $250 a share, and I can afford 4? Okay, what if the next stock, is actually, I don't know what Google is these days, but whatever,
I think they split actually.
Okay, so
let's assume that there's still $1,000.
Yeah, so let's assume then that Google's like $800 or something that's $800 a share. Well, now maybe my portfolio wants to have some position in that, but I can't buy 1.1 shares. Actually, I can even simplify this to say, you get down to one of the rounding issues is you get down to a level where even if it wasn't that expensive to trade, you really ideally want like fractional shares. That's like a whole separate topic of conversation, but a lot of folks think that's a really interesting spot for sort of retail fintech innovation. There's a company in the US called Motif where they let you buy like these really small little representative portfolios where you say, oh, I only have, whatever, $500 to invest. Well, you'd kind of want to invest that in like a diversified portfolio of stocks, and they'll sort of figure out a way to get you into those fractional shares. But that's something that is sort of a tricky problem for, again, like small retail level portfolios.
Okay, this is interesting. So just to be clear, and I think I understand why this might be an issue, is because if you want to be evenly invested in these 10 companies, as the example goes here, you're not going to be able to do so if the actual dollar amount of the shares doesn't equal the 10% that you want to be invested. So you're like not evenly invested, even though you want to be. Is that what you're getting at? Yeah.
Exactly. Because, so if you're like a total OCD nerd like I am, I wish like every stock had to be like, one share is like $10 roughly, and they have to like, actually splits are a nightmare, so you don't really want splits. But the problem emerges, right, that some stocks are penny stocks, some stocks are a couple dollars a share, and some stocks are very expensive. So if you have small amounts of capital, then when you go to try to split your portfolio up into many, many, many investments, exactly, you run into these rounding errors where you sort of can't get 7.3% exposure to this one stock because you can't, own a fractional share, for example.
Yeah. And it gets back into what I was saying earlier, just like an infidelity between the math and the real world implementation. Because if you tell your broker or if your algorithm tells your broker, hey, I'd like to be 10% invested in each of these 10 names, and then your algorithm doesn't really have any guarantee that anything close to that is going to happen, we're probably throwing away our entire edge, because the amount of noise in what we might actually buy and sell is going to be so great compared to kind of any edge we've attained through our math that it's really tough to get anything done.
Right. Okay. Now, just while we're still on this topic, are there any common mistakes that stand out to you, which you often see traders and quants making when determining their universe?
Like just not doing it at all.
That's the biggest one.
Is the biggest one. So like not having a step that defines what am I willing to consider in my model. So, if you're basically just saying like, hey, I'm going to look to find let's say you're looking at like a technical price driven signal. So you just like sort everything based on last 5 days returns. But you don't even consider that thing that's sorted to the top is like a triple levered ETF, right? You just buy it or sell it. So just the worst mistake I think you can make in universe selection is not doing it.
Yeah, and I would say that's kind of, I think, typical of people who are now entering the quant field as, more and more opportunities to do so are arising these days. But, people who are coming in from maybe a more traditional discretionary trading background, and they're entering the quant field and they're saying, let's apply my normal thing, which is I'm going to, try to do some research. And here's what I used to do research. And oh my gosh, now with a computer and Excel, I can actually look at every stock every day. And oh my gosh, this one has such a great ratio. I'm going to grab it. But, that there's just no thought to do that universe selection step in advance.
Okay. Yeah. No, I think those are really great points. That's awesome. Now, we're about to get into factors. So let's tackle, first of all, what exactly is a factor in a quantitative sense?
So, I think that, and again, I said this before, finance is one of the fields that, because of the amount of secrecy of all the companies working, I think that there is a pretty big kind of not disconnect, inconsistency in the terms that are used by various different people to mean various things. So, when I define a factor, I think this is a pretty broad definition of a factor that's accepted by most, kind of professional quant teams, but different people might have different words for what I'm saying. A factor can mean one of two things usually. It can mean an alpha factor, which is what Jess has been talking about with kind of a stock selection model. An alpha factor is any way that you assign a score to each stock at regular intervals. And that score is supposed to be representative of which stocks you would like to own more and which stocks you would like to own less. The score doesn't have to be the expected return out of each stock or the expected future price. It just has to be representative of like better or worse. And then the other the other thing that people refer to as a factor is something known as a risk factor. And when you get into it, a risk factor is literally just a return stream. It's a time series of returns. And we'll talk about that, I think, a little bit after we talk about alpha factors a little more.
Yeah, absolutely. And I mean, when we talk about factors as such, are these factors that apply to individual strategies, or is this something that is only applicable on a portfolio level?
So let me sort of replay like one sort of high level way of thinking about an alpha factor versus a risk factor, like Delaney was just saying, that helped me. And I mean, I've been like thinking about these things for a long time, and still like you'll come up with new ways people describe these things that are really helpful. So in any case, a factor is like a single number per stock, per day, or per minute, right? So it's like a piece of data. Like Delaney said, it could be a return stream, but it doesn't actually like have to be a return stream. It's a single number. The way I think of it, it's a single number per day per stock that's going to tell you something. An alpha factor, that number should be correlated with or predicting the direction of future returns, such that you should be able to use that factor to pick stocks that you think are going to go up or down in some way, right? Feed that into some model, and it should actually have power at predicting the direction of your returns, the sign of your returns. Whereas a risk factor, and we'll talk about what some of them are, is something that at best you hope is going to potentially be predictive of sort of the volatility of the returns going forward. So if we say something is risky, that means we don't know what its price is going to be tomorrow, but we expect sort of the variance between today's price and tomorrow's price to be relatively large. If something's very low risk, that means I don't know whether it's going to go up or down tomorrow, but I expect it to, if it does, go up or down like by a relatively small amount. And all of these things are relative, right? So that's kind of part of why universe selection is the right first step, because these factors tend to be only useful on a relative basis. So that's the distinction the way I think of. As we start to talk about what some of these things are, there's often like sort of almost an ideological or philosophical debate that can happen with people like, is that thing an alpha factor or is that thing a risk factor? And the definition that I like a lot is an alpha factor should be predicting the sign of the future returns, and the risk factor, at best hopes to predict the variance of the future returns.
So, and in addition to that, so I think it might be helpful to actually just like walk through a concrete example of this. Because, at least when I was kind of figuring out this stuff, one of the hardest things was just getting my head around, like, what is this thing actually? What is it? What is it? What does it do? What does it mean? And one thing I just wanted to say is that we're going to set up for like any of the content that we talk about or point to on the podcast. We'll set up and we'll have it so that that's all listed out so everybody can kind of go and check it out and interact with it. Any notes that I say, hey, you should check this out. We'll try to get it in there. The link for that is going to be quantopian.com/chatwithtraders, no spaces. And we'll have that all set up by the time that this podcast airs. So like, as I'm talking about this stuff, we'll do our best to make sure that there's actually concrete examples that you can follow along with if you want to pause this podcast and actually like try implementing this in code and see what happens. But like a concrete example of this might be something like market cap. Right. So market cap can be used. I mean, both as, and I arguably maybe not a very good one, but both as an alpha factor and as a risk factor. And what I mean by that is the following. So every company at every point in time has a market cap. And so in that sense, it is an alpha factor. Again, like, is it predictive of future returns? Well, it was, one of the original Fama French factors, which for people who aren't familiar, Fama French, Fama and French are both professors at University of Chicago and Dartmouth, and they came up with basically factor modeling as a whole. They really kind of started, and they developed a factor model that explained like a large percentage of returns in the market. And one of the original factors was market cap. Now, of course, that's so old now that, I haven't done any work recently. I haven't checked if market cap is still explanatory of future returns. But the idea is that that's an alpha factor. You just say every stock has a market cap at every point in time. So you could set up a portfolio where you weighted everything in your universe by its market cap and then went long or short on the biggest cap companies and the smallest cap companies. And you could be long market cap, which would mean you'd be long the biggest companies and short the smallest companies, or you could be short market cap, which would mean you'd be short the biggest companies and long the smallest companies. And on the flip side, now what you can do is you can say, okay, well, let's say that you theoretically had that portfolio running, right? And you had been long the big companies and short the small companies, and ignoring for now like transaction cost and slippage, let's just say what's the return on that portfolio over time? And that return stream is used as the risk factor for market cap, because the idea is that that's a well-known factor and it's kind of a fundamental thing that moves along in the market. And if your trading strategy, whatever your trading strategy is, it could be an algorithm, it could just be you manually placing trades. If your trading strategy's return stream has dependence or correlation with this well-known market cap return stream, then that means that you are exposed, you're dependent on it. You are carrying some of the risk from that risk factor into your returns. So I don't know if that's helpful in kind of trying to understand maybe the split between an alpha factor and a risk factor, but the general idea is that you can convert one to the other fairly easily, because a risk factor is just what are the returns had you traded on this alpha factor, and what is your some other strategy's dependence on this known risk factor.
Maybe what might be helpful is if we could talk about how a quant may go about actually seeking out an alpha factor. I mean, I know that might be a whole nother conversation on its own, but maybe if we could just sort of briefly run through that might be helpful.
Yeah, I think we can sort of talk about that at a high level, and then I can give a specific example that I already mentioned from the work I did at StarMine. So you want to find an alpha factor. What that means is you're saying, I want to find a piece of data that I can know about stocks today that predicts whether they're going to go up or down tomorrow. So the most straightforward way of doing that, I think best and most straightforward way is first to develop some hypothesis that you want to test. Intuition, economic rationale. What's a thing I could know about a stock today that might tell me if it's going to go up or down tomorrow? So an example that I mentioned earlier is, okay, well, what if I know today how many, like what fraction of the shares of a given company have been borrowed and lent out for short sale? So the economic rationale for that factor being predictive would go like this. Shorting stocks is expensive and relatively tricky to do. You pay interest when you short a stock, and not everybody knows how to do it. So people that are out there in the market shorting stocks are what we might call smart money. This is the hypothesis. So if I could know today for every company traded on a given exchange, what fraction of its shares have been sold out short, I might develop the hypothesis that would say, companies where, there's a lot of their shares that are sold short, those companies are in trouble. And I think they're going to go down, if not tomorrow, soon. Companies with almost no shares sold out short, those companies are probably fine. So I might want to hold those. So that's sort of your first step, is you develop a hypothesis about a piece of data that you could have today. Then you basically need to test that. So one of the things that my research team at Quantopian has built is a couple of open source Python libraries for looking at this type of stuff. The one we built for analyzing alpha factors is called AlphaLens. One of the ways that people would test this type of thing would be to say, okay, great. So let me take my factor. That's what I know today. So that's how many, what fraction of shares are sold short, for example, today. Now let me run just maybe basically like a correlation, right? Like a rank correlation or some sort of regression against tomorrow's price. So let's pretend I can take tomorrow's price and roll it in today, or take the price 5 days from now. And I basically just say, is there a correlation? If I sorted my universe and ranked stocks and I shorted the ones with the most short interest, it's called, and longed the ones with the least, then how well does that predict or rank stocks based on their returns 1 day ahead, 5 days ahead, 10 days ahead, what have you? And so actually can get like a single number or a distribution estimate that says how predictive, like what amount of tomorrow's returns can I explain today with this single number? That's the basic idea. And like, I guess another way the very last step is you say, okay, like I had a hypothesis, I tried it, there's no predictive power, which is usually what happens. I have to discard that and start over again. Or, you either get lucky or you've been working on something for a long time, you finally find something where, yes, there is predictive power. So a lot of it is like, what I would consider any kind of research scientific process where you develop a hypothesis and then you set about really trying to disprove it until you find something that, you really kind of can't discard or disprove. It actually seems to hold up.
Okay. Now, at the risk of sounding like a total amateur myself, is an alpha factor just a fancy term for a trade signal?
I mean, so the thing about alpha factors is I might argue that a trade signal is just a less quantity way of thinking about an alpha factor, right, in the reverse direction. But the thing about alpha factors is, yes, they encapsulate a pricing model, right? Each alpha factor really just has this sense of, can you predict future motion of stocks? Is it going to go up or is it going to go down? So in the sense that you had a trade signal at every point in time and you either bought or sold based on that trade signal, well, if you just took that trade signal and applied it to every stock, now you have an alpha factor. I mean, the notion of an alpha factor is just taking a predictive model, a trading signal, some forecast of returns, and just applying it to everything, and then looking at cross-sectionally how the entire universe does rather than like any smaller portfolio of stocks.
Okay. Now, just because you might have a quality alpha factor, right? There's something in that, what you've come up with. That doesn't necessarily mean you're going to be profitable when you implement that, because an alpha factor is still totally separate from how you actually manage a trade or manage a position. Am I right in saying so?
Yeah, absolutely. So, it depends a lot on sort of what's the end strategy that you're trying to achieve. But the alpha factor, let's say, even if it is predictive, there are a lot of other steps for a quant in implementing sort of a portfolio, managed strategy that come after that. Sort of without even kind of getting into the whole process, one very common pitfall or failure mode is that your alpha factor is predictive, right? It does sort of contain a forecast about tomorrow that's true, but the edge is so small that once you actually try to go into the market and trade that, you can't overcome transaction costs. So on paper, it looks good, but if you don't model the costs, the friction in the market, realistically what you pay to trade it, you actually can't achieve a profit. So one thing that people try to do, although it's very challenging, is they try to sort of have that alpha factor, have a forecast of sort of how much you expect the returns to go up or down. If you think you can achieve that, which is really a little bit tough to have a lot of confidence in that, but if you think you can achieve that, then you can. If you think you have a forecast that says, I think this stock is going to go up by, 0.1% tomorrow. And then you also know, I know it's going to cost me, 0.1% to make that trade. you have zero profit left over. So sort of one common failure mode is you find an alpha factor, but it's a weak alpha factor. So on its own, you can't exceed transaction costs. The thing that sort of cross-sectional quant strategies try to do often is they try to say, okay, cool, I found one alpha factor. It's weak on its own. It's probably not good enough to overcome costs. So let me look and try to actually find and sort of roll up many different uncorrelated weekly predictive signals, which does get into sort of another conversation, but that's sort of the direction that, especially, in today's modern market where factor analysis has been, well understood for, decades, certainly. And some of these single factors just aren't sort of strong enough to overcome, implementation costs anymore. The sort of modern quant approaches tend to actually say, great, let me sort of know and understand that this individual alpha factor is relatively weak, weakly predictive. But if I can find lots of independent and very different sources of weak predictions, and I can wrap them up together in an intelligent way, now I'm much more likely to have something that's A, going to overcome transaction costs, and B, going to work sort of all the time. So the other risk with alpha factors is that they're predictive, but not very consistently. So maybe you have an alpha factor that works really well, and I think traders tend to think this way too. Like maybe I have a trading signal that I think works really well in bull markets or bear markets or very volatile markets, or not so volatile markets. And if you think you have found signals that actually are sort of more intermittent in their value, then it's an even stronger case for aggregating them up together with other signals that might work well at different times. So I would think of it that, finding one good alpha factor is great, but is just one step of the process. You're probably going to need to find several. And then, I don't think it's necessarily in scope what we're talking about today, but there are a lot of challenges to then putting that into a portfolio that you can trade profitably in the market. I think of it as the most interesting, fun step of the process, but it's certainly not the end of the process.
Yeah, and I think that actually that's kind of a summary of what we're going to be talking about in the next podcast, which is all the considerations that you might actually go through and reasons for combining many weekly predictive alphas into one big, monster alpha. And there's actually kind of sophisticated things you can do. You don't just have to average them together. But the general intuition is just like Jess said, if you've got 10 things and each of them has some signal and some noise, well, as you average more and more things together, the noise, because it could be up or down, is going to start canceling itself out. And then you're going to be left with a stronger and stronger signal. And this is just something that's, ubiquitous to any kind of statistics or predictive modeling or, data science. It's just you're constantly trying to average together weekly predictive things to get at a stronger signal. But again, we'll talk about that a lot more in the next podcast. Okay, Jess has to leave.
Thank you very much, Aaron. It was really fun. And I'm sorry I have a hard stop. I have to get on a bus to head home.
No stress. It was awesome speaking with you, Jess. Thanks very much for doing this.
Cheers. Yeah, no problem. Thanks a lot.
So we spoke there a lot about alpha factors, and you briefly touched on risk factors. I think it might be interesting if we could pull that apart a little further. So maybe what is a risk factor? I mean, that's a pretty basic question, but maybe a good point to start. So what is a risk factor? Maybe how does it differ from an alpha factor? How does a risk factor differ from risk management in a general sense? Maybe if you just want to speak about that a little bit.
Sure. So, risk factors are probably one of the main techniques in modern risk management, because your risk is often measured or quantified by risk factors. And so what I mean by that is, again, like any alpha factor will produce portfolio weights, and from portfolio weights over time, you can say, what would my returns have been, were I able to trade this portfolio? Again, like Jess said, in the real world, there's tons of considerations like transaction cost and slippage and liquidity, and you have to figure out all this stuff when you're saying, does my alpha factor actually translate into returns? And in fact, honestly, that's really what backtesters are for. And so I think I might have mentioned in the last podcast that professional quants really don't spend any time back testing, or not any, but don't spend that much time back testing. And the reason for that is a lot of what they do is hypothesis work, where they're, like Jess said, they're testing a hypothesis. They're trying to see if this alpha factor spreads out returns, if it can predict future returns historically. And then once they've gotten something that they're pretty sure does, based on a lot of rigorous statistical analysis, then the last step usually is, okay, now let's see how it survives real market conditions. And that's usually what a back test is for. Back tests are usually done to simulate a variety of trading conditions, because everybody's going to have different prices they pay for trading and everything. But that's, I think, what at least, and I know what for a lot of what we do, and we're like simulating whether a strategy will do well in this brokerage versus this brokerage. That's what we look at back tests for. But so the general idea is, like, ignoring all of those constraints. Let's just say you were kind of theoretically able to enter into this portfolio based on this alpha factor. Well, now you have a return stream, right? And the idea is that return stream represents the returns that are coming from that alpha factor. And so the alpha factor could be a momentum factor. So you could look at returns coming from momentum. It could be market cap. It could be some fundamental value factor where you're trying to estimate the value of a company based on a few of its, metrics like cash flow and revenue and everything. But the idea is, once you have that return on the portfolio, when the portfolio, depending on the alpha factor, well, then you kind of know, like, had I been trading that alpha factor, I would have gotten these returns. So if your strategy, and there's a variety of ways to do this. Some people use covariance techniques. Some people use multiple regression models. I think multiple regression models are the most common. And in the Quantopian lecture series, we actually cover all this. We actually have lectures that touch on multiple regression. We have lectures that touch on Spearman rank correlation, which is what Jess was talking about earlier. We have lectures that touch on like risk factors. So it's all there if you want to go check it out. Basically, the idea is that let's say that there is the Aaron factor, and I knew what your portfolio looked like every day, and I knew what returns were coming out of it, right? And I was trying to sell you a strategy, and I was saying, Aaron, you should invest in my strategy. And you looked at the correlation between my strategy and your strategy, your returns, and you found that there's actually a 100% correlation. Would that be something that you would be interested in investing in? Probably not, because there's nothing new. It's just exactly the same as what you're doing, and you could just pour more money into your strategy and not pay any management fees. So the same thing applies for risk factors. So let's say that now we have the Aaron factor and the Aaron risk factor, which is the returns on your portfolio. Well, when I'm evaluating my strategy, let's say that your portfolio is a very well-known portfolio, I'm going to look for whether or not my new algorithm or my new strategy has correlation in its return stream with your return stream. Because if it does, really what that's saying is it seems like some of what's going on in my strategy is really just this already known thing. And so, for example, one of the most common risk factors is the market, the broad market in the US, the S&P 500, traded as the SPY. And it would be, you would also probably look at, the Australian broad market in Australia. And so if you're looking at the broad market and you're looking at the correlation between your returns and the broad market returns, if there's a high dependency, then it means that your strategy can basically be expressed by put most of the money into the broad market and then do something else with the rest of the money. Does that make sense?
Mm-hmm.
So the general idea is, if you have a high dependency with the broad market, not only is it really not that different from investing in the broad market and then doing something else with the rest of the capital, but also it means if the broad market goes off a cliff, there's a strong risk that you're also going to go off a cliff. So in general, quants want to make their new strategies as independent of well-known factors as possible, both for the reason that it's more attractive to investors because they're not just redoing something that's already known, but also the fewer things you're dependent on, the fewer sources of risk you have in your returns. If I'm dependent on a lot of different things, only one of those things has to go off a cliff for me to go off a cliff. So just the lower my dependence is on these risk factors, the better generally a return stream is considered to be.
Okay, so let's start to put this all together now. Let's walk through an example. So I know you guys there at Quantopian put together an example about female CEOs as a potential strategy. Would you like to maybe walk us through that, and then we can kind of pull it apart and speak about what part of that is the alpha factor, where's the risk factor, and that sort of thing. But maybe just walk us through that example to begin with, and we'll take it from there.
Yeah, sure. So the Female CEOs Project was a really good piece of work by Karen Rubin, who's our VP of product here. And, she is an exceptional product manager in that, she's actually really willing to get her hands very dirty with the stuff that she's building. And, as part of that, she actually put together a full piece of quant research, which is, I thought was pretty impressive, given that a lot of product managers do not take nearly as many steps into their own product. What she did is she came up with a hypothesis, and her hypothesis, and this is actually backed by a decent amount of finance and economic research in the last, I'd say, 5 to 10 years, maybe more. But her hypothesis was that investing in companies in the broad market, so investing in companies, and I think she used as her universe, I think the Fortune 1000, maybe. I'd have to go back and check it again. We'll have links to this. You can go check it on your own at quantopian.com/chatwithtraders, and you can see all the work. But the idea is she started with the universe, and then she said, within that universe, at any given time, I want to be invested in companies with female CEOs. And so her hypothesis is that being invested only in companies with female CEOs will yield better returns than being invested in the entire universe equally. That's the hypothesis. And so that's where a quant would start, right? They'd say, here's my new hypothesis. Here's what I think is going on. And it usually comes from some interesting insight or broad economic understanding. And again, what we talked about in the previous episode was really like ways to avoid overfitting your models and trying to avoid bias. And, this is an example of, I think, a good way to do things rather than trying a ton of different things and saying, oh, this thing happens to work. I'm not sure really why. But so here you start from like a really solid hypothesis, which is that companies that are currently being run by women will outperform the broad market in general. And maybe the reasons for that could be many. I think that there's some arguments. I don't know. I honestly don't know, and I don't endorse any of these arguments. But there's some arguments that because there's sexism in all industries, the bar for women to meet to get promoted is higher. And so they have to work harder and be better to get CEO positions as opposed to comparable men. And so therefore, companies being run by women are just going to be run better. And then there's also actually a lot of work which has recently shown that kind of social environments of all men tend to make kind of more irrational and riskier decisions. And so, obviously you want companies to make, kind of low risk, rational decisions. And so if your board is has some women in it, that might be a really good sign that the company is going to make less risky decisions. And then finally, maybe the theory is that just the fact that a company is going to elect a female CEO is a good sign that that company is just, it's free of more bias. It's a more progressive company. They're smarter in how they work. So there's lots of different reasons that you could maybe hypothesize that this effect would be true. But the general idea is that at the end of the day, you've got a hypothesis. So really what that is an alpha factor, right? Because your alpha factor is now a score of 1 for companies that currently are being run by a female, and 0 for companies that are currently being run by a male. And that's your alpha factor. You're saying weight might sort companies based on female versus non-female. And so in this case, all the female ones go to the top and all the male ones go to the bottom. And, see, does that spread out returns at all? Do the returns on the female companies at a given point in time exceed the returns on the male companies at any given point in time? And so the way that Karen tested that is she actually ran a simulation of saying at every point in time, just be invested in the companies that are being run by women. And she found that she did actually significantly beat the broad market as a benchmark. And since then, she's actually gone back. And again, we'll link to all this. She's gone back and, done this kind of redone this study and made many improvements and picked better benchmarks. And each time, basically her strategy has still managed to outperform whatever benchmark she's chosen. So it seems like there is something there. There is something in at least in the 2003 to current time frame. It seems that there is still an effect in which being invested in companies run by women does exceed the performance of being invested in companies that are run by men. And the thing that I love about this alpha factor is that it's also something where you could feasibly invest in it yourself. And it's not, obviously, like I can't really make any statements of informed risk, but just from an intuitive perspective, as long as you are invested in a few different companies run by women, you're not really doing anything too crazy or exotic with that, right? You're just that's a method of picking stocks.
Absolutely. So in this example, you highlighted where the alpha factor lies. What about the risk factor? Can you talk about where that kind of fits into this example?
Sure. So now in this case, we have this return stream. We have the returns of the strategy of, let's call it the female risk factor, right? We have the returns of a portfolio of holding just female-run companies over time. And so now what we could do is, as we're developing other factors, other strategies, we could look at those factors' risk exposure to the returns on the female portfolio. So that's how you would then transform this into a risk factor, because you might say, well, maybe in 5 years, this is just well known and everybody trades on it. So I don't want to be dependent. I don't want to have any correlation with this factor. Then you can start using it in the other direction as a risk factor rather than trying to trade on it yourself. And then we can also go the other direction and we can say, okay, we have this return stream of female CEOs, and what are its risk exposures? So we could take a set of, any number of known risk factors, and then we could look for dependencies between, our female portfolio and those known risk factors. And we could say, oh, interesting. It seems like companies that are run by women have exposure to these other known risk factors. Or maybe it doesn't have exposure to these other known risk factors, and this is just a completely new thing that we've discovered. So that's kind of the approach that you would take to either turn it into a risk factor or use risk factors to try to evaluate what is this new thing that you've just constructed.
Excellent. Okay. Well, yeah, this is definitely a really good example, and I've actually watched that video. Was it Karen who gave the talk about this particular strategy?
I think so, and I think there's a few different videos as well, because she's given the different times. She's also actually talked to a few different reporters about it, because as you can imagine, this is a pretty hot topic issue.
Yeah, so definitely I'd encourage anyone who's listening to this right now to check out those links, which we'll put at quantopian.com/chat with traders. Delaney, we're pushing on over an hour now. Is there anything else you'd like to add on this subject?
I think at the end of the day, we talked about a lot of really conceptual stuff today. And I have found that a lot of this stuff is hard to get unless you actually kind of either muck with it a bit or get your hands slightly dirty or, actually try to see it in practice. So all I'm going to say is, again, just like, I strongly recommend that if people have kind of listened to it and maybe they're like, I don't quite get that part, or that part made sense, but I don't get how you'd use it. I recommend going to, again, that link you mentioned, quantopian.com/chat with traders, and we'll try to link the relevant lectures, examples. And I think just seeing this stuff visually, it can be a lot more helpful. So like, for instance, the way I would probably listen to this podcast if I were trying to learn this stuff is maybe, listen to it and then go back and actually try to look at some of these examples that we posted, but maybe also listening through it again, like pausing it whenever you don't understand something and actually trying to read through and look at the plots and just see physically like, oh, okay, I get it. You're sorting stocks this way, and then that mean your portfolio weights are this, etc.
Absolutely, yeah. I mean, if you don't get it, just look it up and dig deeper for sure. So next episode 3, what are some of the subjects we're going to be covering then?
Sure. So, I mean, like I said, I think Jess kind of previewed it in one of the answers she gave. And the general theme is, okay, well, now you have some alpha factors. What do you do with them? Because like Jess said, individual alpha factors, I think, will tend not to be very good. So one of the things that quants just accept is that individual pricing models or individual trading signals tend not to work very well. They don't tend to have much edge over random. And that edge can also go in and out depending on market conditions. Or factors could be predictive in one sector, but not another sector, for example. So the idea is you want generally to combine many different individual alpha factors into one prediction, which is actually quite good. And so what we're going to discuss is all sorts of ways that you could look at, basically kind of combining them together. I'll try to go back into the original kind of stats theory behind this and describe how this is not just a thing that you've done in finance. It's really just done in every single predictive modeling field there is. And we'll actually try to talk about, some interesting techniques you can use, because this is actually a pretty interesting application of, and I think I've mentioned that I'm kind of dubious of machine learning in finance because a lot of people use it in ways that won't necessarily work in the long run, but there are some really powerful ways to apply it. And this is an interesting application of machine learning, which is maybe using machine learning to try to, at any given point in time, select the best factors to be trading on then, as an example. So those are some of the things we'll try to discuss in the next podcast.
Awesome, man. Sounds like a good episode. Let's leave it at that for now. Delaney, thank you very much for doing this, man. I appreciate you taking the time, and we'll speak again very soon.
All right. Thank you. Appreciate it.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's happening, traders? Aaron Fifield here. You are listening to episode 101. Thanks, Emil, for tuning in. My guest this week is Siam Kidd from Norwich in the UK. He's a former Air Force pilot turned retail trader, but he's also much more. He's a serial entrepreneur, and he's also on a quest to improve the schooling system, which I can respect. I really enjoyed the conversation I had with Siam, as you can probably tell by the length of this episode. We got to chat about his shaky beginnings as a trader and his rock bottom moments, how he trades currency pairs with a technical driven approach with the goal of catching major trends when they occur. During the later half, I asked Siam about why he got into business, how he's found the ability to think big, which is something I think many people actually lack, and how he's gotten to a point where he now owns 15 businesses. Then we also talk about flaws in the schooling system, Siam's grand scheme, and what the future has in store for us. Now, there's a lot packed into this episode, but before we get into it, I have a very small favor that I'd like to ask from you, okay? I'm running a survey again, guys. So if you can